Good morning, ladies and gentlemen, and welcome to the G20 Cross-Border Payments Conference, hosted here in Pretoria, South Africa, at the South African Reserve Bank's head office. And of course, we are also coming live to those who were not able to join us in person on the SA Reserve Bank official YouTube channel. I am your host for the next 2 days, and my name is Mavis Mahlwana from the South African Reserve Bank's National Payment System Department. This event has, of course, been made possible through the collaboration of the South African Reserve Bank as well as the Bank for International Settlements Committee on Payment and Market Infrastructures. The conference themed Advancing Cross-Border Payments, Opportunities and Challenges for Sub-Saharan Africa is a key and a relevant conversation point at this stage. For that reason, we have managed to curate a broad range of speakers that include policymakers, regulators, payment service providers, technology providers, as well as academia and non-for-profit organizations and international development partners that focus their work on cross-border payments. To officially welcome us to the conference and lay the foundation for the next 2 days, please join me in welcoming the Deputy Governor accountable for the National Payment System Department at the South African Reserve Bank, Deputy Governor Rashad Kassim.
Thank you very much, Mavis. We have very nice jobs. Basically, you get a little script written for you to welcome everyone, and you go off, and then you go off and earn your big package. Let me just say that, let me take this opportunity once again, in addition to what Mavis has said, welcome everyone to the SARB. People who've come from far parts of the continent, outside of the continent. We really value your presence here. In a sense, I kind of feel a deep sense of relief as we've just got back from Washington, and in a sense, it was the last mile in the finance track of the G20. We had our last meeting at the IMF, which is the last in the series of what we call the finance ministers and central bank governors meeting. And the big issue now is what happens at the summit of heads of state, which happens here in November, and it is the role of our Ministry of Finance, more than the central bank, to put forward the issues that we'd like our president to raise at the central bank at the leaders summit. So it has been really interesting working, chairing the G20 this year, because there are some issues that are very controversial at the G20, and it's very hard to make progress on these issues. And there are some issues that very few disagree with, but there are a different set of problems that throws out. So what have been the most controversial issues at the G20? Not surprisingly, at the G20, we're chairing the G20 at a time where geopolitical conflict is at its height, at its most kind of significant height. So it's very hard to get consensus at the G20 when you want to assess to what extent has the Russian-Ukraine war, the Middle East conflict, and a few other conflicts, to what extent do they have an impact on global growth? Who's responsible for the slowdown in global growth because of geopolitical conflicts? And it's very hard to get consensus on that, as there are different alignments, different countries, and so on. But there is one area where there's not much controversy. I heard this from our colleagues from the US who are taking over from us, is everyone extolled the virtues of a low-cost, efficient, fast payment system. There's no debate there. It's kind of, it's the easiest thing. Whether you have geopolitical conflict, whether you have COVID, it is one area that no one will disagree with. No one is, there's different views about treatment of climate change. There are different views about how you treat the debt problem that is a big issue at the G20. But it is a non-controversial issue to look at and extol the virtues of a fast global payment system. But that is the good news. The bad news is that it's very hard at a forum like the G20 to assess how successful you've been in moving the cross-border agenda. And the reason it is hard is partly the limitations of the G20. It's a global grouping, it's non-binding. The most important countries economically in the world get together and either set standards, put things on the agenda, on the radar that's not there, get their policymakers amongst the G20 set of countries to agree on a set of rules, standards, and so on. But how you move that is a more difficult issue. And I guess this conference is a culmination of or realization of the fact that it's one thing to put cross-border payments on the agenda of the G20, give it all the attention, raise the bar on what you want to achieve. But at the end of the day, you need a number of complementary initiatives to take it further. And this is one representation of these complementary initiatives. I also, South Africa chaired the G20 after two countries that have been very successful in creating domestic fast payment systems. So, we had India, who has been very successful in doing it, chairing. Last year, we had Brazil. But it was very clear to both countries who showed incredible resilience, creativity, the momentum out of very difficult circumstances in both countries in creating an effective fast payment system. There was enormous frustration with the agenda of going beyond domestic. And it's obviously, for good reason, the agenda of the G20 of linking fast payment systems is a much more difficult issue than it is, as difficult as it is to create a fast payments domestic system. In the region, needless to say that there are a lot of challenges in the region. And one of the reasons why we're not going to meet some of our 2027 G20 targets of fast payments is partly because the data we had when the global community set the targets was not as good as it is now. We have a better sense of the unevenness of the global payment system, and that in its own right has been a challenge. But coming back to the region, I suppose just pointing to two interesting case studies in the Southern African region. For example, with the support of the International Monetary Fund and the World Bank Group, the SADC region undertook an in-depth review of the South Africa-Zimbabwe payments corridor. Not surprising to many of you, these findings were very sobering. Average fees for a $200 US $200 transfer stood at close to 13%, which is more than 3%, more than 4 times higher than the 3% target set by the Sustainable Development Goal of 230. We know that the adoption of digital payments remains sluggish, and the idea here today to provide fresh thinking on how we can do this. Another interesting example is in the common monetary area, where the South African rand is pegged 1-to-1 to the Eswatini's Lilangeni, the Lesotho's Lottie, and the Namibian dollar. Recent policy changes because of Know Your Customer and many other anti-money laundering have reclassified low-value electronic fund transfers as cross-border payments to align with global financial standards. While this improves system integrity, it has raised the cost for customers from 10 Rand up to 85 Rand, which flies in the face of what we're trying to do. So this balance between trying to get a low, efficient system, on the other hand, to protect the integrity of anti-money laundering, know your customer, is a very difficult balance. It is sometimes used as an excuse. It is sometimes a very important part of ensuring that the system works well. Not unrelated to cross-border payments, the last session we had at the G20 really focused on very different views of stable coins. And the reason I think stable coins is not irrelevant to the discussion today is that many would argue that the case for domestic stable coins is generally very weak, but there is something to think about when you're thinking about cross-border stable coins. And I think that this is part of the problem. As we delayed in some ways in getting to where we want to, there are all these fluid new technologies emerging, new case studies. There is the Nexus project, which is in Asia, which is an interesting example of things moving ahead. And it's hard to avoid. We're developing a payment system, a fast payment system in South Africa. We haven't been having big existential debates about should we be using a blockchain. We kind of technology neutral, but I think that issue of technology choice becomes a bit more difficult to avoid when you are looking at cross-border payments. And there were very different views on the table on how you think about stablecoins. There were one set of countries who immediately talked about the financial stability implications of stablecoins, how it will disintermediate, the risk it would create. There was another set of countries saying, this is the efficiency in the global economy that you're going to get by using stablecoins. So it is the last kind of issue in the finance track that we have a very difficult conversation on. Not surprisingly, the other area that has become a big issue, and in several of the seminars that I participated in the annual meetings, is the problem of FX conversion. That is a bigger problem in some ways than the cost of cross-border payments. Some of the statistics I've seen, even in countries that have very developed fast payment system, is over 50%, 60% of the cost is FX conversion. And it seems that, once you can tackle the FX conversion part, and maybe you cannot separate the two, we move a long way in trying to deal with this. Anyway, I thought I'd say a few things, some scripted, some unscripted, and that you could use me as an example to say what I said was right or what I said was wrong. Either way, it'll create an interesting discussion. But once again, I'm very pleased that we can have a conference of this nature. I will walk in and out today as I have other obligations, but I look forward, and I'll stream some of it from my office. I look forward to the conversations. Thank you very much.
Thank you so much, Deputy Governor Kasim. Essentially, the stage has been opened for us to move forward with the program for the day, and I think it is quite calming to know that at a global stage, there is alignment that cross-border payments should remain a focus and much work as it needs to be done. And that's essentially how we have curated as in the program as in for today. Before we let the first segment of the program as in start, I just want to take you into how we have sort of structured as in the program. You would have seen from the agenda that there are what we call research discussions as well as policy discussions. Research discussions essentially emanate from the call for papers that we made back in March, where we received quite an overwhelming response with academic papers and so on from a wide range of academia, payment service providers, and so on. And we have essentially invited some of the authors of those papers to make presentations on their papers. And then we have tried to put a nice twist to it, where we will have a discussant, which is an individual who reacts to that author's insights. So of course those sessions will be moderated and will also have an opportunity to receive questions from yourselves around the insights from those papers. When it comes to the policy panels themselves, of course, those are engagements around key matters that we are seeing developing, such as interoperability, prepayment validations, and so on. So we've curated a number of speakers who will engage on those matters. So to just maybe start us off, we thought that it is important to get a view of what is happening in payments from a global as well as a regional perspective. So starting with the global lens, we have Tara Rice, who will be joining us virtually. And she is the head of the BIS CPMI, and she'll be speaking to us about cross-border payment technologies, innovations, and challenges. And once Tara has done sharing with us those insights, we've also then have Damola Owalada from Finmark Trust, who will share with us insights of the Southern Africa remittances market. I just want to check whether we have Tara available on the line at this moment.
Hello, good morning, everyone.
Good morning, Tara. Over to you.
Thank you so much, Mavis. Good morning, everyone, and thank you for the opportunity to speak with you today. I do wish I was there. I really wish I was there. I was in Cape Town earlier this year and very much enjoyed my visit then. So what I wanted to do is just lay out some of the issues that Deputy Governor Kassim laid out and put a little bit of sort of economic theory and context behind it to really flesh out why these challenges are so complex. Okay, why are we here? We're looking to find improvements to cross-border payments. Now, you can see this arrow here. Cross-border payments have been around for a very long time. You know, we started with simply using gold as a means of payment, moved to parchment paper, wire transfers, and today we're using more digital methods such as SWIFT. So there have been some improvements in recent years. There we go. But nevertheless, cross-border payments remain more costly, slower, less transparent, and more limited in access than domestic payments. So that's mainly for wholesale payments. For retail payments and remittances, even more challenges, even more costly, slower, less transparent, and less access. So technology does provide for some new opportunities. We've seen very rapid technological developments in many areas. Today, we've seen progress in the front end, particularly. You know, end users today expect online services, digitally native sort of apps, and we're moving in that direction in the front end on payment systems. For wholesale payments, a bit more of a continuous evolution, and we'll talk about that. There's been some progress. A hub and spoke, another type of model, is another option. I'll talk about that in a minute. Coordination and governance can be challenges, but there are opportunities for greater scalability. On remittances, also mentioned by Deputy Governor Kassim, there's been quite limited progress over the last 20 years. We know this because we've been measuring, the World Bank has been measuring the cost to transfer remittances for quite some time. In general, in 2024, about a $200 remittance cost about 6%, only down from 9% about 20 years ago. This is one area where the CPMI and SARB have been focusing a bit more in this G20 year because improving payments in this area could improve the livelihood for many people. Okay, so I mentioned front end and back end, so let me put a few definitions behind it. The front end is what we see when we use our phone for payments. And it's technically what the end user will see and interact with. But there's a whole lot that goes on, of course, in the back end. And in domestic payments, you can see here we have different payment systems, but most of them are pretty, I would say, pretty common in the sense that there's not a lot of differences among them. But when we get to the cross-border back-end models, that's when we have a lot more variations and then a lot more challenges. This is on the technology side. I'm also going to talk about sort of more the economics side. Okay, so I said there were 4 different models. This comes from a CPMI paper, a couple actually, that we've developed over the past couple of years. So the 4 models are a single access point model, where you access jurisdiction A and jurisdiction B, both access through their payment system, one single financial institution or bank. That was more popular several years ago, but that's being phased out now in favor of these new models using newer technologies. A bilateral link, many countries right now are pursuing bilateral links. It started several years ago and is felt to be a way to sort of investigate first just linking with one other jurisdiction. So Thailand, Singapore, US and Mexico have a bilateral link going back many, many years. The benefit of a single bilateral link is you can work through one-on-one these interoperability, technical governance issues. However, once you have a proliferation of bilateral links is then it has been compared to a spaghetti bowl. You then have just a series of bilateral links, and at some point it's not scalable and it's no longer efficient. So we're starting to see development more of hub and spoke systems and common platform. So hub and spoke, just like a bicycle wheel, is where each different jurisdiction through its payment system connects into one single hub. And a common platform, here we can think about like the BIS's project Agora, where you build a common platform, and the jurisdictions then all have access to that single platform. Today we are seeing, as I said, more innovation in the bilateral and the hub and spoke. Common platform, there is more developments, not just Agora, there's more development in this area, but it is thought that it would take quite some time to build a brand new common platform and address all of those, as I said earlier, interoperability, governance, policy issues. All right, so how do you choose? How does a jurisdiction choose a model? Well, there's many different factors that go into such a decision. Each cross-border payment arrangement has its own strengths and challenges. It's going to depend on the use case, that first box there. So different countries are going to have different use cases. For example, one country may have very strong trade links with another country, and wholesale model that enables trade is going to be most important in that case, whereas some remittance corridors are going to have a separate or different use case. And the one that Deputy Governor Kasim mentioned was the Zimbabwe SADC corridor, for example, which is quite expensive at 13% fees. A second factor is domestic payment policies and domestic payment market structures. So as I noted earlier, once a jurisdiction has set up a payment system, making any innovations or improvements to it is going to affect the decision on sort of what type of model and how they pursue that. And then finally, the ultimate objectives to be achieved factor into what type of model. So that would be, for example, as I just noted, foster trade, improve anti-money laundering and CTF regimes, and finally improve or reduce financial fraud. Okay, so I said I'd get to a little bit of the economics behind these challenges. In 2003, there was a seminal paper on two-sided markets, defining two-sided markets, payment platforms as two-sided markets by Rocher and Tirole. What this means is that there's the payors and the payees, and they each have reasons for coming to a particular payments market or platform. And it's important to be able to get payees, incentivize the payees to join the platform and the payors to join the platform. It's important to incentivize both of those, but of course they have very different incentives. The payors will want low costs, they'll want safety and security, and they'll want to make sure that they have access to many different payees. The payees will want, again, ease of access, as I noted earlier. And they'll want to know that they can also contact, be able to send funds to their friends and not just pay for goods. There's so many different incentives for both the payee and the payor. It's important to get those right so that you can get those, the platforms built up into scale. And there's a whole I should say literature devoted to the different challenges, market failures, and frictions inherent in two-sided markets. In most cases, public sector actions are required to reduce those frictions. Absent public sector actions, you can have problems in a system emergence, so gaining popularity or access to, for some payees, for example, and then also there could be non-competitive pricing or very high pricing. Okay, so this is what happens in domestic two-sided markets as payment platforms. Now think about just joining two jurisdictions, each with a two-sided market problem. We all of a sudden have 2 times two-sided market problems. Now think about 3 links. You then have 2 times 2 times 2. So you can see where I'm going here. All of a sudden, we've just compound the market failures, the economic challenges in this platform economic sort of problem. So what can help? For example, today's conference where we want to talk about some of the frictions, the specific frictions inherent in some of the markets in South Africa, is going to allow us to look, kind of hone in on specific use cases. And as I noted earlier, use cases can really vary with the objectives. So it's not a one-size-fits-all. You need to look at very specific cases. So technological interoperability is one layer that we're going to look at today. Payment policies and choices, again, as I noted, play an important role. And on top of all of this, governance and oversight issues are paramount. So there's more coordination, just to conclude, there's more coordination when you have more than one market, and you have more limited mitigants in order to reduce those frictions. So this leads to, in the end, more problems, fewer cross-border payment arrangements, higher costs, lower access, lower speed, and less transparency. So that's one way of trying to just explain this very different challenge that we're faced here today. I'm going to talk just a little bit about the cross-border payments program and where we are today. Before I get there, let me just highlight a few of the research concepts on this side. Now, this comes from a paper that with Stein-Klessens that we're working on, and it will be published as a working paper early next year. So we lay out these issues in the two-sided markets problem, as I just noted, and the choices that jurisdictions make in resolving some of these issues are going to result in large upfront investment costs in the improvements that they pursue. what that's going to mean is that there's going to have to be some choices. You can't spend all of your, all of your ambition and all of your efforts on every single different option. So you're going to have choices. Choices are going to have to be made by jurisdictions. Incumbents, correspondent banks, for example, large global banks, incumbents so far have been somewhat resistant to change, and that's, of course, results in monopolistic behavior, pricing, et cetera, going back to some of these market failures and frictions. In the end, we can have subsidization, cross-side network effects. This could lead to closed loop systems, walled gardens, et cetera. So how to resolve these coordination issues and these frictions and failures is really paramount to solving some of these cross-border payment problems. All right, so what are the drivers to evolution? Standardization, harmonization, we'll talk about that a little bit. Over the course of the 2 days, a couple of good examples on the CPMI side is the harmonization of ISO 20022 message formats. So this is a message format that was developed several years ago and has been adopted across the world by payment system providers. However, and jurisdictions, it has not been adopted consistently. And so there's a number of fields in a given format, and countries differ in some of the fields. So when it comes time to submit a cross-border message for a payment, you could still see that there's not that harmonization, and there still needs to be manual checks. That's the same for application programming interfaces or APIs. So there's been quite a bit of work thinking about what exactly needs to be done to standardize and harmonize some of these formats that we already have. Interoperability is another concept here. Interoperability means not just having the same technical standards, but it also means having some of the same business practices and having the same sort of, we call semantics, talking the same language, so to speak. And then finally, new interfaces and infrastructures. We noted the technical changes and rapid developments. It's important that those are both user-friendly, but also that they are can be used across different payment systems, across different models. Okay, so there is, we can think of the front end as mainly being driven by private sector innovation. Where the public sector has a role is through thinking about some of these challenges and market failures or coordination issues that I've discussed, and where there could be policy intervention on a small scale to reduce those challenges. Antitrust interventions is one case that's been used, and regulatory harmonization. As central banks, they also play a role as a catalyst, so fostering dialogue with the private sector. And this, for example, both the FSB and the CPMI are doing through a couple of task forces with the private sector, public-private sector task forces. And finally, adoption of new back-end technologies, which the public sector can develop and operate. Finally, then let's add additional complications and efforts here. Technical interoperability is something we talked about on the cross-border scale. Domestic payment policies, which I talked about earlier, they need to be consistent or at least complementary across jurisdictions. And then governance. Just a note on governance, the CPMI wrote a paper a couple of years ago looking at governance and oversight of the interlinking of fast payment systems. So that is also something to look into, and something that is really important when thinking about the interlinking of fast payment systems. Something that we've heard from a number of central banks that have been interlinking their fast payment systems is that the technical issues, these interoperability issues, standards harmonization and interoperability, they are difficult across borders, but governance and oversight issues was much more difficult. One central bank had said technical issues can usually be solved through discussion, dialogue with the other central bank, but governance really required some legal expertise and in some cases, like working out a memorandum of understanding in how some of these governance and oversight issues would be resolved and handled. All right, so I'm almost done here. I have 3 more slides. I said I'd talk a little bit about the G20 roadmap. I know most of you in the room are probably familiar with it. As Deputy Governor Kassim said at the outset, these targets were set early, and the 2027 date to achieve them is rapidly approaching. Today, I would say most people recognize that it's going to be unlikely that we'll achieve all those targets. There are many of them and KPIs, but let me just go over them quickly, because improvements in these is going to give us an indication of where we need more work. So we've got, for cost, we've got, we're looking at reducing the global average cost down to less than 1%, for remittances to 3%. We've got targets on speed, 75% of cross-border payments within an hour, the remainder within a business day. We've got targets also on transparency. Transparency meaning the end user, the sender and the end user actually see when that payment was sent, when it was received, how much it cost, and what all the different factors are within that cost. And then finally, for access, this implies that end users should have at least one option for sending and receiving cross-border payments. So where are we today? In 2020, we started with 19 building blocks. In 2023, we reprioritized kind of the roadmap and how we think about what we have left to accomplish. And we put those remaining sort of actions, our commitments, into 3 broad buckets: payment system interoperability and extension. And you can read here the different elements within those: legal, regulatory, and supervisory frameworks, and then data exchange and message standards. So as CPMI, we've been working closely with our partners. You can see them here, also with SARB, of course, to make inroads on these actions. Today, I can say that we have made many, we have met many commitments and completed many of these actions. However, this is sort of on the input side, and if you look at the CPMI's monitoring survey, you'll see that actually many jurisdictions are now in the process of implementing some of these standards, guidance, policy recommendations, et cetera. However, there is a long lag time between when a country starts to implement those policy recommendations and when the end user is actually going to see benefits on the outside, on the output sort of measures. So there'll be some time lag for that, but we continue to monitor every year both those inputs, that would be the implementation measures, and the outputs through the FSB, those KPIs. Okay, let me just conclude. All right, so back to policy practice. Again, we look forward to seeing all the developments in the private sector. The private sector, again, plays a huge role in building that front end, in facilitating payments, and making payments easier for end users. On the policy side, our job then would be to find building blocks to overcome some of those coordination issues that I just mentioned. So that there's 2 ways to do this. One is through analytical work, which we continue to do: new standards and recommendations, harmonization, interlinking of fast payment systems, data exchanges, data and information exchanges, and then access, one of those 4 frictions that I discussed. More work to do, of course. We continue to work through the G20 and other forms of international coordination to reduce these frictions. Soft law can help with the development of standards. Implementation at the jurisdiction level is critical, and that implementation As I said, we monitor through the CPMI survey. It should be consistent in some sense so that implementation can then reduce those interoperability sort of frictions across borders. And as I just noted, it takes time to see the benefits through to those end users. So with that, I'll conclude, and I thank you again for your time. I wish you a wonderful conference, and again, wish I could also be there. Thank you. Back to you, Mavis.
Thank you so much, Tara. So, colleagues, that was Tara Rice, the head of the BIS CPMI Secretariat, sharing with us some key insights on developments that we are seeing around payments, the rise of the interlinking of systems, the remaining focus work that the BIS CPMI is doing to advance progress towards the G20 cross-border payments roadmap. So we have received that global lens, and it's now time to bring it as in back here at home and the Southern African region. And for that, I'll call on Damola Olade from Finmark Trust. He's the head of the SADC Financial Inclusion Program there. Thanks, Damola.
Good morning, everybody. My name is Damola Olade. I manage the SADC Financial Inclusion Program at Finmark. I'll be talking to you about remittances in the SADC region. And I'm just waiting for my slide pack to come up. Is there a clicker? Hey.
So green to move forward.
Okay.
Just wait.
Well, that is not my slide pack, but while we wait for it, I start talking about it. So there's quite a significant level of migration in the SADC region. This particular talk this morning will be speaking around the implications of migration and remittances specifically. The previous speaker spoke about a wholesale dimension and the retail dimension and remittances as far as cross-border payments is concerned. But this presentation is strictly around the remittances dimension. As far as the content is concerned, I'll introduce it, I'll give you a sense of methodology, I'll talk about the market size, I'll speak to pricing, speed, and transparency, and summarize the findings. So, from an introductory perspective, as I mentioned, there's quite a bit of migration happening here. South Africa is the largest economy in the region, so it receives the most migrants as migrant workers, and there's a long history to this. It goes back to the apartheid period where people came to work in the mines, and then in 1995, the SADC Secretariat also had a protocol on free movement, so you have quite a bit of movement within the region, and it necessitates migration. Obviously, this then means that there's a level of economic interconnectedness within the SADC region, which then implies that remittances becomes a critical livelihood dependency for people outside of South Africa specifically. This presentation or this piece of work is also premised on the global agenda, specifically around expanding access, reducing cost, increasing transparency, and increasing speed, which essentially is what this presentation is based on. So from a methodology perspective, we're looking at basis of assessing access, the basis for cost, speed, and transparency, and then we also look at some additional context as far as engaging with some of the key stakeholders is concerned. So from an access perspective, we had a couple of options here. We could have looked at a demand-side survey specifically, but demand-side surveys would typically not have enough coverage to look at migrants that might be irregular, as an example. So you wouldn't get the perspective of people that might be in the informal economy. So for us to have a bit more precision around how we look at access, we rely more on regulatory data that comes from balance of payments information. So the details that I'll be presenting will be based on volumes and values information as far as what the accessibility to formal remittances looks like. And then when it comes to the cost, speed, and transparency, what we've done is made actual transactions across the different license categories of service providers that serve the market in South Africa to the rest of the SADC region, to then see what the actual receipt cost looks like, which is based on exchange rate margins and the direct fees. That process also allows us to get a sense of the speed of the transactions and also the level of transparency as far as the consumer's a sense of information symmetry, the terms and conditions, to what extent do we understand what the fee entails and how long will it take for the transaction to be terminated. And we also try to get a sense of what's happening within the space as far as engaging with regulators, policymakers, and the service providers. So just to anchor the conversation or the talk this morning, this cross-border remittances report that I'm presenting to you is premised on South Africa to the rest of the region. There's a reason we're doing this. We don't have the resources to look at the different permutations of where people might move to within the region. South Africa also has arguably the best data as far as the BOP categories are concerned, and the templates. And this is being addressed as far as a BOP harmonization program within the RTGS renewal program, and it's starting with the CMA. But at this point, South Africa becomes the kind of proxy in terms of how we think about the SADC remittances market. So it's a South Africa to the rest of SADC perspective, and South Africa then becomes the first mile. The middle mile perspective will be speaking to the clearing and settlements, of which we have the RTGS and the transaction cleared on immediate basis, which is the instant payment system for the region. And the last mile will then be all the different countries that are SADC migrants that come to South Africa send money back to. This next slide tries to contextualize the first and the last mile in a way. So it's looking at the access strand, financial access strand, across all the different SADC countries. And the blue bar there looks at those adults that are banked. The gold looks at adults that are using other financial, formal financial services. This is typically mobile money. And then the gray is informal, and then the red is excluded. This is premised on FinScope data. But the point that I want to make with this slide is that there's somewhat of a fragmentation around the enablement for people's access to formal financial services. So as you can see with the yellow bar, there's quite a number of countries where access to formal services is actually based on mobile money specifically. So and if you consider the fact that there's a lack of interoperability, as the previous speaker mentioned, particularly given the fact that a lot of mobile money operators do not have access to settlement accounts as far as regulation is concerned, or are not allowed to have licenses to provide remittances services, you then have a situation where the decision to use a formal remittances service also needs to consider how the recipients will receive it. So due to the irregularity in migrant profile, a lot of them can't use bank accounts in South Africa, so they're more likely to be using non-bank service providers, and some of those we refer to as authorized dealers with limited authority. And then, again, the access is really driven by agent networks, which then means that we have a remittances market that's very cash heavy. And it's also important to mention that the 4 largest migrant send-in countries to South Africa are Zimbabwe, Malawi, Lesotho, and Mozambique, which are very mobile money heavy driven. So that creates a bit of schism in terms of how people can receive money from South Africa to these countries, and it has implications for digitalization of payments from South Africa to the rest of the region. This slide here gives a bit of perspective in terms of what the market overview looks like. As I've mentioned, some people come into this country and they have a right to work. Some of them are refugees, and those that have a right to work will be able to access a bank account, which means they can instantiate or initiate transactions based on a store of value. And then you have a high level of irregularity in terms of migrants, and you have tourists, especially given the protocol on free movement. People come here, stay for about 3 months, go back, work, try to send money back. However, these irregular migrants and the quote-unquote tourists are not able to access a store of value, and they're typically served by non-banks. We have an estimate of 4 million migrants, SADC migrants in South Africa. 90% are deemed irregular. So you would imagine that these are people working in piecemeal jobs. They are usually low income. They might not meet the eligibility criteria to use banks, and essentially driving a cash-heavy first-mile service. It's also quite important in terms of the next slides that I'll be coming to also show that there's a substantial level of informal cross-border trade or low-value cross-border trade that happens in the SADC region. And a lot of these traders are using remittances rails to move money across borders, which then means that the remittances data that we're looking at is actually masking trade data, which means we have limited tools to assess risk of financial crimes that could be linked back to a sectoral analysis as far as kind of picking out what's going on within the trading dynamic is concerned. And it also gives a lack of visibility to trade and doesn't allow us to kind of develop policies to drive regional value chains. It's a reality in our region. We need to think about how remittances service providers, especially non-banks, can actually take care of low-value cross-border trade. There's a significant level of hawala activities happening, and people are finding clever ways to move money across borders here as well. And we're also seeing an expansion in female migrancy into South Africa because of the expansion in the service industry. On the right side of the panel, some kind of dimensions around the service provision landscape. We've seen an increase in the level of licensed entities serving the market. We're seeing the operational models is typically banks, retailers, money transfer operators. There aren't any licensed mobile network operators here. There's a significant level of partnerships between the authorized dealers and the addlers. And we also see some of the addlers taking on e-money licenses at the last mile and getting into partnerships with MNOs at the last mile. So it creates some kind of a closed loop environment, or actually creating some kind of business model that might not necessitate some of these non-banks to utilize the IPS, the regional IPS, as an example, which is something to think about. I think we've already talked about, the previous speaker, the deputy governor spoke about the decoupling of the CMA transactions from SAMOS, which actually has implications for cost. South Africa is a risk-based approach environment, although we do see that some of the commercial banks specifically aren't using the RBA. For a number of reasons, they have much more stringent compliance areas to adhere to from Prudential Authority. They are much more likely to want to stick to what the Immigration Act is saying. There might be financial surveillance issues that might need to deal with, which is somewhat different from what the non-banks need to kind of deal with as far as compliance is concerned. The gray listing is a key issue. And what is also quite important is the financial or the foreign reserves contraction in some of the countries in the last mile, which then means that there are parallel forex markets, which then drives informal remittances service provision in the region. Just kind of move on. Maybe the last point I should say here that is quite important. So just premising on the fact that we have a freedom of movement protocol as far as the SADC Secretariat is concerned, and understanding that there will be quite a high level of irregularity of migration. the region is yet to grapple with the need for a cross-border verification of static data like IDs or passports, which then would obviously then lead to resolving issues around financial integrity and recommendation 10 of FATF as far as ensuring that there aren't any anonymous people making transactions, which is something that the CCBG is trying to deal with. So going to the formal access, as I mentioned, this is really around formal remittances. The data we're working with is from the FinServ, and the balance of payment codes that you see on the screen there is really how we define remittances. I think a novelty around remittances in the SADC region that I could maybe mention is the value remittances, which is not necessarily sending money per se. People are actually ordering goods. So from South Africa to Zimbabwe, as an example, you can order groceries, which is, I think it's a novelty. Otherwise, the rest are really money or fiat-based remittances. So looking at the data, between 2016 and 2014, South Africa to the rest of the region as a whole increased from 6 billion rands in 2016 to about 19 billion. And for our international audience, that would be about $200, $300 million in 2016 to about $1 billion in 2024. It's really a function of the increase in migrancy. It's also a function of statistics in terms of the improvement in the data itself, the data management around the BOP. On the left panel of the slide, you have the 4 largest corridors. They make up about 90% of remittances from South Africa to the rest of the region, which is Zimbabwe, Mozambique, Malawi, and Lesotho. The fall off there, as far as Malawi is concerned, is really around the previous point that I made in terms of the contraction in foreign reserves and the nascent or a thriving parallel informal remittances market. It's also important to maybe show some of the intermediate markets, Botswana, DRC, Mauritius, Tanzania, Eswatini, and Zambia. One thing I need to say in terms of what might be driving some of these flows is that specifically in Lesotho, you have a retailer model that is driving this process. So this is really people going into a ShopRite in South Africa and cashing out at a ShopRite in Lesotho. And that is really what's driving that market. And some of the subsequent slides might actually kind of give an implication of what is really driving some of these markets. The spike with Namibia that you see on the last panel of the slide is really a function of the move away from SAMOS to cross-border and an improvement in the reporting. So that's much more of a statistical detail. This is showing volumes, and what I could really say here quickly is that volumes is moving, the rates of change of volumes is moving much more quicker than value, and is quite important to mention. And then this slide is really looking at the average transaction sizes that your average sender would initiate from South Africa to the rest of the region. And what is important here is that if you look from 700 rands to about 1,200, which was about 1.4 billion in 2016, this has increased threefold, which means that lower income people that are sending lower level tickets are accessing formal remittances. And it's quite important, even in the manner in which we think about our pricing assessment. So a 200 USD would not be appropriate in the SADC region, as an example. This is looking at how people access remittances. Again, the 3 markets, the largest, intermediate, smallest. And you can see that the largest markets are really cash-based markets. These are really people using cash distribution networks to send money from South Africa to the rest of the region. Why? Because they're not able to access a store of value in South Africa. Why? Because the banks aren't really utilizing a risk-based approach to onboarding customers or customer due diligence for a number of reasons, and it might not necessarily be looking at the actual inherent cost per se. It could be much more around just ticking compliance boxes. This is really a much more longitudinal view around what we look at as far as cash and digital is concerned. As you can see, the non-cash is increasing, but not at the same rate as cash. So now going to the pricing, transparency, and speed, and which is taking me to the last few slides. As far as the pricing is concerned, we're looking at exchange rate margins and direct fees. And that becomes the basis of the pricing. And then when we do that, we weight the data by license categories in terms of values going through the different license categories. So we have the authorized dealers, we have the ADLA category 2, 3, and 4. So if one of these categories is driving access as far as value is concerned, then it would carry more weight when we then do the average weighted price. However, it's important to note that a customer does not think in average prices. They try to find the cheapest service. So we thought to show what the lowest price is and what the highest price is as well, and what the median price is. So, you know, it does look bad in some of the corridors. Botswana is quite expensive, 37.4, although it's reduced to about 22. And you can see the green highlights is really the corridors where you've seen declines in terms of the pricing itself. However, if you look at the lowest price and what people are likely to use, then it tells a different story. So the IMF did a study that Zimbabwe is very expensive, but it's actually within the SDG goals if you look at the lowest price to send money from South Africa to Zimbabwe. So basically, we get into a Kafkaesque kind of realm if we are thinking in average prices, because the customer does not think in that way. I tried to just give an aggregate sense, still going to this idea of weighted average pricing, and the slide kind of gives a sense of what is going on there, just for posterity and also out of habit in terms of tracking what we've done over the years. So SADC is reduced from 9.6. If we look at the actual average transaction size for the region, 9.6 to 4.7. And we look at other dimensions in terms of excluding Malawi. So Malawi is an outlier in the sense that a lot of the non-banks are taking forex margin losses to keep their customers from moving to the informal space. So if you look at Malawi there, it's actually quite bad. But that is now, if given the fact that it's a significant corridor, it draws down the average, weighted average fee, which is really what's going on. So if we do SADC total and include Malawi, it brings down the fee. And then if we take out Malawi, it increases the fee. If we look at SADC excluding Malawi and CMA, it looks quite bad. If it's CMA only, and if you look at the CMA only, which was within the SDG goals, 2.9 in 2021, it's now increased because of the decoupling that the DG spoke about earlier. What we try to do is also represent the 4 corridors that make up 90% of the South Africa to the rest of SADC region, which is Lesotho, Mozambique, Malawi, and Zimbabwe, 8.5 to 3.8. For us to be able to compare our data with the World Bank, we also do the USD 200 just for conversational purposes. The last couple of slides here, maybe just dealing with transparency and speed. Transparency is pretty, so maybe starting with speed. We're in a region where speed is actually within the target or the aspirations of what the G20 is espousing. We do terminate most transactions within an hour. Only that doesn't happen when there's somewhat of a correspondence banking dimension in the transaction itself, or if a transaction is flagged for AML purposes. From a transparency perspective, you might find, so when we were doing the mystery shopping, you might find, especially if there's a store of value in the context of the transaction itself, you might find that maybe after a month or so, or a few weeks, there are still deductions that is linked back to that remittances transaction itself. And this is not an indictment on the banks. It might just mean that like there's a corresponding relationship, something was flagged, there might be a delay in how deductions were made linked back to that transaction. But this would not be applicable when it comes to the non-banks because there isn't any relationship as far as a store of value, and there's a binding quote when the transaction is made. So it kind of shows a bit more transparency, but that's just prima facie. Let me just wrap up. Okay, so what do we take away from this? We underestimate the informal remittances space because we don't have the data tools to do this. We should be putting more money into understanding the informal remittances, informal migration landscape, because there you start to learn what is competing with formal remittances. We need to develop policies on registering informal awalas as well that might be serving a lot of people that might be using informal remittances, which the South African FinServ is working on. The issue of trade data, low-value cross-border trade needs to be addressed, and we do believe that the non-banks remittances service providers should be given some kind of a balance of payment code to address this issue and separate core remittances from trade transactions. We need to think about how to resolve the issue in the CMA in terms of moving or decoupling from seeing CMA transactions as a South Africa domestic transaction and maybe bringing back those costs. Again, the issue around cash, how do we improve digital financial ecosystems? So this is quite important, and I think the previous speaker spoke about this. We cannot think of cross-border remittances as separate from domestic payment systems because being able to actually access a store of value at a domestic level, or being able to make merchant payments at a domestic level as a migrant, or being able to receive my salary digitally would actually encourage me to make digital transactions when I send money. So we need to think about that. We need to think about some of the financial integrity issues as well, and look at cross-border data sharing protocols and frameworks to drive or reduce the kind of sensitivities around financial integrity. In terms of costs, we need to think about digitizing the first mile in South Africa, which will link back to the payment ecosystem modernization programming and some of the activities that are happening there. We need to think about the retailer model in Eswatini and Lesotho, which is actually leading to a lot of queues, even though it's quite cheap. We need to think about how to create options for grannies that are queuing at ShopRite the whole night to get money so that they can have options, digital options as well, even though it's quite an important service. We need to think about how to resolve the low adoption of the transaction cleared on immediate basis. We need to look at how we can get more participation on the RTGS and less of correspondence banking. And we need to look at more adoption of responsible finance principles around transparency and reducing the information asymmetry between some of the service providers and customers. That is the end for me. Thank you.
Thank you so much, Damola, for that overview of how the SADC remittances landscape is looking like, primarily remitting from South Africa to the rest of SADC. Noting that we are slightly as in behind with time, We will move ahead to the next session, which is our first research session that will be moderated by Nonqebo Hadebe from the Alliance for Financial Inclusion, where she is the head for Africa Regional Office. Nonqebo?
Thank you so much, Mavis, for the introduction, and it's a very good morning to everybody. I see you all looking a bit tense this morning. I'm not sure what the Deputy Governor said. I was quite late, and I apologize for that. As I set myself up, I just want to say, taking from what Damola is saying, I'm not a payment system expert, nor am I a financial sector expert. I am actually a financial inclusion expert. And I'm worried, Damola, you keep on mentioning the power of hawalas. And it's a showcase, what are we doing right or doing wrong at the moment? I tried to transact back to where I'm based in Côte d'Ivoire, and I was asked for an intermediary bank of who I was sending to. Now, I've been working in the financial sector for over 30 years maybe, and it came to, 20, yeah. And I asked myself a simple question: what is an intermediary bank, and how is an ordinary person supposed to know they're supposed to input that when they want to transact? And it got me thinking, if I'm having difficulties transacting and I'm banked, how much more for an unbanked person or an underserved person? So what is it that we're doing correctly, and what is it that we're doing wrong at the same time? Are we not the same regulators and policymakers moving everybody back into the black markets? Because honestly, cash is still king out there. Now, as I wear my proper work hat, my name is Nonqebo Hadebe. I am the head of AFI's Africa Regional Office, based out of Côte d'Ivoire in Abidjan. Currently, I'm a Swazi by birth. Interesting. Migrated to West Africa a couple of years ago, and it's been quite a difficult journey because I'm not used to having to look for cash to carry to pay for my transactions, and it makes me very uncomfortable. But this morning, I have an interesting discussion here: advancing cross-border payments, opportunities and challenges for Sub-Saharan Africa. And we must go to the granular level, to the grassroots level, to determine what is actually happening and how are we not meeting the financial services together. I have two panelists who will present papers, and then I have a discussant. But I don't think it would be proper to have everybody cluttered here to sit and listen. So what I'll do is I will introduce my first panelist, Mr. Eugenio, from the International Monetary Fund, to come up and present. And we take it from there. And he will go back, and I'll ask my other panelist. Eugenio, as you come up and move me from the stage, I think it's important to know that you've been working with the IMF, and we want to find out what is it that you find in Sub-Saharan Africa, and we can discuss further. Thank you.
Thank you all. Thank you for the invitation. It's a pleasure to be here. This is my first time in the continent. I'm looking forward to learn a lot. I have been 20 years at the fund. I work in a lot of different places, including many African countries from the program side. I'm working a lot on cross-border banking and capital flows. But as time have moved, we have all these challenges on cross-border payments, and we have a lot of excitement on the new technologies and how all these new technologies have been influencing the payment systems and what is going to happen next. So the paper that I will present, basically, it is a simple question that usually simple questions are very difficult to tackle. We were studying or trying to measure cross-border cryptocurrencies flows, and then we have the big challenge of like, okay, with what we compare that. So the question was, okay, let's try to measure what is cross-border payments. And from there, kind of like that's how we went there. I'm still waiting to see if I have the slides on. And in that context, basically, we said like, okay, what do we do? So let me put first, this is kind of my name is Eugenio Ceruti. This is joint work with Meli Firat and Martina Henge. And you see a long disclaimer here. It's the usual one, but since we're using also SWIFT data, the disclaimer is a bit longer because kind of like that's the standard disclaimer. What I'm going to present is based on a working paper that we have published, this kind of like the 25-120. And what are going to be special for this one is that we have added an Annex D for Sub-Saharan Africa, and we have some of the results that will be in the link in the conference. You will have this kind of new version with that paper there. So what I was saying is like, okay, basic question, how much is cross-border payments? Scary number, 1 quadrillion. What is that? So how we came from that number? So as the previous presenter have put together, we have like cross-border payments is at the end kind of like basics for facilitating trade and investment. So there is a lot of kind of things that are kind of within there that is important to know, and this is trying to use basic data to have a better idea. So we are going to be using SWIFT data to having the market value of these SWIFT payments, how much they compare with other payments, what are some stylized facts, how you break down these cross-border payments by income groups, by type, currency, networks, and so on. Then we will run some regression to do some sanity checks, in the sense it's like, does it make sense? Do we see correlations with trade, with investment, information asymmetries? And as a teaser, at the end, I will just run a couple of regressions, so some tables with geoeconomic fragmentation, if that influences or not the payments that we see. And for this conference, it's kind of a bit of kind of data on Sub-Saharan Africa. So first, the quadrillion part. So basically, if you add up SWIFT, it's huge. So basically, we have two types of basically payments that run through SWIFT. We have customer payments, kind of like, if some of you know, it's like the message type 103s. And we have the financial institution payments that basically are the kind of the more wholesale, the more like done across institutions. That is the two message type that is in blue. If you add up, kind of like the customer is around worldwide, probably around $200 trillion. If you add up all what is going through the financial system, it's around kind of like closer to the quadrillion. I cannot be specific on the number because of kind of confidentiality issues, but the distribution is what you have on the left. Basically, financial institution cross-border payments around 80% of the total, 20% is what you see in customer payments, that they use the banks' networks to carry these payments. So the first question, that's how we were coming to this paper, was to put in context the crypto environment. The crypto environment, I don't know, probably small, the second figure on the right-hand side, you see basically 2.5 trillion. So if you think this is, you see it increasing, especially stable coins is a red one, but you see, okay, this is increasing high speed, but still tiny proportion as a percentage of the total. This is driving mostly because what's happening across advanced countries. We're working more, and we will release kind of later in the year a paper when you start zooming in for emerging and low-income countries. You will see that adoption is much higher, but something that we like is the SWIFT data provide us a good benchmark of what is going on when you compare cross-border payments. So if we move from here, basically, as I was saying, basically, okay, what is all these cross-border payments? Who is paying with whom? So this figure is basically, on the left-hand side, you have the financial institution payments. This is the biggest chunk, and then the customer payments on the right-hand side. The area in blue is payments, cross-border payments that happen within advanced countries. Between advanced countries, the AMD, the red, and between AMDs, the green. So you see that kind of like either way you look at cross-financial payments or the customer payments, basically this is driven by the payments across advanced countries. We have a few figures. I will not enter in everything that we have like in detail in the paper. We have a lot of annexes, but this is more or less to give you the numbers. And Europe, Asia, and the Americas more or less concentrate a lot of these payments. So now it's like, okay, if you look at the number of transactions that happen in the SWIFT network, a lot of them, here is the breakdown of the size of the payments. So you go from $0 to $500 to the highest category is above $50 million. So the number of transactions, you see it here, kind of like it goes, the kind of a larger share is given by the smaller transaction. But when you take into account the value, they dwarf that in the sense that you see, for example, on the left-hand side, you see 82% is of the total value in 2024 was given for 50 million and above. And if you see for customer, it's a bit less, but it's still like 60% of the total. So this is more or less what you see in the numbers. So the average, kind of the number of transactions, mostly in small amount type of transaction, but the bigger carry of the value is the big numbers. What happened if you see this same figure calculated for Sub-Saharan Africa? So here, for financial institution type of transaction, kind of the distribution is a bit less, but still we have that the top categories are the 50 million, 10 million to 50, so it's concentrated there. But when you see the customer payments here, the reality is a bit different than the rest of the world in the sense that the top category is now 1 million to 10 million, so, but you see a lot of more colors, more even distribution. So it's kind of like, in terms of value, it's a bit different. The much larger share for lower type of transaction volumes. You will see that these simple things also will explain a bit of the regression analysis that we have to understand what type of transactions are underlying all these. So an interesting statistic is like, okay, let's look at the currency denomination. What is the currency denomination? So the top figure is for the global. You see that in 2024, with the data that we're using, basically around 53.4% of all the financial institution transactions were in US dollars. Similar number, around 55%, were for the customer payments. There is kind of like, we have data from 2021 to 2024. There is certain stability across the currency denomination. The only currency that was increasing a bit faster than the others, it was the Chinese renminbi, especially, for example, on the financial institutions. If you look at the share in 2024, it was 3.7, and in 2021 was around 2.2, so it was 1.5 on top of that. So in proportion, that's big. That's sometimes when you think, you hear like a lot, oh, the people are using a lot more the Chinese renminbi, but kind of like as a percentage of the total, it's kind of like it's good also to put it in context. What happened in Sub-Saharan region? So I guess cash is king, but also the dollar is king. So you see here is 77.1% for financial institution. That's the total. Have been increasing even 10%. So it was in 2021 was around 67. Now it's around 77. And for customer payments, also you see 62% It's a high number. This South Africa run, especially seems to be is very relevant for customer payments, and this is mostly linked to the previous presentation, remittances, and the importance of Sub-Saharan, of South Africa in this part of the continent. Chinese, for my surprise, I guess in this data is very small and have not been increasing the denomination of the renminbi. So that's more or less of the data that we have here. If we move, this is basically at the global level. So we have basically all pairs from origination to destination of these cross-border payments. What we put a lot of effort in the paper, it was to count things only once. So sometimes you have multiple legs that the payment goes through. We try to count it only once from the beginning to the end. And this is how the network will look in the US dollar on the left-hand side. You see the usual kind of advanced countries, big financial centers, kind of at the center of the network. If you see it for the Chinese renminbi, it's something much less dense, much smaller network, but it's worldwide. You see it over there. And at least it's not surprising that Hong Kong is one of the main centers, but also you see the UK being another one that transacts a lot. So the data is showing. In the paper, we have some network analysis showing how this network is getting denser over time, at least for 2021, 2024. So, okay, sorry, I put an equation. Very quick, this is very basic equation. It's a gravity equation, so it was mostly, okay, let's do a sanity check. Does the data show what we think it should show? You will be guessing, okay, what are these payments? Okay, it will be related to trade, will be related to FDI, will be related to portfolio investment. So you will expect that there will be positive correlations with those items. Also, we throw in geographical distance, common language, and other relationships, just to see what we get here. The results are a bit kind of like what we expected. Basically, you see total payments is basically the addition of both financial institution payment and customers. You see that the correlations are positive, especially with import investment, portfolio investments, FDI. So you see there, and you start seeing basically when you go to customers, you have a bit of this kind of negative relation that you will expect, in the sense that what we see underlying cross-border payments is not only the actual transaction of the good that you have purchased, but also reflects information asymmetries. The more you know your kind of counterpart, probably the more you will transact, and the more cross-border payments will happen. But what we have learned from the regressions and like several hundreds that we have run is that there is a lot of heterogeneity within all this data. And kind of makes sense the type of heterogeneity that we have. So here I'm showing, basically we run all these regressions for each of the buckets that we have data. So the blue is for the category $0 to $500 type of cross-border payments. And the other one is one of the highest, 10 million to 50 million. And basically what I'm plotting here is the coefficients for the main variables with the kind of like confidence intervals. So you start seeing that basically the lowest the amount of the transaction, for example, distance becomes significant and negative. So the farther away, the less the probability you will have the cross-border payments. And this is financial institution. So if we go to the next one, we have the customer, the same. And you see that, for example, the coefficient that was positive, the negative from distance before, now we have it across all type of transactions. So there is some differences across the type of transaction because it reveals who is behind. If we do the same, and this is special for, okay, that's a longer table, but this is for here. Basically, what we have done here, we put the Sub-Saharan dummy, and we interacted all the coefficients. I think what is very clear is the coefficient kind of like on distance and Sub-Saharan Africa that is much more negative across kind of the payments. And that's probably reflecting the type of payments that is being carried here. It's lower amount of money that usually is related to more information asymmetries as a barrier, so you have less payments. So it's kind of like, I think kind of makes sense. Also, to a certain degree, kind of like we see that it's interesting that in terms of imports trade, the interaction coefficient is not significant, so it's not much different than the rest of the world. So it's, you have distance, information asymmetry playing a role, the others a little bit, but not as much, so it's not much different from what is the rest of the world in terms of the payments that we have. So let me quickly put you another equation. This is very similar. Here we are going to put, okay, we all know that we live in a world of a lot of uncertainty, so let's put this fragmentation variable and see what happens. If you increase the fragmentation measured by, for example, an index by Fernandez-Villaverde, what happened with cross-border payments. Also, we put an interblock dummy that basically if these payments are happening between originator and beneficiary of different blocks using kind of United Nations voting patterns, and distinguish between US and non-Chinese kind of aligned countries. Let's see what's happened. Here, basically, in general, by currency denomination, we see that in general, it's bad for cross-border transactions, as you would expect. More uncertainty, more fragmentation, less money goes around. Probably the only difference is Chinese renminbi denominated flows, the increase, probably kind of for more relations there. But this is interesting that it's happening a lot for financial institutions. Here, I keep the financial institution
of dollar usage. And a couple of countries are dollarized. And that also causes a high usage of dollar in the region.
Okay. Any other hands? But not to worry. In Southern Africa, we still think that the rand is king, even where I come from, so don't worry. We'll still keep to it.
Well, the data is showing that, too.
Can I, one more question?
Okay.
Here. That's very interesting. Thank you for your presentation. My question is about the size of the overall cross-border payments market, because I found in the literature different sizes. For example, one of the numbers that is out there is about hundreds of trillions. So do you have an insight on what drives this difference between each estimate, and how did you get to that one?
That's a good question. That's why we started to write the paper. So if you see, I think everybody quote FXI investment of 194 trillions, 2024, kind of like, and we were trying to figure out how that number comes from. And I think using SWIFT data, I guess, what they call constatable market is basically what somebody could go and make money from, and I think it's linked to the customer payments. So it's not the exact number, but my intuition is that that number is linked to that. The biggest question is, okay, what are the other 800 trillion that are going through? It's a lot of FX kind of market transactions, a lot of treasury accounts moving money around. But for me, as a kind of like as a mix of like analytical and operational guy, the question is, okay, what is going to influence FX dynamics or influence the different things, one or the other? And that's probably what we're trying to look after in the SQL papers.
Okay. Thank you so much for that. And George, I think it's you can share with us the invisible senders. Maybe that's why it went missing. It went invisible on us, and share the challenges that we find as well. Thank you so much. Over to you, George.
Thank you very much. And of course, by digital, we mean invisibility. Okay, good morning. My presentation is titled Invincible Senders, Gender Challenging Cross-Border Payments in Sub-Saharan Africa. It explores how women, despite being vital participants in cross-border remittance, face persistent exclusion from formal payment system. Let's begin with our broader context. Remittances are crucial, but inequities persist. Sub-Saharan Africa received over $50 billion in annual remittances, more than foreign direct investment, making remittances to a critical source of household support, covering food, education, healthcare, and small businesses. Yet the region remains the costliest for sending money, averaging 8%, far above the global targets of 3%. While the G20 and the Financial Stability Board reforms aim to make payments faster and cheaper, equity remains a missing pillar. This brings us to the central problem this study addresses. Women remain excluded from formal financial systems. Women are at the heart of remittance flow as traders, migrant workers, and caregivers. However, and mobility restrictions. As a result, they rely on informal methods that offer trust, immediacy, and lack security. So where does this gap in inclusion come from? Our research gap, we look at global metrics that overlook gender. Global reforms measure efficiency, speed, cost, transparency, but not equity. In other words, we know how fast money moves, but not who gets left behind. Women's needs are often invincible in national and regional payment modernization. This study seeks to bridge that gap. The study objectives. Explain the purpose of the study. Our research had 5 key goals: to document women's experiences across 3 broader corridors, analyze structural and social cultural barriers, understand why informal channels persist, propose gender-sensitive reform, and reframe the G20 Financial Stability Board roadmap through a gender equity lens. To achieve this, we built a simple but powerful conceptual framework. Women's choices shaped by access, trust, and agency. This triangle illustrates how 3 forces interact: access to ID and devices, trust in the system's safety and familiarity, and agency in women's power to make financial decisions. True inclusion happens only when these 3 dimensions reinforce each other. Now let's look at how we examine this framework in practice. Looking at our methodology, we explain in evidence-based. We use a mixed method approach, quantitatively and qualitative. Quantitatively, we drew from data sets like Findex, our GSMA, and our International Development Prices on our remittances index. Qualitatively, we conducted over 80 interviews and focus groups across land borders in Liberia and Guinea, Senegal, the Gambia, and Uganda, South Sudan, corridors where grassroots remittances thrive. Now let's see what we found. Our key findings: first, structural barriers. Women face multiple institutional barriers: fragmented ID system, dual KYC rules, and rigid foreign exchange policies. For instance, Guinea ID cards are often not recognized in Liberia, forcing women to use informal couriers. Such hurdles undermine financial inclusion and increase risk. But the challenge is not just structural, it's also digital. There was a digital divide. Skills gap was greater than device gap. Even when women have access to phones, They may lack digital literacy or confidence. They rely on male relatives or agents to complete transactions, increasing dependency and exposure to fraud. Addressing gender gap in digital capabilities is therefore essential. Social and cultural barriers make the challenge even deeper. There are informal There are informal and formal channels. Informal networks fill critical gaps. Women often use informal channels because they are faster, cheaper, and trusted. Community systems like tontons and savings groups build resilience. Interestingly, many women use both systems, formal for transfers, informal for larger or urgent needs. So what do these insights mean for policy and practice? Reform must be gender responsive. We recommend that tier KYC system, gender-sensitive RD policies, and products designed for women. Regulators should require gender disaggregated data and support financial literacy campaigns. Collaboration among central banks, mobile operators, and women's cooperatives is vital. And this aligns closely with the G20 cross-border payments agenda. Alignment with this agenda. We should tie funding, our key message here is to tie our findings to global priorities. The G20 roadmap targets faster, cheaper, and more inclusive cross-border payments by 2027. Our study shows that inclusion must mean equitable access. Sub-Saharan Africa lesson is clear. Reform must build on trust networks, not just digital infrastructures. That's why our focus on land borders is so crucial. Why we focus on land borders? Land borders reflect real inclusion gaps. Most cross-border transactions in Sub-Saharan Africa happen at land borders, not airports and banks. Women traders, refugees, and informal workers rely on these routes for livelihoods. Studying them offers the clearest view of grassroots realities and informs gender-sensitive financial policy. Now let's look at, we had a visual slide. Let me see, is this here? No, it's not there. But there was a visual slide that, let's say, is invisible, but it shows the land pattern between Liberia, Guinea, Senegal, and the Gambia, and of course, Uganda and South Sudan. Now from this, we drew some conclusion. So infrastructure is not enough. Inclusion must be human-centered. Infrastructure doesn't equal inclusion. Women face layered exclusion, from ID gaps to social norms. To unlock the full potential of remittances, we must pursue holistic, gender-sensitive reforms, regulatory, technological, and social. So what actions can stakeholders take? Our call to action is should be inspired by commitment. We must embed gender equity into cross-border payment modernization. Regulators should harmonize policy. Institutions must scale inclusive products, and educators must strengthen women's financial capabilities. Aligning reforms with the G20 roadmap will ensure no one is left behind. Before we go into our discussion, I think I got about 2 minutes, Massimo, very well so. So we propose a policy recommendation. Why this matter exists, and we think that it is a policy imperative. The insight from the invisible sender leads us to an unavoidable conclusion. We cannot achieve inclusive, efficient cross-border payment system without a deliberate gender lens. The proposed research to policy initiative that we've made, bridging the gender gap in cross-border payments, a policy innovation for inclusive digital finance in Sub-Saharan Africa, should therefore be treated as an imperative under the G20 Bank of International Settlement Innovation Platform. It builds directly on evidence of exclusion identified across regional corridors, proposing scalable innovation in digital identity, tier KYC, agent net worth, and gender-responsive product design. By anchoring this proposal within the G20 BRS framework, policymakers can transform lessons from invincible centers into actionable pilots, linking inclusion metrics to payment modernization targets. In short, this proposal bridges the gap between research and policy, ensuring that women's financial agency is not a side note, but a core driver of Sub-Saharan Africa's digital transformation. I thank you.
I think as George takes a seat, thank you so much, George, for that insightful presentation and giving us the gender lens of what is happening as well. Infrastructure versus inclusion and the parameters for gender, access, trust, and agencies. And these three must intersect at all times for meaningful and impactful access to financial services. I think the one that key nugget I found was the recognition of identity cards cross-border. We still do have those challenges in Africa. I'm sure I can't even open a bank account without a letter from my chief at times, in some cases, and I won't be able to open one most probably in South Africa. I would not be too sure, I haven't tested it. But luckily for the CMA, we have access to our banking products if we're from this region. But just also, it was a call to action. Take an introspection of what we've done. We call upon policy makers to make recommendations and set targets. But when it comes to implementation, it seems like it's lacking. I think Tara brought this out this morning as well. We're not going to meet the SDG 10.3 by 2030, let alone the 2027 target. But what is it that we need to do? But I'll just leave that as a reflection and hand over to Noma Welase to take us through her reactions. Thank you.
Yes, thank you, Nongqobo. And good morning, colleagues and the guests of the SAB. We are happy to host you. And I think I've been warned that I'm between tea, and so I'm going to be very brief without repeating the excellent presentations that the researchers have done. So taking reflections from the first paper, quadrillion was a shock to me. And I know in payments we often talk about demystifying payments, but the interest of economists to payments is really complicating for me. I don't know if you were like me when the formula was shown. My colleague here said this is a standard formula, and I thought, I don't know what it means, but it is standard in your world. But it is interesting because we've been talking about the economics of payments. We've been talking about payments economics, which is very important for us to understand the decisions we take as regulators, how do they impact the people on the ground? And this has come very strong in both papers. And I will take a reflection in terms of the coverage of the first paper on quadrillion evolving market. The coverage was impressive, I must say, where you have combined multiple sources, and I take cognizance of 6,496 bilateral corridors. And that being the case, I imagine what Tara was talking about earlier this morning of interlinking with that spider web, what will that world look like? And I think you've set a foundation to incorporate that in your progression of this paper or your next paper that is going to, reflect this mushrooming, interlinking as it takes a center stage in many jurisdictions. You talk of 24,029 corridors included in your research. As much as that is impressive, I think in the wake of trade wars and tariff wars, we are likely to see new avenues, people discovering new markets, and these corridors are going to expand. And it's making life easy, at the same time life difficult. And we actually going to be led by institutions like yours to break gravity model that you applied. But I'm surprised in terms of the outcomes for the Sub-Saharan, where the leading variable there is actually distance and languages, and I don't see colonial ties coming through. And I would have expected that to be more pronounced in Africa because of history, but I didn't see that, and I probably don't know whether that is for the good, or else the data did not tell the right story, because there is a direct link to the language. Because the languages that you have applied in your gravity variables are likely to be linked to colonial ties than they are to vernacular. And I would have loved to see more in depth of that analysis. Which languages are we talking about here as Africa is trying to find itself? Coming to invisible senders, what a touching title. To be invisible cannot be a nice thing. It invokes emotions just from the title. And I'm very impressed by how this was talking to humanity. Aspects we never think of. I mean, at some point in one of the conferences I've attended, we were celebrating the penetration of mobile devices in Africa. Little did I know that there was a group that was not experiencing it the same. And your paper has highlighted that to me. And of course, your paper has touched on recommendations and has gone to be as very practical as possible. But I will tell you, coming from payments and being concerned about safety and efficiency, whenever we have to make a choice, we choose safety to efficiency. And I know you have proposals there that say maybe we need to be risk-based in terms of identity and how we open store of value. And I take those pointers, but I would have loved the paper to take that into the dark side of that coin. What would be the unintended consequences of relaxing some of the rules and standards? And I think we're likely to see that in your next progression of the paper. As we wait patiently, and I saw some of the practical examples of recommendations, because you've gone into depth with practical recommendations, which I'm very impressed by. But as we're sitting and you're proposing aspects like text to audio for people to understand the language, and it's something I've always been, very passionate about, because the language of money has always been foreign to Africans. Even today, we hardly see any financial app that is in vernacular, even in the wake of generative AI. And I think I'm saying this for a third time in a conference. And as we wait patiently to take advantage of this and make money understandable to everybody that uses it, or payments understandable to everybody that uses payments, we are very grateful for generative AI, and I will talk only from the good side of what I expect from generative AI. Illiteracy and some of your recommendations are actually requiring us to collaborate more, and you talk of multi-stakeholder approach, which is a reality. Some of these aspects are structural beyond what we regulate in payments. And to move that dial is going to take multiple other regulators outside the scope and the ambit of payments. But we appreciate your reflections. I mean, the issue of social, cultural, and the confidence in women is quite bothering. whilst the laws, you would recall that we come from an era where women in marriages were minors, and many laws have been lifted, and it's no longer the case, but the shackles that keep them in that state have not fallen. And in your paper, you really have raised something that I thought we have progressed, but the work you have done shows too little in terms of progression. And these are the things that you have switched us on to, and it means we need to go back to the drawing board and as a society talk about raising a girl child. Where does that confidence go? And your reflections are not aligned to what we understand. I think in some quarters in education, it has been reflected that girl children excel during school years, but something happens when they get to employment. What changes? And I think your reflections are very much aligned to this. And I'm looking at the time, I've taken 7 minutes, but I want to thank you both for your stellar work. Thank you.
Thank you so much for that detailed overview of the two papers that have been presented. I'm not sure if my panelists have 30 seconds to say anything or reflect so we can ask the audience. I'm sure I've still got 5 minutes because of the technical glitch. But I'll start with you, Eugenia.
Thank you very much for the comments. When we were running the different regressions and slicing the data, we were surprised why color is not there. When we slice the data, we go for like kind of transaction values for between 0 and 10,000. You see there. If you look at the data, a lot of, I think, is the French colonies driving a lot of that. But once kind of the amount increase, it looks like kind of like you lose it there. So probably it's close to remittances and kind of like trade relationships. So that's there. I think the same food language. So my conclusion is like kind of like the data kind of makes sense, but there is a lot of heterogeneity and the drivers behind are like very different. And when you go, the bigger you go in the amount of money, probably all these information asymmetries are not as important.
For me, I strongly know that the presentation made have been very holistic. We have identified the issues. We have provided a proposal in terms of dealing with the issues. We agree with the plan of speed, cost, and the rest. But of course, gender is excluded, and we need to improve that. We take note of the things that in the gender culture, say in Africa, it was changing now. But of course, education on the side of women is very low, and because of that, they face a lot of exclusion. So in that, we are recommending our proposal for financial education and cultural campaign, which we think will help to bridge this gap. So now that we found the problem, we've identified, it's about finding a solution to identify the problem. And given the time frame for 2027 with our G20 and FSB objective, we can now review it and see how we put into it a proposal, a program that will make sure that when our results come out in 2027, the issue of gender-sensitive program and gender-sensitive outcome would have been achieved. So thank you again for the opportunity, and thank you.
If there's any burning question, I know the coffee needs to be drunk very quickly, but are there any burning questions at the moment, or you can take them up bilaterally? Okay, I'll assume there aren't any, but I just want to thank my panelists and my discussant for the insightful sharing. And I also just want to congratulate the South African government for the G20 presidency. It's been very action oriented in the last few months. There's different side events, but I think what is key is to make them implementable and make sure we action them, because it affects our region as well, in Sub-Saharan Africa. Thank you to the South African Reserve Bank for allowing our panelists to share what it is from a microeconomic perspective. Cross-border payments are critical and a pillar of the global economy, and they facilitate trade, investment, and remittances across nations. But a key takeaway has been that the remittances are much more important than the FDI that we thought in economics we should be looking to attract. And so we need to rethink our policies and also to be human-centric at all times as we do these policies, and intentional. Collaboration is going to play a very critical part of what we do. But I think it's important to never forget that as we operate in the financial sector, it is about inclusion, stability, integrity, and protection of all that are in there. But the most important part is to always protect the financial system. It's our sovereignty, and especially for Africa, if we do not protect it, then we will regress on what we have made, especially in terms of financial inclusion. Thank you so much, and thank you to the audience for this morning, and hopefully we've changed your mind as well and made sure you have more questions to shape the policy according to what is on the ground. Thank you.
Thank you very much.
Thank you so much, Nonghebo, for a very well-rounded conversation. That was our first research session, colleagues, and I think you will appreciate that it was quite thought-provoking as well as impactful. So we have more in store, obviously, for the rest of the day, but for now, we'll take a much-needed tea break. We should be back in the room by 11:30. Just a reminder to validate your parking tickets, please, at the registration table. Thank you. picked up. So clearly we were all in need of some much needed hot drinks, water, and so on. So glad to have you all back in the room. And as always, to those who are joining us on the virtual platform, thank you so much for still staying with us on this cause. So we are moving to the second research session that aims to engage on the interaction between migration and international remittances. And this particular session will be moderated by Maxine Hlaba, the Manager, Executive Secretariat at the SADC Banking Association. Maxine works very closely with the SADC central banks regarding payments integration efforts in the region. Over to you, Maxine.
Thank you, Mavis. Bonjour, bon dia, good morning. All protocol observed. So I have the honor of trying to moderate the next session, and I think I will call upon, I'll call upon my presenters one by one, and then we will sit up front at that point. The first presenter is Silas Marimo. Silas, are you here? There we go. Thank you very much. If you could come up. And Silas is going to present to us on the migration and cross-border payments, analyzing remittance dynamics in Sub-Saharan Africa. And please, we each have 15 minutes, because then that will give Antonia 15 minutes, and hopefully we can catch up. Are you doing a presentation? So this is to go forward.
Thank you, and a very good morning to you all. I'm Silas Marimo from University of Joburg, representing a team that is led by Professor Oliver Takawira. With me here is Ian also Gangata, in absentia, Dr. Musi. So we are particularly going to be presenting mainly on the migration and cross-border payments, analyzing remittance dynamics in Sub-Saharan Africa. Okay, there is the outline of what we are going to be discussing on, just the background, problem statement, a little bit of literature review, methodology, findings before we go to conclusions and policy recommendations. So particularly, cross-border payments are very crucial in terms of fostering financial inclusion, trade, and economic integration. And based on also what other speakers have highlighted in the past presentations, I think we've just seen that expansion of regional mobility, intra-African migration, and digital financial infrastructure has just reshaped the dynamics of cross-border payments in Sub-Saharan Africa. And would want to say also migration has become a significant driver of cross-border financial transactions, particularly with the remittance side. Remittance play quite a crucial role in terms of supporting household income. You'd find that migrants usually, when they move from one country to the next country, they live along family members and children who need support from them. So remittance play quite a crucial role in terms of also the welfare of families that are back home. And in some African countries, would find that remittances contribute more than 20% of the GDP. And I think there's one speaker who then did mention to say, previously we were really focusing on foreign direct investment, without really taking a closer look on the figures that are coming from remittance figures. Having given this background, there still exists a gap in terms of understanding how migration patterns really influence cross-border financial behavior. One would think to say if there's an increase in migration, remittances will improve, cross-border payments will improve, but this research will give you some light with regard to that. Then in terms of problem statement, I think we did then discuss in terms of what are the issues that we are experiencing here in Sub-Saharan Africa. And one of the things that were mentioned and one of the things that we found out within our study, within the cross-border payments system, or with particular reference to the remittances, we then found out that remittances in Sub-Saharan Africa are fragmented, they are costly, and they are inefficient in terms of settlement. Sometimes it takes time. There are a lot of things that are at play in terms of settlement and in terms of cost and speed. Cross-border payments are being facilitated due to these barriers in terms of cost, inefficiency, requirements for KYCs by different players, different regulations from one country to the next country. You'd find that migrants have now resorted into using other forms of sending money, which are mainly the informal channel. I think one of my brothers who presented before us did mention to say they still need for institutions and policymakers to then investigate more and invest more in terms of monetary value in trying to understand the informal channels. And so one of the problems that comes with informal channels include distorted national remittance data. Some of the data that we have currently doesn't reflect the funds that are being moved within the informal sector, undermining the accuracy of macroeconomic indicators and financial inclusion, which would also then affects in terms of policy recommendations and so forth. It also complicates monetary policy and financial surveillance, and sometimes these informal channels are also used by some individuals who then use it for externalization, embezzlement of funds, money laundering, and circumventing capital controls. These are the challenges that are coming with the informal use of sending cross-border payments, particularly within the remittance sector. These problems have come to play because there are also other barriers that are restricting even migrants to then send money from their countries. I think one of the presentation also highlighted to say there are across estimated 4 million migrants within South Africa, and 90% they have got irregular documents, which means they're resorting to other things. And they're resorting to other things mainly because of the barriers that are there. And it's a problem that is evident within Sub-Saharan Africa. And one of my history teachers always said, where there's a problem, there's always an opportunity. So the good thing is that today we are seated here. Indeed, there's a problem in terms of cross-border payments. Indeed, there's a problem in terms of remittances. But there are also opportunities which regulators and policymakers who are sitting into this room can also come up with. Motivation of our study, it's a paper that we wrote with the team from University of Joburg. Mainly wanted to examine the impact of migration patterns on cross-border payment. We also wanted to identify challenges and opportunities. As highlighted, where there are problems, there will be also opportunities. We also wanted to suggest actionable policy implications for enhancing efficiency of cross-border payments. Therefore, our hypothesis for our paper, which we submitted, was migration influenced cross-border payments in Sub-Saharan Africa. There we go in terms of statistics. We did collect our data from World Bank. And as we can see, from 1990 to 2024, in blue, those are international migration stock. They are on the rise. At the same time, remittances per capita, it's also on the rise. Whilst remittance flows were significantly low, below 10 million between 1990 and 2000, they increased sharply between 2000 and 2015 and maintained a steady growth between 2015 and 2020. Sharp increase in remittance from 2020 to 2024, reaching over 50 billion in 2024, which still then presents an opportunity also for other participants that are still sitting here, that this is actually a growing industry. that is worth investing more money to tap into revenue that can be generated from remittance business. In order to try and open up the discussion and analyze and try to understand the analysis that will come after this, we then reviewed the theoretical literatures or the theories that underpin this certain study, and we also reviewed empirical studies. So some of the theoretical literature, which I will not go into detail, is the new economics of labor migration, the transaction cost theory, the network theory, digital financial inclusion frameworks. These were theories which were trying to explain in terms of migration, in terms of remittances. They are linked to our study. Then in terms of empirical studies that have been done in the past, some work has been done before our work that we are going to be publishing. And in terms of empirical studies, that is part of empirical studies, and one of them actually highlighted that a percent decrease in cost of remitting US dollars to 100 leads to about 1.6% increase in remittances. Transaction costs have significant negative impacts on remittances. Migration stock has insignificant impact on remittances. We might go throughout the list, it's very long, but I think our research will then maybe give a review of what it is within our specific area of Sub-Saharan Africa. Then in terms of the methodology that we used in this paper, we used a quantitative analysis approach using panel data from 2004 to 2024. We then selected 6 Sub-Saharan countries, mainly because of issues to do with data. You'd find that there's a lot of issues to do with data availability within Sub-Saharan Africa. But our sources are mainly World Bank, IMF, GSMA, and World Governance Indicators. Those were the pre-tests that we actually carried out before we analyzed our model. These were the expectations. These are prior expectations to say what is usually expected based on theoretical review. Does migration stock increase remittances? Does migration stock reduces remittance? And the expectation was both sides, negative and positive. Financial access, we expect it to increase mobile penetration. But the bigger question today is to say, within our specific Sub-Saharan Africa, does migration costs or does migration stock increase remittances or cross-border payments and other variables to mention than a few. This is our model. I will not go deep into it. I'll proceed to then go into the results. So these were our findings from the research. To our surprise also, migration stock was not really, a unit increase in migration stock was resulting in negative values of remittance or cross-border payments. I think the reasoning behind on that finding, it's one of the reasons that one of my brothers did indicate to say, there's an estimation of about around 4 million migrants moving maybe within South Africa or within SADC. But on the 4 million, 90%, they've got irregular documents. What do they really do? They then intend to use other methods. There's also other theoretical theories which also explain to say there are cycles that are within migration. At a certain cycle, individuals don't tend to remit back to their countries, but they tend to save and then invite their families to the countries which they will be. Financial access, we saw that an increase, unit increase in financial access would then also improve in terms of remittances and cross-border payments. Same as mobile penetration, cost to send, regulatory quality and negative. There we go. 6 of the variables that we had used were quite significant at 5% and 10% level. And as explained, the shocking results for us for migration stock, 1% can significantly reduce remittance, of course, with the explanations that I've just given. Access, I think it remains one of the important variables which really influences cross-border payments, particularly remittances. So as mobile penetration also, an improvement in mobile penetration means more remittances and cross-border payments would also increase. A percentage increase in cost of sending remittance by 1% can increase remittance flows by about 0.25. A percentage growth in GDP can significantly increase remittance flows by 0.01. Right, so in terms of conclusion, we did find out there is an interplay between cross-border payments, remittances, and migration, which offers developing economies in Africa a pathway for sustainable social economic development. Factors that we found to be influencing cross-border payments are transaction costs, migration stock, financial access, macroeconomic instability, income level, and mobile penetration. Our recommendation after our study, if it has been published successfully, is that other further studies should also employ larger samples, which might just go beyond Sub-Saharan Africa, and try and look for more data within Sub-Saharan Africa. And we also would recommend that we use other modern estimation techniques like machine learning, not only to get the explanatory or getting the explanation regarding the interplay of migration and cross-border payments, but also to try and predict what would happen in the near future. In terms of policy recommendation, we suggest the implementation of initiatives and policies that promote adoption of fintechs, e.g. mobile money services. We recommend mobile money services because most of the services that are done within mobile money services are instant. And in terms of KYC, you don't really need like a proof of residence to then go and have a mobile money service. Relaxation of barriers of cross-border payments, e.g. stringent requirement for sending money. As highlighted, it's still a topical issue to say how much is being sent via the informal structure. What can we really do in terms of the requirements that are required? Remember, these people are moving within Sub-Saharan Africa. They might be born in South Africa, they've got a birth certificate in South Africa, they've got an ID in South Africa, they've moved it to Botswana. So it means there's some sort of identity that they have. So our recommendation was to say central bank governors and policymakers should then try and find ways of relaxing barriers to cross-border payments, but making sure that everyone is safe within the financial service sector. Encourage investment in digital infrastructure to boost financial access and reduce transaction costs. Central banks in Sub-Saharan Africa should aim to develop a coordinated send and receive remittance platform to facilitate remittance of funds in the region. We do acknowledge that there's an already existing platform that was also the Pan-African, which was already established, but in terms of popularity, it hasn't been really able to make much strides. So we really recommend that central banks should put heads together, come up with a platform that enables send money and receive money via remittances, which is instant, which has got speed, which is also a risk-based approach. To deal with informal remittance, the study recommends a risk-based approach on KYC onboarding to promote formal channels for sending and receiving money. This was our last recommendation to say, although different countries and jurisdictions are applying different regulatory, but we should now move more closer to risk-based approach, which enables even some migrants that have got the minimum KYC to be onboarded and to be able to send their money via formal channels. With that, I thank you.
Can I invite you to join us? Okay. Yeah, instead of going down. Thank you very much for that, Silas. I'm not sure about those recommendations, but I think if we get to the opportunity to consider some questions, I'm very interested in the barriers, what your thinking is there. I'm sure the central banks don't want to hear that, but it's one of your proposals. I'm going to invite the next speaker, and the next speaker is from the World Bank and is joining us online. Oya, are you online?
Yes,
So
I'm here.
Brilliant. Good morning. It's a very early morning for you.
Indeed. Thanks.
Welcome. The session is yours. 15 minutes.
Thank you. Thank you. Let me also start sharing my screen. So hold on. I'll do the presentation mode. And share now. I hope you can see it because I can see myself sharing right now. Good morning, good afternoon, everyone. I will be talking about a particular research paper that we are currently working on. It's about understanding the remittance behaviors among migrant communities. Without further ado, let me briefly explain what we're going to do. So I'll start with the context and introduction, and then we're going to directly dive into the data that we have on senders and receivers. And then we did some analyses, statistical and econometric analyses on the preferences of senders and receivers. So we're going to talk about those. And then I'll have some observations and key takeaways, which we can use for the discussion as well. So in terms of the context, I think I'm already talking to a converted audience anyway, so I don't have to go too much into this. But we all know that remittances are important for a good number of people all around the world, and they provide a financial lifeline and critical support for many, many families. At the same time, remittances present an opportunity for us to improve financial inclusion because it's in many instances, it's the one and only time when migrants or receiving families interact with formal financial service providers. And then we also know from the existing data that we have at the World Bank, and also others have been collecting similar data as well, that reducing transaction costs is a big issue. Remittances can be very expensive, and any cost reduction means that either the sending side or the receiving side or both sides of the families can enjoy higher incomes. And then we also know that digital remittances are cheaper. They're more secure and more transparent. And we also think they are more convenient to those people who are able to use, so those that are digitally and financially literate. So that said, what are we doing in this particular research paper? So our starting point is that the World Bank had a technical assistance program in basically 4 receiving countries in the past 6-7 years or so. These countries are Bangladesh, Egypt, Ethiopia, and Nigeria. And we have done quite a bit of work with the central banks on improving the domestic payment systems, as well as specific work on remittances. So we wanted to collect some data in this context, specifically investigating the sender side. We do have some additional data that we collected earlier on the receiver side in some of these countries. And then we also do know from other research that there has been some investigation of the receiver side. But we wanted to do a little bit more into the sending side because we understood earlier from the receiving side that in many instances, it is the sender, the migrant, who decides on how to send. It's not necessarily a decision by the recipient. So how do we find these senders? Obviously, they're not in their home countries. So we decided to take a look at the major sending countries to this same group, the group of 4 countries. So the common major sending countries. And then we ended up in Italy, Saudi Arabia, and United Arab Emirates. So we collected data through household surveys in these 3 countries, and the data covers only migrants of origin from Bangladesh, Egypt, Ethiopia, and Nigeria. So in the current presentation, I'm going to focus on Ethiopia and Nigeria, but the broader research paper will focus on all countries. So just a brief overview. Remittances are extremely important for Nigeria. The inflows are really very large. In Ethiopia, in the macro level, inflows don't seem as large, but at the micro level, we know that it's really a big deal for the Ethiopian families receiving remittances. It's a lifeline. So both countries, both central banks and authorities have done several reforms in the past 7-8 years, trying to improve their domestic payment systems, but specific reforms also focusing on remittances to boost remittance inflows to the country. So there are obviously still some challenges. Otherwise, we would be saying, oh, these are really great solutions, let's apply. The challenges remain because these solutions do not always translate into user benefits. So there's also, there should also be a focus on how we can realize benefits at the user level as well. So going back to our data, so if you take a look at the columns, you're going to see the entire sample, the sample in Saudi Arabia, the sample in United Arab Emirates, and the sample in Italy. We do have a mix of men and women. Interestingly, most senders are men, but we managed to get a good chunk of women as well. We have a different age composition for different countries. Actually, you can also do all this age composition for the receiving countries based on the sender's demographics as well, and there are some interesting patterns that come up. So the data set is, as you can see, is quite rich, and there are a lot of things you can do. So what I am going to do is to zoom into only very specific components of the analysis, because we can, for example, think about whether we want to analyze the entire data based on the sending countries, because the sending countries will have a specific enabling environment, whether we want to analyze the data from the receiving country perspective, even if the sending countries are different, and so on and so forth. So this is really a very interesting case that we think it can reveal a lot of fruitful results based on the type of analysis that we're using. So on the country profile within the sample. So for Ethiopia, the sending countries are all 3 countries in the sample. Average transfer size is $360, with 27% of Ethiopians sending less than $200. And we also have information on frequency and whatnot on average. We have information on the average demographics. Basically, 42% of senders send transfers at least monthly. And main reason for not using digital transfers is essentially people just use cash for everyday transactions. So they don't even consider digital as an option. And this is true even if these senders in the data set have accounts to start with. Okay, so Nigerian senders profile is not too different. Average transfer size is smaller, $290, with 38% of Nigerian senders sending less than $200. And then we still have the same cash dependency result here as well. Main reason for the Nigerian senders not using digital transfers is they just use cash for everyday transactions anyway. So digging deeper into how people end up sending, actually, we see that most of the senders actually use formal remittance channels, which is, good. And also similarly for the receivers, most of the receivers of these senders are on the other end, of course, receiving formally. So we wanted to take a look at what does formal mean, and mostly, essentially, it is a bank transfer or a transfer using a money transfer operator, and most of these remittances are collected as cash at an MTO agent or a bank agent or a bank branch. So we also observed, comparatively speaking, in our sample of only 4 country senders, informal methods are much more prevalent among the Nigerian senders. Essentially, full digitalization of remittances is still in its early stages. So we can take a look at the entire sample. The cases are that sometimes on the sending end, sending is done digitally. Sometimes on the receiving end, receiving is done digitally. But fully digital end-to-end is not there, is not commonly there, let's say. So then a little bit more digging deeper into the specifics. So there are some instances, obviously, that we need to think about where the recipients have an account or recipients do not have an account. And this can obviously impact whether full digitalization is possible. And of course, basically, sometimes we observe that recipients are, even if they do not have an account themselves, they are using accounts of others that are around them to receive their remittances from their families. And then essentially, for those recipients that do not have an account, the sending method becomes mainly informal in that sense. So informal channels are more prevalent because of the recipients not having accounts. So again, we did some more thorough analyses of formal versus informal sending. Overall, as we were just discussing, account ownership is a big factor here. Interestingly, age also seems to be correlated. So the older the sender, basically, the more it is that a formal method is chosen, the more likely it is that a formal method is chosen. And again, sending to rural areas, it's also important here in terms of the choice of informal methods, which probably is an indicator of formal remittance channels not necessarily being available in rural areas. Now, second step, digital versus cash. As I said earlier, there are 2 different ways of describing what a digital remittance could be. So one leg of the transaction could be digital. If we use this as a much broader definition of what digital is, then this is what we have here. So essentially, higher sending amounts and account ownership translates into the higher likelihood of using a formal channel. Also, age is related. Age seems to be related again here as well. Higher education levels and sending to rural areas are sending to urban areas are linked to send digitally. And lastly, we did a more strict definition of what a digital remittance is. So this is digital on the sending side, digital on the receiving side simultaneously. So there is a difference between Ethiopian and Nigerian senders in the sense that for the Nigerian senders, if they are sending end-to-end digital remittances, this is higher sending amounts and less frequent sending. Those are the two major determinants or correlates. Let's put it that way in a better way. And for Ethiopian senders, there are some additional factors that turned out to be significant. For example, the younger the sender is, the higher the likelihood of using end-to-end digital. Male recipients, end-to-end digital, potentially indicating some sort of a gender gap on account ownership on the receiving side. Higher educational attainment of the sender indicates a higher likelihood of digital. And account ownership of the recipient obviously is positively correlated with choosing digital as well. So just a few key takeaways on my side for the discussion and for your consideration. So essentially, corridor-specific factors are important. So for us, the results for Nigerian senders and Ethiopian senders were different, and also the ones that we didn't show on Bangladesh and Egypt as well. There is also a big element of macroeconomic management to encourage trust in the overall financial sector by the remittance senders and receivers. So that is an important point to remember. Transparency, therefore, relatedly becomes important. Digital ecosystem, still we need to do more on developing that, especially in rural areas where it currently lacks. Policies can be designed to target small transfer users, and not just policies, but also product design can be specific to small transfer users so that it can boost uptake and usage. And financial literacy programs, of course, it's always a plus to enable more confidence, instill more confidence in the senders and receivers, and to push for more usage. So, needless to say, payment infrastructure reforms, but also the last point is on merchant acceptance on the receiver's side to make digital remittances more useful. So essentially, if the receivers are supposed to cash out immediately and not use any digital transactions, then it doesn't really make too much of a sense to actually trying to push for digital remittances because it's not of good use for them. So with that, I stop and hand over to Maxine.
Thank you very much, Oya. Now, our discussant for the day is Antonia Issa, and she's with Senfree. Antonia, could I invite you to the stage? Thank you.
Sorry. I can sit. Why don't I sit? Or I stand. I'll stand. I've been sitting a long time. Good afternoon, everybody. My name is Antonia Essa. I'm a migrant. As you can hear from accent, I'm one of those, vulnerable groups that come from Europe to Cape Town to escape the hardships. I joke. I'm a researcher and a consultant. Been working a lot with central banks across the Sub-Saharan African region and have done research myself, not to this high standard, so I really enjoyed both papers quite a lot. And I think there's so much here to unpack, and I'm so excited to see new research methods from both papers to be deployed in an imperfect data world that we are really operating in. It makes me nervous to see how many papers are utilizing the same sources. As you will have seen, there's a lot of World Bank, IMF, and those are and GSMA, Findex, those are very important data sets, and we can't overemphasize how important and critical they have been. But I think what we are seeing from the two papers is how important nuance in data is. And we're hearing, bilateral migration matrices, bilateral remittances data is very important, so you can see the corridor flows. But if you look at the underlying data sets, a lot of data from Africa is missing. And we are seeing the big corridors covered really well: Ethiopia, Nigeria, Kenya, South Africa, those big inflows, especially from outside the continent. But we know so little about the intra-Africa corridor sizes, behaviors, and if anything, these results are telling us is that we cannot generalize from one corridor to the next. So what may work in a UAE to Nigeria corridor may not work as well, for a Ghana to Nigeria corridor, for example. Me, as a migrant, I have a very different background from the women we heard about in the earlier session. Our realities are not the same. But I do need to just pick a bone here. If we could talk about the South Africa-Germany corridor, there is a lot that needs to be done as well. So again, the reforms are quite specific to the corridor that we're needing to see, but the session is really the focuses on the person behind the flow. Why are us migrants sending money back home? Gritty people, leaving everything behind, starting in a new country, and one of their main drivers is they want to provide better lives for their families, so they will find a way to send those funds. And we are seeing the increase in the values across the globe. So remittances are increasing. Now it is about how do we formalize them, how do we utilize them in a way that it provides value to the remittance recipient and the sender in, for example, the form of a cost reduction. So the number one takeaway for me and for a policy consideration is that the lack of data presents a problem. The lack of data, especially in the smaller corridors that may not be as prominent, but rely a lot on remittances like Lesotho, like Eritrea, Gambia, those economies that really, really need those flows to operate. We really need to push more and better data in our invisible corridors while utilizing the insights that we are seeing from the better studied corridors to give us hints as to how we're doing on the more continental-wide reforms that we are going to hear a lot more about in the comment sessions, but that are, of course, dominating a lot of the debate. So the value of collecting and improving data is important because humans react to incentives. If we're all using the same sources of data, we may, back ourselves into a corner. And where do we get this data from? I think important are these household surveys, and they cost a lot of money, and they're very, specific, obviously, to the corridors. What are other data sources we can leverage? And I think Damola did a great job in showing if you have a regional approach to data collection from a regional economic community perspective, like SADC, who really emphasizes better data collection, you can start to understand average values better, remittance behavior better, and you can importantly measure progress of your reforms. And I think that's a little bit of what we're missing on the continent. We need to keep each other motivated in this reform process because it's taking decades and decades. The problems remain the same, but we are making progress, and we are seeing it in some of this data. Digital behavior is increasing. Obviously, COVID helped, but people before we said, nobody understands the digital, and so we are seeing especially younger people adopting digital measures more. Even the recipients are actually interacting more on the digital platform. So we are seeing that shift, and if you can't quantify that and you can't show policymakers, researchers, the private sector the progress in the various corridors, I think you're going to have a hard time to really see the structural reforms through. Humans respond to incentives. You need to show the progress that has been made, and so the big advocate, or the big takeaway for me is more data, more nuanced data. Who has that data? Private sector players. Obviously, we need the demand-side surveys, but private sector players, they sit on gold mines, and you as regulators or the policymakers as well, the collaboration on those insights, taking that to a policy and reform level, is going to make the private sector also feel like they're involved in the conversation. And I think for the G20 transparency, cost, access, speed indicators that we want to measure over time, I think in Sub-Saharan Africa, we need to be careful on how we set the baseline, because we are using, only a selection of countries to put these cost estimates, et cetera, together. So it needs to be expanded to really make all corridors on the continent visible. Why? The migration story is super interesting. I think 2/3 of migrants in Sub-Saharan Africa stay within the continent. Only 1/3 goes to outside the continent. And we know very little about the 2/3 within the continent, which have much smaller transaction sizes, as we saw in Damola's presentation, compared to the $200 or over $300 we're seeing, in the corridors now in the study that Oya also presented. So our backgrounds are different, smaller transaction sizes. We have a lot more spontaneous migration or a cyclical migration as well, and so value of data can't be overemphasized, and I think there is a role to play for the payments infrastructure we are building. So obviously that's a source of information. Regulatory supervisory processes, so licensed cross-border payment service providers need to report on a usually monthly basis back to the central banks or the supervisors. How can you improve those templates or requirements to get more granular insights to also measure behavior over time? Another point we heard from Silas is around the licensing frameworks, which is a big, well-studied, I want to say, topic, and the reason has already been mentioned in actually the start of this conference today. Sub-Saharan Africa is mobile first. We are seeing the improvement that mobile money has brought. Again, I'm generalizing now, not in every corridor, not in South Africa, for example, but in general, on a high-level basis, Sub-Saharan Africa is mobile first, meaning that the mobile money operators have been able, on a domestic level, to really drive a lot of the financial inclusion gains, and that is not reflected in the cross-border environment. Mobile money operators or mobile money providers, and this is not only the non-mobile network operator-led companies, the licensing frameworks for sending remittances out of country is very limited to banks. So licensing frameworks, I think, is a big discussion that we are not yet seeing a lot or as much progress on in the cross-border space as the domestic space. And it really limits the ability of mobile money operators to fill that gap we want to see in the lower value transactions across borders. And so the approach is, if I'm a fintech, and I will put mobile money operators into the fintech category, and my only way to do cross-border payments is through a sponsor relationship or through a partnership with a bank, I will invest that time into the partnership, I will make it work, but it may be a investment that I will lose over time, because now we are merging to the more open loop networks. You, as a regulator, want me actually to be in your network. You want to access my access points, my agents, my kiosks, my branches, to reach more people in a country. So, the point is, what is my incentive to join a national payment system if I already have access to all the services I need through a bilateral partnership? And I think when we started the day-to-day, we saw how unscalable bilateral partnerships are. And what we're seeing on the continent right now is bilateral partnerships are increasing rapidly. We're seeing great partnerships popping up all across the region because we don't have a regional platform yet that can really combine a lot of these players to build one big network. And again, where is the incentive? What is my incentive as a provider to choose the interoperability route if I've already invested in a lot of my partnerships? And I think, again, competition issues come in, etc. You asked to provide the rails, a platform, and I think Oya also mentioned this. And these access to rails is, again, something we should really debate, because we are seeing regional payment systems pop up on the continent. A lot of work, many decades of work have gone into that. Uptake is low. Why is that? Where are the incentives? What is our public partnership model looking like? Is it feasible to build a continent-wide payment system that consists of 54 supervisors and regulators? Probably unrealistic, but the point is, what can we push at continental level? And this is where the standards come in. You talked about proportional KYC. You know, there is so much barriers. I mean, we heard it the whole day, I'm not gonna repeat it, but the need for proportional KYC to really understand the risk the consumer poses instead of, the compliance risk that the payment service provider is measuring. Those kind of standards at a continental level that can then be taken into the regional conversations and then ultimately in the domestic environment, that is where we can really hope for harmonization in the regulatory sphere. And that also includes the licensing framework. So licensing frameworks, eKYC, those are all standards that we could look at on a regional perspective to reduce the barriers that are common across the corridors. The user experience, we heard, makes a big difference. If I know, I may be technically savvy, but I may not know this particular app. What has worked in other contexts is to have one unified brand approach, even the regulator dictating in a USSD menu where a certain payment solution should appear. So you have a unified, more unified user experience, and that people are less scared to try these digital solutions. And the other thing here is, of course, recourse, which we haven't necessarily touched on. The flip side of trust is recourse. What happens if I lose my money? Where can I go? And the real, I guess, gravitational force of informal mechanisms is the human relationship that a lot of the migrants have with, these very targeted service providers. And we're hearing that, they just provide better customer service. And we also did a study with Pay Inc. a couple of years ago on informal remittance providers from South Africa to Mozambique, to Zimbabwe. And we talked to a lady, and she was like, well, why should I use a formal channel if my person that I've been using for 10 years, he comes to my house. I give him either the envelope, so I don't have to travel anyway. He comes to my house. I know his family in, the village in Zimbabwe, and if something goes wrong, I will find him. Our families know each other. And the interesting thing in the Zim corridor is actually people don't necessarily want money, they want goods. So on top of giving him my cash, I will also give him, these 3 chairs that I need, that my family needs back home. How can the remittance service providers compete with something like that? You do need value-added services, because the idea is you shouldn't make the bulk of your money on transfer fees, because we want to reduce the cost. We do need a market-led approach. We do need providers. So what are these remittance-linked value-added services, like insurance, for example, that can be created as an income stream for the provider, while also, obviously, most importantly, adding value to the recipient. But the lack of digital ecosystem that Oya also mentioned in the end is where the buck stops, right? Even if I wanted to use digital channels, I can't use my digital value and spend it. Let's say in Ethiopia, yet I do need to cash out. And there's some incentives around business models for agents for cash out. So the one-way street that you're pushing people into by not increasing the uses for digital value, for example, by being able to pay for my bills, school supplies, I should be able to do everything with my digital value. Do I need instant digital transfer? Maybe not for all use cases, but the point is if I can't live my life digitally, of course I have an incentive to cash out. And so this is where the domestic payment infrastructure becomes so important, which brings us back to the point I think in a previous session, you can't really decouple domestic from cross-border, and especially for most African countries, remittances are a key use case that provides consistent flows for a platform to generate the necessary transaction scale to reduce the costs over time. So really, I take the points, and I can reiterate the points from my own work, collect better data, incentivize and measure, or be careful, not be careful, be deliberate of what you're measuring and how you're going to show progress to all the ecosystem actors, so including you as regulators and policymakers. Value-added services, so we can get away from the P2P transfer being the main generating income machine. Proportionality in licensing and eKYC frameworks, and then last but not least, having the continuous conversation and platforms, forums, to improve basically the collaboration between the public and private sector actors who are meant to create this digital ecosystem together. So I really want to thank both presenters for the valuable papers. I think it's always great to see how different ways of triangulating data can produce results. I was very interested to see the negative relationship between increased migration stock and the reduction in remittances. So I am interested in whether that's just a formal remittances decrease or whether that includes estimation for informal flows. But I think it's great work to build on and shows a path on how we can really identify a more nuanced approach to Sub-Saharan African remittances benefits. So with that, I will hand over to Maxine. Thank you very much and see you at lunch.
Take a seat, maybe there's a question. All right, thank you very much for that. I think there are a lot of takeaways from this session. The key things I heard, data is missing, and maybe some of the decisions that we're making with a lack of data. Licensing, standards, incentives, eKYC. I think there's a lot of work. I think I will take one question or two if the audience has, but I am interested though, Silas, you want to remove some barriers, and I see some of your recommendations. It's a wonder that the regulators are still sitting. By now they should be frowning at what you are recommending in your paper.
In our view, for everything, I think the best approach is a risk-based approach, but you'd find that these barriers, they are from the back end and the front end. And from the back end, companies that have got international remittance firms are already fighting. So you'd find they will need to register in one country in South Africa, go to Botswana, register, go to Zambia, register. There isn't really like a coordinated regulatory requirements between these countries. I don't know about EU, but I would love to think that there's a coordinated certain level of standard in terms of regulatory requirements. This is on the back end alone. TED framework, which we hope in terms of coming with a standing within the formal to the informal side.
Okay, thank you. So regulators, you've heard relaxation of barriers to cross-border payments. You know, it's very important to assign, you've got some recommendations, but you must always assign who is going to do something. You talk about invest in digital financial literacy programs. Who's supposed to do that? You know, if you don't assign, you won't get the work done.
No, I know. My key takeaways were key takeaways and not necessarily recommendations, so I could run away with not assigning people to each one. But anyhow, so I think you are touching upon a very good point because first of all, digital financial literacy is extremely important in the current day and age where, for example, fraud is on the rise. And we are expecting people from all sorts of backgrounds to be able to be digitally savvy so that they can actually use all these fancy financial services that we're talking about. But at the same time, of course, we need to make sure that they are actually able to do so. And that's where digital financial services come into play. Now, who is going to do that? Who's going to do digital financial literacy activities? Essentially, I think it needs to be a collaborative effort, public-private. It is in the interest of all of us to ensure that people are able to properly use what they have. And also people are able to actually start using what they currently do not use, right? In that sense, also another point to consider is financial literacy, financial education efforts have traditionally been extremely, extremely time demanding, extremely costly, and you really need to do repeated interactions so that you could build habits, you could actually teach, and it's not easy. It has to also come in various forms. You have to think about doing a national awareness campaign, and then maybe some targeted efforts to specific segments. Some segments will need more hand-holding, some will need only one time showing them how to use. So it is a very big effort, and it doesn't seem realistic as to say that this is the job of a central bank, or this is the job of the private sector, or this is the job of the Ministry of Finance, or whatever. I think it needs to be a broad effort. Of course, there are certain elements within a digital financial literacy program that it could be better delivered by the private sector, that could be better delivered by the Ministry of Finance, that could be better delivered by the central bank or the NGOs, right? So I think it's a very good question, but it has to be. So the answer is there's not one stakeholder for that.
Okay, thank you. I know I'm standing between you and us and lunch, but maybe one question. Yes, sir. Can we get a mic there? Okay. Here and then over to Damola.
Thank you. So the first question is for Silas. Your presentation is around migration and how that influences remittances. So in my mind, remittances is a transfer of value, essentially speaking. And for you to transfer value, you need to have value to store, which means you've earned some money. So essentially, migration is perhaps a couple of degrees of freedom removed from the actual act of remitting. How do you control for that in your model? That's the first question for you. And then for Oya, your explanatory variables included access to financial services. And just considering the fact that there might be dormancy and issues around usage dynamics, how do you address that in the model? Because access doesn't necessarily imply usage, which might then influence the model specification. I also thought to ask to what extent do you maybe think about the residency status of the senders as far as what they might access to send money across the different channels? And then the final one is really around the manner in which you think about the senders and the receivers. So do we think of this as one general equilibrium, or are they subject to the same bounded constraints? And I'm asking this question because when you look at the frequencies of the different channels that people either send or receive from, they don't match. So are we supposed to think of them as one single model, or we should be thinking of them as mutually exclusive? Thank you.
You can tell, I call him professor and he objects, but there we go. Can I ask Kagiso to ask a question, then we wrap it up. Kagiso, your question?
Thank you. Mine is going to be simple because I don't want to stand between everyone and lunch. So I think it's more to Antonia and is it Damola? No, it's not the gentleman.
Silas.
Sarah, sorry. Yeah, so mine is quite simple. I just want to find out from you, obviously, you might be aware that there is a strong initiative that is happening within these buildings. It's called Payment Ecosystem Modernization. And within that program, there is obviously cross-border plays a major role, but digital financial identity is more important as well, especially considering that we're talking about 90% of 4 million which are illegal migrants. How do we bring in digital financial identity to make sure that we have seamless cross-border payments? And also maybe to you, Antonia, from open finance point of view, how can that be used? Thank you.
The last question.
So talking about how can open finance be utilized, because I know that you guys play a major role in that space. How can we use open finance for seamless cross-border payments? Thank you.
Okay, Silas.
I think I'll start with the last one. I didn't quite hear it clearly, but I think I'll answer in line with how can we then come up with seamless cross-border payments, right? In terms of removing the barriers.
Okay, that's not clear.
Yeah.
Can we tackle maybe the next question?
So maybe if it's clear according to what I've heard. So what I think personally, I think we need to have like a coordinated framework in terms of licensing of international remittance firms. Like I explained, there's the back end part, there's a front end part, and also to partly answer my brother there, I think he did also ask a question around can we classify the same, the receivers and the senders? So there's the back-end part whereby international remittance firms are supposed to be registered with different regulators in their jurisdiction, and the front-end part whereby agents are supposed to pay out. In terms of regulatory requirement, you'd find that within the Sub-Saharan Africa, it's quite different. You move to Zimbabwe, you want to pick up your cash, maybe an ID is only required. You move to South Africa, you want to pick up your cash, maybe your ID plus proof of residence might be required. You move to Lesotho, so forth, so forth. So our recommendation there is that there's need for a coordinated regulatory frameworks. We know there are also other regulatory bodies, which I think the Committee on Payments and Market Infrastructure can also foster in terms of helping nations coming up with a sort of a standardized framework in terms of what is required in KYC, what is required in licensing. I don't know if I've answered that quite well.
Okay, I'm going to have to stop the discussion because I'm advised we're eating into lunch. Could I request that, Damola, you had some questions, and Kagiso, Silas is here, I think, the whole day and tomorrow. Same with, are you around, Antonia? Yeah, okay, cool. We'll just miss you, Oya, online. Ladies and gentlemen, thank you very much for your attention. You have to be back here at 1:30. So eat very quickly and be back. I think that's the idea, right, Maggie? Maybe. Thank you. Thank you very much. They must find you, Antonio.
Welcome back, colleagues. I'm hoping that you have been re-energized as we are moving into the afternoon session. And there's a couple of sessions that we have lined up, and I think your attention will be greatly appreciated, as well as your inquisitive reflections and questions. So we've had 2 research sessions up to now. And for the first time today, we are moving into a policy panel session, which aims to discuss how to unlock cross-border payments in Sub-Saharan Africa, and will be moderated by none other than my boss, Arif Ismail. Arif, over to you.
Thanks very much, Mavis. I'm really looking forward to this panel, and on a light-hearted note, I have to start by saying, and I really mean it on a light-hearted note, Eugenio, and those who presented regressions. My tagline for this session, Gita, is from regressions to practical progression. So let me call up all my panelists, and they've been hand-selected for you because, in inverted commas, they are provocateurs, all right? So without further ado, I want to call up my cousin, Arthur Cousins. Okay, Arthur has so much of experience in this industry, he doesn't need any introduction, but he certainly has provocative thoughts. And Richard, without a shadow of doubt, we're going to put Arthur on the spot to make sure he shares, as usual, his honest views on things. I also want to welcome my sister from Namibia, Barbara. She's also a provocateur, Director for Payments, and of course, co-partner on the Payment System Subcommittee, Barbara. And then, of course, who needs no introduction, but is certainly a hot wire, Gita Erling, who is the CEO of PASA. I'm very delighted that we have Dr. Chioma Nwosu online with us, and I'm told, Mashlate, that we have Dr. Chioma with us already. Deputy Director from the Central Bank of Nigeria, has published and led research on a variety of topics, including monetary policy, financial stability, financial inclusion, and of course, digital payments. And then, of course, we had to bring in someone with an international flavor, but with a local rooting. And I want to welcome Dale Connacht on the panel. Dale has been a dear friend. He is certainly one who understands risks in FMIs very deeply, especially from the securities market. But Dale has transitioned to the IMF and is now our resident, what they call long-term expert in this domain. So I want to start off, I've just got about 5 questions. And the way that I'd like to do it is to ask a provocative question and then to go around the panel and get your thoughts. So let me start off with the first question. Are we being ambitious enough? What are your actionable suggestions, Arthur, okay, or insights to accelerate this darn cross-border payments in Sub-Saharan Africa?
So, would you like me to go through my crib notes? No?
Whatever,
okay.
Arthur. Crib notes, wing it, we're quite open.
So you'll hear from my accent, I'm not a migrant. And you can see from the lack of hair and the greyness, I've been involved in this industry for many, many years. And that's an AI version of me up there by the looks of things. All right, so we were asked to, just broaden in your question, how to unlock cross-border payments in Sub-Saharan Africa, and how to address the problems and the challenges, and then explore the role of public-private sector cooperation, plus the supporting policy framework, as well as regional collaboration. So there's the 2 bottles of water, and the one is the challenges and problems. I don't want to elaborate on that because you've had some outstanding presentations, in-depth analysis, And all of you here, I believe, know what the problems are. And they were succinctly put into the spotlight by a recent paper produced by the FSB, Financial Stability Board. And I'm not sure any of you have read it yet, but they have hidden in the script, they reckon, these include, inter alia, misaligned anti-money laundering, AML, encountering the finance of CFT compliance controls and privacy rules, inefficient implementation of capital controls, limited transparency for end users, interoperability challenges, which we've heard this morning, and insufficient competition in certain markets. And then I found a further paragraph where they say, for example, analysis of cross-border payment corridor for remittances in Sub-Saharan Africa, the region with the highest costs, that's us, highlighted that high costs seem to be driven by heavy reliance on US dollar cash, weak competition as well, and lack of direct access to payment systems by non-banks, payment service providers. So it's your fault in that one. And burgeoning, where's Brad Gillis? He's somewhere. Burgeoning, Brad, reporting requirements. Okay, that makes you go. All right, so I want to look at the opportunities side of things. And I believe we as a wider region of Africa, we have the following as the basis of capturing these opportunities. One, the political structures. We have the African Union, AU. We also have the African Continental Free Trade Agreement. We have the African Development Bank for financing. And here's one I believe that is absolutely important for the work we need to do as industry. It's the Association of African Central Banks, who the members are headed up by the governors of all the central banks on the continent, barring one country that I'm aware of. And now we have wonderful support from the FSB, the Bank for International Settlements, and through them, the CPMI, the World Bank, and the IMF. So we've got this huge supporters club in the stands helping us along there. We have a number of operational systems in the various economic regions today. And we have a very entrepreneurial private sector. And then we heard about these new technologies, they're available, and it's how they are embraced. So, in coming to this session, you heard from my colleague over there, Antonia. We put pen to paper, and next to is colleague Barry. We put pen to paper, and we thought we would try and articulate what should be done. And this is now basically a call for action. We have all these wonderful conferences. We've got all the data. Well, no, we haven't. You heard today we haven't got all the data. But until we now sit down and do something about this, we're just going to continue discussing. So we need now an abundance of cooperation and collaboration. And when it comes to cooperation and collaboration, some things have to be given and some things have to be taken. And we've got to do this in an adult way. So we've suggested 3 pillars. A regulatory pillar, because we heard about we need to harmonize the regulatory aspects of the wider cross-border payments on the continent. A lot of good work has been done in West Africa, Central Africa, and recently in East Africa. Tons of work has been done in the SADC region, but now we need to do something for, to me it should be the continent, but let's start with Sub-Saharan Africa. It's a fair portion to put our teeth into. which should be central bank owned, so that we settle in central bank money. And people in the securities world would like that. The securities then get settled in central bank money. And all of our obligations in the clearing of both high value and low value should be cleared on this platform. And here's where we've got to give and take. This platform should allow for settlement accounts for all participants. Okay, all participants. Now, some participants may only want the accounts for interbank transactions, government security settlements, and that sort of thing. Others may want it for retail settlements. And others may be unrestricted and use it for both high value and low value. But all parties should have this ability. And that would streamline the settlement leg for all the clearing that we will then want to do in the next part of the drive. And that part of the, and then that framework and that platform can consider using and developing a digital, central bank digital currency, which could possibly replace the usage of the dollar to some extent and be the currency of reference for all intra-African payments.
Arthur, can I stop you for a second?
No.
No, sure. Can I stop you for a second? You've given us such a rich set of thoughts. I want to bring in the other voices. You sound like a central banker, Arthur.
I've been working with him for so long now.
You sound like a central banker because you say, the way to solve for this. And my starting question, Gita, was, are we ambitious enough? And what are the actionable suggestions? And Arthur's response to this is, be a central banker. I'm being provocative. Be a central banker. Make sure that the settlement infrastructure is sound. Make sure that the regulatory frameworks are sound. Make sure there's legal harmonization.
So we say regulatory harmonization, but what that actually translates to from a human being has to touch it. And we don't have a rail problem. There are plenty of payments rails that can do things real time, can do them 24/7, 365, can do them safely, cheaply, and efficiently. We have a problem with the things around the rail. A retail payments person, that interoperability in my world means on all cards. If you're part of the scheme, you will process the transaction. I think a big chunk of the problem we sit with in the cross-border payments environment, and this applies in a number of different contexts, correspondent banking as well as our regional schemes, is that I don't have to accept the incoming payment, and that's driven by a risk process. Do I have an RMA in place? Have I put the other counterparty through a risk evaluation? And if I haven't, am I going to transact with them? So even within individual rails or schemes, my understanding, and I look at the faces in the room, is that we don't have full interoperability across all of them. So no human being touching it, full interoperability, and then the issue with the proliferation of rails.
And I want to stay with you before I go to Chioma and then back to Barbara. You talked about making sure that there are things that happen around the rails.
Yeah.
Can you just say a few more things on that, Gita?
So let's give an example. I've been caught in conversations between our members and regulators about, have we made payments in our immediate region straight through processing? And yes, we've harmonized BOP codes and reporting, and I don't understand all the technical detail, but we haven't operationalized it to the point that everybody understands exactly what must happen in which field, and then we get data issues, then a human being has to intervene, and then we inflate the costs again. So there's some very practical, small things we can do, and I liked your talk about a rule book, Arthur, because I think we've got to get to a whole new level of detail to say, what does interoperability, straight through processing interoperability, truly mean in any one of our given schemes? And developing new payment rails, and here I am going to be a bit provocative, for me is not the answer. There are regulator-driven payment rails. There are a whole bunch of private sector ones coming along. When it comes to the private sector, stablecoin, cross-border, business to business, I don't think regulators even have a chance of having a view of what's happening in that context. So we don't have full visibility of what the space looks like, but there are competitors to the central infrastructures. And that means the central infrastructures have to be compelling in their competition, and that talks to very detailed, very precise regulatory harmonization.
Fantastic. I'm sure you all want to come in. I'm almost tempted to go back to Arthur and ask, what does straight-through processing really mean? But I'll come back to that. Let me turn to Dr. Chioma, who's online. Chioma, please come in. Tell us your perspective on this. And again, in the spirit of being practical, what are the kind of suggestions that you want to put on the table? Thank you.
Okay, thank you. I will start with looking at some of the, agreeing with partly what Gita said, and looking at the different issues that we already have in the payment system. Yes, we have made, in Africa, we have made a whole lot of progress in the payment system and in cross-border payment, rather. And but then we also know that because we have different currencies across the different countries in Sub-Saharan Africa, there are some issues. And no wonder you see a whole lot of trade being carried out using the US dollar, which in some way we feel that, okay, it's kind of harmonizing. But then there are ways also out of it, because take, for instance, what the Pan-African payment and settlement system is already doing in West Africa and in some other regions in Africa, that's already has embraced about up to 16 countries are already using it, is helping in cross-border payments. And also look at if we can also kind of harmonize our regulations, payment, cross-border payment regulations, that will go a long way in helping. And the truth of it is that we have a lot of opportunities. I mean, we can leverage the existing regional payments that we already have, and then we can also look at interoperability initiatives like what the BIS has in implementing their Project Nexus. So if we can look at that, that will help us. Also, the issue, like the first panelist mentioned, the issue of having the central bank digital currency and possibly a stable coin that will help, trade between the countries in Africa. I believe that will go a long way. Thank you.
Thank you very much. You've pointed to three key things. And Barbara, I'm going to come to you. It's harmonization of regulations, which Arthur started off with. Very similar to Gita in some ways, Chioma, saying, that there are rails that exist. We must leverage them. Like you mentioned, regional financial infrastructure. But you also talked about interlinking, and using the BIS example of Nexus. But I was going to leave this as the last question. What about CBDC and stablecoins? And it goes back to the points that have been made by Arthur in particular around think about governance, think about rules, think about regulatory frameworks. And then you put down something like CBDC and stablecoins. Barbara, I turn to you wherever you want to go with this conversation. Thank you.
Thank you very much, Arif, and good afternoon, colleagues. I think a number of the things were somehow highlighted already, but just to circle back to the whole straight-through processing conversation that Arthur introduced earlier, I want to just quickly pick up on that one and just quickly tell a story there in terms of how we were we just recently implemented the ISO 20022, and we were trying to see, okay, how can we leverage off this? Because we are told that it is, it can do so much. But there is a lot of education that needs to go through, particularly with the various regulations, regulators and so on. So we took that standard and we took our financial intelligence regulators, our FinServ regulators, and the payments regulators and the operator. And we said, let's look at your requirements, my requirements, your requirements. What do we bring into here? We bring in the industry so that we can sit around the table and see how do we achieve straight-through processing using this standard. And I have to tell you, I was amazed by the collaboration that happened there. There was even an instance where one of the participants could say, let's quickly, before we put it in the guideline, let's quickly test it. That's the kind of agility that you would want, not that for me is solutions-orientated action. Kita, you talk of action-oriented, but sometimes when you sit in the room between private sector and public sector, I'm not controversial or provocative, but all that you hear are problems. Oh, this cannot work, that cannot work. And sometimes the public sector, therefore, then sometimes step in to say, you talk about all of these different rails. Why do the public sector sometimes step in? Because you just hear, okay, if you do this and that and so on. So you try and see, okay, how do we get things forward? So if you have that kind of agility that I have just seen, then really we can make a lot of progress when it comes to cross-border. And we will probably be signing off on our domestic STP guidelines next week. And that for me is really something that I feel if we can emulate some of these at a cross-border level, then we will really take it a step further. Someone recently at the IMF annual meetings, his name was, I think, Jeremy Ale. He made a striking remark and he said, you know, in 5 years' time, the concept of cross-border payments will sound probably like a cross-border email. Think about that. When last did you send any cross-border emails? So it's instantaneous, seamless, and probably even ubiquitous. So, but just given the sheer challenges that we sometimes sit with and that was so well articulated today, it might perhaps take us slightly longer than 5 years to get there, but I think there is sufficient agility in some circles and there is definitely commitment. And with the collaboration between private sector and public sector, I do think we can make things work. And given some of the projects that we have taken it to a CMA level, for example, that we will be embarking on soon, and actually already have embarked on based off on certain regulatory guidelines that were issued within the region, we really hope that we can see that kind of agility where we will, yes, we need to differ, we need to thresh out things and so on, and that is fine, but we shouldn't get stuck in the mud with it. We really need to move forward with it. That is what I wanted to just highlight. And then where I would perhaps then just add something additional to your question, to your comment around CBDCs and where does that, I think we should leverage from, there's a lot of work that was done already. If I look at it from a regional perspective, and maybe I want to take it further down to the sub-region, we are seeing that there are innovation hubs that we have in the region currently, especially in SADC, that I am aware of. There are two, Mauritius and Namibia. So I think we should optimize those hubs to the extent where we could, for example, say, can we test CBDC in one of these hubs? Can it work for us from a cross-border perspective? And those would be some of the things that I think would be tangible actions that we can get insights from to see how best we can take this, this elephant bit by bit forward. Thank you.
Thank you. That was very rich, Barbara, as usual. There were two key things that you took out. The one is you're saying to us, hey man, roll up your sleeves, get to work, public and private sector. But to Arthur's point, you got to focus in on something, because rolling up your sleeves and getting to work, in your last comment is how do you eat the elephant? It's a lot of stuff that you got to go through. But what you're saying is, you're saying at a practical level, You know, you got to get the folks together, whether they're from financial integrity, financial surveillance, payments, and you got to roll up your sleeves and get to understanding the policy trade-offs. And then, you know, importantly, before you set the guidelines, you got to be able to test it and say, okay, you want this, I want that. They're competing objectives, but how do we make it work? And then you're also saying, and this is a commitment in the CMA, and you chair the CMA, and I'll get the term right, Tina, you're somewhere here, CPOC. All right. And under the CMA CPOC, Tim is also in the room when you know, one of Tim's, not absolutely last, but one of the last things that he inspired was saying in the CMA CPOC to the governors, we want, when we cannot resolve this at the governor level, Tim, we want, at the payment system level, we escalate to governors, and we've put that structure in place. So great, roll up your sleeves, let's get going, standardize, harmonize, fantastic. And then the second thing you're saying at a practical level is, we've talked enough about theoretical stuff around stable coins, the CBDC, etc. There are 2 hubs in the region. Let's leverage that practically and do some testing together. You know, and it's a nuance on Geeta's. The rails exist. Do we need new rails? And I want to come back to Geeta on that question. But before I come back, let me turn to Dale. Dale, you're now seeing this. You saw it from a South African perspective. You're now seeing it from a global perspective. And in fact, you lead us in the SADC and the African continent as an LTX. Are we being ambitious enough? It's a direct question.
Are we being ambitious enough? Let me start by saying our role from an IMF, World Bank, cross-border, technical assistance, processes, procedures. Obviously, our focus is on the authorities and helping them to identify and resolve obstacles. We do talk about looking at specific corridors. We look at national system diagnostics to say, how do we improve those? And that talks to modernizing payment infrastructure, updating regulatory frameworks, and supporting financial inclusion and helping with cybersecurity. All the big buzzwords we've seen around the table, and we've certainly heard a number of them this morning. So our TA tends to be country-owned, focused, and we do work extensively with the IMF, the World Bank, and even certain donors in the region. But I think the reality for me in answering your question is to recognize that every single payment corridor is different. We've already heard that this morning, and we've heard how many there are bilaterally across maybe bigger than just our region. So there's diversity. Users are different, some are including non-banking PSP structures in their environments, some don't. We've got rule differences, we've got channels, we've got rails, we've got risks which vary, and I can't not include the word risks there given my background. So I mean, our starting point is diagnostic. I think there are things we can ambitiously take on. There are cohorts within regions that are potentially prepared to move together, that are appropriately positioned to move together. But in fairness, there are other countries within the same region we're talking about now, in the Sub-Saharan African region, where they're on infancy of even implementing an RTGS system. They don't have the infrastructure, they don't have current legislative frameworks to work with, and those need to be built up. So are we being aggressive? Are we being optimistic? I don't believe so for certain channels. I think they're very, very achievable. But I think we also need to recognize that there are building blocks in certain spaces that need to be put in place. I will start, and Arthur and I were having a discussion over lunch, and maybe we vehemently agree about the end result. We may differ on how to get there, but I think there is this need, certainly from our perspective, is to start by making domestic payments easy, low-cost, inclusive, and safe. Now, that does mean that maybe there's an internal focus to some extent. And it talks to wide coverage. It talks to both urban and rural. I could cite you examples across the region where there are huge chunks of the population that do not have access to any form of payment system, whether it be mobile money or otherwise, because they are being excluded by lack of power, lack of internet capabilities and internet connectivity issues, and lack of education. We had a comment earlier today about whose role is it to educate. I can again cite examples for you of central banks that have gone out into the district to educate the population. And there are a couple of them probably in the room today that do that. Is it necessarily the central bank's job? Probably not. There are probably other players that could do it better, but it's being done because nobody else is doing it. So I think my takeaway really is to say, are we being optimistic? Are we being aggressive? Is to say, if domestic payments are simple and trusted, the cross-border bridge lands on a solid ground. And the G20 goals, lower cost, faster speed, wider access, better transparency, and all of that become more achievable. So some of these places are behind the curve. Some are on the curve and some are ahead of the curve. And we need to take all of those into account if we're looking for an SSA perspective.
Thanks, Dale. You planted two thoughts, and I'm going to come backwards from you down back to Arthur. The two thoughts that you planted is in some instances there's a lack of infrastructure. How do we deal with that? It's a very practical thing. One suggestion, and again I'll keep it general, is that there are folks within the Southern African development community, as well as broader, like in Europe, who are saying, well, we're willing to make the infrastructure available, the designs available, the rule books available. We're willing to do that in the spirit of being good citizens for the world, okay, at the most senior levels, right? The second thing you're saying, and I want to get responses from everyone, is clean up your own backyard before you do anything in the region. In other words, domestic payments, as Damola was saying this morning, matter. You can't think of it separate from cross-border. Barbara, would you agree with that?
Oh, 100%. I agree with that. And I think Dale couldn't have said it better. Because if our domestic payments are not up to scratch, it's very difficult to even think about cross-border. Where's the trust? Who is going to trust it? Because, and how are you going to participate in that? And that is why that is something that is really a critical starting point for us. And I think as we are having these conversations, it is a very real risk that some people or some countries might be left behind. And I want to take us back. Many might not have been around, many might have been around, but when we started out with the SADC RTGS, there was a deliberate effort to make sure that most of the SADC countries, at least you have at a basic level, there is some sort of functionality in place, so that nobody is left behind, at least not significantly. And I think those are, we've really done a lot of work that we can leverage off and learn from. And I think we should do the same, especially now that we are moving into faster payments and with all the innovations that are happening. We should not, we should be good corporate citizens also, and see how do we bring everybody on board so that nobody is left behind. There was earlier also the question around smaller countries versus the larger countries and data. And Antonia highlighted it quite well. And I know Namibia being a small country and being squashed between three larger countries, especially from a size, population size perspective, we sometimes have to talk louder than everybody to be heard. Just kidding. But it does play a role in terms of how we work together, therefore then also as Sub-Saharan Africa, to make sure that it is not just the larger economies or just not the larger voices that are heard, but that we're actually setting that enabling environment for everybody to meaningfully participate, because it does impact our citizens at the end of the day. Thank you.
Chirma, I'll come back to you. Gita, you've been nodding very much. I want to get your thoughts.
So I fully agree about the need for domestic payment systems, but I think this is an and conversation. So if we're going to want to, for example, stitch together domestic payment systems, you get back into a regulatory harmonization conversation. And I think we have to do both, as well as very pragmatic, what can we do to move frictions in the current environment? And I particularly liked your comments along those lines, Dale, about all of the peripheral elements and not necessarily the rails. I think as payment practitioners, we want to default to the latest sexy technology, exciting new payment rail. We have to be very pragmatic about the business cases in these contexts and the cost that they bring to the parties, which is why your point about collaboration is so critical, because the voice of the people who are actually going to be using these payment systems and who are going to be incurring the costs for these payment systems is absolutely critical, as well as the central infrastructure. So if there are 2 points I'd like to leave you with, it's those. It's the collaboration with the practitioners and the people who are going to incur the costs of rolling things out and have to take them to market. And it's the need for the regulatory harmonization in addition to the domestic systems as a starting point.
Fantastic, Geeta. Chioma, I'm going to turn to you. I mean, Geeta's point is it's an and. You've got to focus on domestic and you've got to focus on the cross-border harmonization and so on. Would you agree? And then I'm going to throw it into the mix. You guys have launched the e-Naira. You know, what's your perspective on building domestic, not forgetting about cross-border, and tell us something about CBDC and the e-Naira.
Okay, yes, we launched the e-Naira, which basically we used majorly for the time being for domestic settlement, even though we are looking at it being used maybe starting from the West African countries and then moving on to other countries in Africa. Yes, just like I mentioned earlier, you know, using something like e-Naira, which is a central bank digital currency that was launched by Nigeria. So far, we have not made so much progress in terms of integrating, because the part of the things that we had in mind is with the launch, have it, of course, you know, Nigeria is a predominantly cash-based, but with the launch of the e-Naira, that has reduced our cash dependence. But then the issue, the angle of now using it for cross-border payments, which in offhandness, because some countries within close to Nigeria, like the Benin Republic up to Ghana, or have embraced that, and because they also, you can do a kind of bilateral trade using the local the Naira in those countries. So for now, that's how much we have gone with e-Naira, but and which we are going back on drawing board presently to look at different things that we need to still do to be able to relaunch it in a bigger way. Thank you.
Thank you. Thank you very much. We're running out of time. Can you believe it? So let me turn to each of you. And Arthur, I'm going to start with you. I've messed up your crib notes.
Absolutely.
I really did. So let me start, Arthur. And I want to do a rapid fire to try and get the one practical thing, Arthur. Okay, from all your years of experience in grey hair, what's the one practical thing that you demand that we do?
Chapter one of what I said. You've got to put that framework in place, governance, regulation, and not additional rails, Geeta. I'm saying we use what we've got and we link them, but we standardize, we put all the agreements and all that around that. So I'm also with you. So let's get going is the one thing I'm saying.
Got you.
That's what we're going to do.
Got you, Arthur. And you're saying, we've got the infrastructure.
Yes.
We've got to put the governance and the
smart
rules.
people.
Absolutely. And you're saying focus in on that.
Get
That's
going.
what you're saying. Right.
Find the people and get building. Okay.
I like this, Arthur, because it's almost like, you know, we've talked enough. Action now speaks louder than words. Geeta, what's your one action? What's your one practicality?
We've talked enough, but ultimately the business case drives usage. And if we don't understand why people are going to use a given solution, then all the talking in the world's not going to help. And the only way we're going to get to that is by engaging with the people who actually take this to market. So fundamental to payments is the four-party model, and is everybody incentivized to play? And that question needs to be answered underneath all of these systems.
So in other words, Arthur, we get what you're saying. You've got to get going. We've got to interlink systems and so on. But it's a necessary condition, but not sufficient. What Geeta's saying is there's still an underlying business case and economic model that needs to be thought through quite carefully. Before I come to you, Barbara, would you agree with that?
So if we haven't done the business case modeling with all the data and all the stuff that we've heard and seen, then we've got a problem. Then we've got a problem, because then the G20 initiative, which highlights the speed and all of that, then we barking up the wrong tree. So I'm saying it's what they've uncovered by the people they have worked with, have spoken to, says we've got these problems and we've got to reduce this cost. So the business case is reduce the cost and let's get on with it.
Right.
Reduce the cost and let's get on with it.
Got you. Barbara, what's your one thing? And Chirma, I'll come back to you.
For me, the one critical thing is, and I will take it internally, us as regulators, there are structural things that are rail agnostic, system agnostic, that we have to do. So we need to pull up our socks, and we need to, it's not something we don't know. We know exactly what it is that we need to do. We need to just get in the room. And here, when I say regulators, I'm not just talking about the payments regulator, I'm talking about the financial surveillance regulators, I'm talking about the financial intelligence regulators, I'm talking about any regulator that plays within the payments ecosystem. We need to just do. We know what to do. If there is some education that needs to happen amongst ourselves, let's educate ourselves. But let us do the needful in order to remove some of the frictions, in order for the rails and the systems and the private sector and all of us to work together to make things work. Thank you.
Chair, we hear you. Regulators, come to the party, sort your matters out. Okay, we hear you. Dale, what's your one thing?
One takeaway. I think from all we've heard, proportionate rules. It's about understanding we've got variations in the market. Small retail users, larger corporates, governments, etc., etc. Proportional rules, open participation, and clear prices. All of these move access and affordability together. And then interoperability is as much about shared rules as it is about the technology platforms we're talking about.
Got you. Right, fantastic. Chioma, you have the last word, and then we probably can take one or two quick questions with the permission of the panel from the audience. Chioma, your one thing.
All right, mine will have to do with the issue of building confidence in Sub-Saharan Africa. And when I say that, what will help us to do that is by aligning our AML, CFT, and the KYC standard. You know, I kept talking about the issue of harmonizing. We need to harmonize and then build confidence. That will go a long way for us. Thank you.
Thank you very much. This has been a fantastic panel. But because I threw Arthur off, Nomolazi, I'm going to come back to him with one more question. All right. A nasty one. We talked about interconnecting systems. Do you think we could have potentially a silver bullet across Africa? And I'm keeping it general. What's your thoughts?
So there is an entity that's trying to do that. And I think they are facing a number of challenges and will continue to face a number of challenges. But I think if that organization and that entity that's trying to have a pan-African payment infrastructure would come along with us on the journey, they would benefit from three things. If we have the appropriate oversight and regulation sorted out, Barbara, and we have the settlement infrastructure sorted out, not in a row, they would benefit from that settlement infrastructure as well. And the third thing, if we stick with all the rails we've got and we interoperate, they can interoperate with what's already in place. They can benefit from that as well.
Very clear. So return to fundamentals. That's the key question. It's time for you to ask a question or two. I see two hands. I'm going to go with them. So Angeline, the lady in the middle. Yeah. I'd also encourage us to keep it really short, and then our responses would equally be really short. Thank you.
Thank you. I agree with Gita that I don't think there is a problem with technology, rails, or processes that are facilitating cross-border money transfers. From the conversations today, we also know that there's a lot of people that are moving money using cash, but there appears to be a fear-based processing rule for cross-border money transfers. And that's steeped in money laundering, terrorist financing, and concerns about sanctions. So the question is there not a completely alternative process to accept payments, regardless of knowing the person, and going through an incremental improvement process of knowing that person? And what the regulators then get from those participants is monitoring, reporting, and then responding to reports that appear to be behaving incorrectly that can be adjusted and stopped.
Thank you. So almost a tiered regime. And that's your question. Shouldn't there be a tiered regime, if I understand it correctly? Angeline, you have the last question, and then we'll get really, really rapid reactions from the panel. Thank you.
Okay, so mine is a bit of an analogy. So when we build a highway, we build a highway for the traffic that's currently there. How are we ensuring that by the time we get to 2030, we've already got a problem that we're not going to make our targets, etc., that we're not building for the targets that we've set previously to reach? And how do we make sure that we build for the future, when not for 2030, not for 2035, but sufficiently that we're not sitting here again in 5 or 10 years having the same conversation?
Nice question. Can I get really 10-second responses from anyone? Gita?
Just on the tech one, I really think in today's world it should never be a question that we're going to run out of processing capacity on tech. Whether the tech we're building is kind of future-proof enough, the world's changing so fast, who knows? We've got to build architectures that are fit for process, that are potentially flexible enough to deal with different forms of money, because I think we have to bear that in mind, and are robust enough to deal with whatever volumes we throw at them. So some level of, they need to be relatively easy to configure without breaking everything. So I'm much more worried about the regulatory than the tech piece. The tech piece is usually the easy bit, so not minimizing what anybody does. But I think the challenge we're talking about here is not about underlying systems.
Excellent. And on the first excellent question, does anyone want to come in, Chioma or Barbara? I'm sorry for putting you on the spot. Arthur says you guys must handle the question. So if I understood the question correctly, there's almost a fear-based mechanism on the regulatory regime. Should we not tier it? In other words, if you're doing very low-value transactions, the regulatory regime should not require my dog's DNA. It should be tiered. And would you agree with that? I hope I've captured the question correctly.
Okay.
Yeah.
I don't want to speak on behalf of the financial intelligence regulators, but I do think, just looking at some of the work that the FATF has done of late, particularly in regards to payments efficiency vis-a-vis payments integrity, some of the input that was asked even around Reg 16, I think it is, it's really to try and see how best those efficiencies can be, or integrity can be maintained, yet you can still have an efficient process. And I do think there is a risk-based process. It potentially is how we as jurisdictions internalize those risk-based processes from an application point of view. And that is probably what we need to discuss and see, because I do think that there is scope within the standards and within the recommendations for us to do that. Thank you.
Thank you very much. With that, please give the panel, including Choma, a round of applause. Thank you very much.
Ladies and gentlemen, I think let's just give this panel another round of applause for such a fiery discussion. I couldn't keep up with all the WhatsApps of all the messages of what an interesting panel and conversation. So to the organizing team who put together this team, well done. All right, so I don't know how we're going to top that, but we will try. We will try, right, my moderator, wink. So we are moving into a research session once again, which is the third research session, and it will focus on drivers of cross-border payments in the region, and it will be moderated by Bongi Kunene, who is the Managing Director for the Banking Association of South Africa. Please help me welcome Bongi on the floor.
Good afternoon, ladies and gentlemen. There is no topping what has just happened. I'm not putting low expectations. I'm taking from the words that were used here. I had one word which stuck with me was ambition. So the size of this panel's ambition is going to be tailor-made. So having given you that as a heads up, I would like to bring to the podium Ngoni Chiranga. I think you can go further out. Yeah. And Ngoni has an impressive resume, which I'm not going to do justice to, because if I focus on that, we may miss what he's going to give to us. So, a few words about you. Ngoni is an experienced academic with 20 years of lecturing and research experience across Zimbabwe, Botswana, and South Africa. He holds a PhD in economics from Northwest University. He's done a lot of research. The research that we're talking about today focuses on international trade, financial stability, climate change, and SMEs. He is currently the academic manager at TUT, that is Tshwane University of Technology, in their Polokwane campus. Ngoni, there are more people on the panel, so don't shoot. I would like to call on Stephen Ambore. Please come. Okay, let me talk about Stephen while he's coming down. Oh, he is online. I thought he's in the World Bank based here. My apologies, Stephen. I'm taking you to South Africa. Meanwhile, we are elsewhere. So Stephen is a policy director for Africa at the Women's World Banking, and he drives initiatives to advance women's financial inclusion and economic empowerment. He has over 20 years' experience and expertise in financial inclusion, digital financial services, and he has held leadership roles at the Central Bank of Nigeria, and he has contributed to national and international financial inclusion policies. Then I would go to my last panelist, invite Dr. Gamadibe. Is he in the room? please. Come up while I talk about you. Thank you. So Dr. Kamadibe is an economist at the research department for the Central Bank of West African States, BCEAO. His research focuses on macroeconomic policies, trade policies, financial policies, and macroprudential policies, which are implemented in the countries of this West African Economic and Monetary Union. In 2018, he received the Abdoulaye Fadiga Prize, which is awarded by the Central Bank of West African States for the promotion of economic research in WAEMU countries. He holds a PhD in economics from the University of Lomé in Togo. Ladies and gentlemen, please, let's welcome the panel. The panelists have prepared remarks which they're going to lead with before I start engaging with questions. Just to give you a heads up, I know you've got the remarks and you've got time, but what I want to give you the flavor of, given that you are research economists and I am an administrator working with banks, I'm going to be asking you very bank-specific questions in your fields so that I bring it a little bit down to everybody, to my level, and we will have this engagement. So I'll start with you, and if you can just proceed with your prepared remarks. Thank you very much.
Good afternoon. If you look at cross-border payments, it's a relatively understudied area given the unavailability of data. As such, when you look at the paper that we wrote, we utilize a crude index that emanates from formal trade. Trade flows, which are relatively available, we get them from World Bank, YDI data. So we use SADC countries that border South Africa, because naturally countries that border South Africa enjoy more trade flows. So 60% of trade within the SADC region actually comes from South Africa. So naturally, more trade is available within South African borders, which actually agrees to the quantitative method that we're going to utilize, which is the gravity model, which looks at more trade happens to countries that are closer to each other. So as such, you find that South Africa tends to trade more with Zimbabwe, trades more with Botswana, and also it trades more with those bordering countries. So ideally, we are looking at imports from SADC from a perspective that this is a trade flow. So when imports are coming into South Africa, they follow, the payments are either formal or informal. So now, the data that we have is actually, okay. Okay. So the data that we have is actually formal, but for us to get the informal aspect, we have to now come up with an index where we say an index is actually that have also used content analysis from Southeast Asia. Some other studies have actually used from a quantitative perspective. This is what we know. And also you have systematic literature which has focused on cross-border payments. But what is missing, which is the gap that we aim to fill, is a study that focuses on an emerging economy that is from the SADC region, or also a study that uses the gravity model, which has been held as a proven method in modeling bilateral trade flows by a number of authors. Then these are the research questions that we want to look at. What are the factors that influence informal cross-border trade, and also the contribution? Then how do we solve the problem? We use the gravity model, style-side economic facts, and also content analysis. So those are the research questions. So just an overview, to get an overview of the payment system in the SADC region, focusing on those countries that are bordering South Africa, you may find that most countries, they've got e-commerce related legislation and cybersecurity, and also the law exists. But if you look at Eswatini and also Namibia, it's still in draft, and at times it doesn't exist. So that's a summary of simplified facts. So if you look at the countries that we have, we are basically looking at Zimbabwe, South Africa, Namibia. So countries that have a population which is less than 5 million, you may want to check what is the relationship, perhaps, with contribution to GDP and also internet penetration. So you may find that in South Africa, internet penetration tends to be high, and it's relatively a country with a population which is higher. But then you look at smaller countries, internet penetration may also be high because the reach it's easier for network service providers to reach everyone. But where am I going with this? I'm looking at the relationship between population and also internet penetration. You find countries like South Africa, there is high internet penetration, and also you have a higher population. But if you look at countries like Mozambique, the population is high, but internet penetration is low. Maybe this is due to years where the infrastructure was destroyed by war or other factors. But if you look at small countries, because it's easier for network providers to actually reach everyone, then internet penetration is very high. The intuition is, what is the payment method that can be used in these countries? So it gravitates towards using telecoms or a fintech, which the central banker has no control over. So that's a literature review matrix that summarizes the literature that we have looked at, which from what is available, it's mainly more qualitative, but what is missing is a quantitative study. So that's the conceptual framework, which traces what are the drivers between informal and formal cross-border. So those are the theoretical contributions, and you move to empirical contributions. But per se, the quantitative aspect that we look at is the Poisson, and those are the variables that I'll focus on, or with a dependent variable where you look at the index that captures the informal aspect. So from an econometric point of view, we are just looking at ICBT because it is comparatively easier to approximate the informal. This study actually adopts the econometric approach and applies the gravity framework. So those are the variables. If you look at I will not go deeper into the econometrics. I want people to be comfortable. So, but per se, what we are focusing on is just trying to model the informal aspect. So that informal aspect is the unknown. And how do we do that? We come up with a crude index which borrows much from what we know. So if you say what you know, 1 minus what you know, you come with the unknown. So that unknown is that index. And per se, when imports are coming into South Africa, there is payment. So that payment is either formal or informal. I'm not interested in the formal because we know that. The informal is what excites, that's the gap that this paper looks at.
Question for you. So you've given us your problem statement, which we understand you are framing the question as lack of trade between these countries. Specifically, we are looking at SADC. Now, here is a problem conceptually. We have SACU, which has been in existence since 1910. We have CMA in existence since 1986. We can't claim that the countries do not know each other. We also cannot claim that the trade, I know that empirical evidence gives us 60% trade in between South Africa and the rest of the neighbors. But what is it that SADC countries have to do to trade more with each other or trade better with each other? Because when you look at trade statistics, they are doing roaring trade with other continents, particularly the EU and Asia. So what is the problem? The problem doesn't seem to be proximity. It's not geography. What is the problem?
Should I answer that?
Mm-hmm.
Okay. Okay. I think it's important to understand the basket of commodities that are traded in SADC. SADC trades in base metals. And base metals, naturally, they are in their raw material state. So the buyers of base metals are outside. Intra-African trade is less than 20%. And if you look at inter-Africa, it's 80%. So naturally, the consumers of raw materials are not within Africa.
Mm-hmm.
So at the end of the day, you end up trading outside the SADC region because lack of effective demand for what we have. So that is one of the shortcomings. If you look at the objectives of AFTA, for instance, we want to promote intra-African trade, but what are we selling? That's the question. We have copper from Zambia, copper from South Africa. So if you look at the laws of comparative advantage, should you buy copper from each other? Or ideally, we need people who buy this copper, which are outside. You look at the biggest consumers is Asia, which is China per se. You look at the European market, and also recently we had AGOA, which was consuming most of what South Africa supplies. So per se, the integration dream with what we have will take quite some time.
Okay, please proceed. We will also ask the audience to come with questions a bit later, but please proceed with your presentation. Thanks.
Okay, so those are the a priori expectations of the model. So the findings, if you look at the variables that I have, CPI, which is inflation, it's significant and positive. Then we have other variables like GDP, it's also positive and significant. But just to see if the model is correctly specified, we did some specification tests. And if you look at the distance variable, it tends to be negative, which actually agrees to what the gravity model says, that countries which are relatively closer to each other, they tend to have more trade. So let me dive to the discussion. A positive and significant relationship exists between consumer price index, which is a proxy for inflation, across all variables, which supports the hypothesis that inflation pushes trade into informal channels. Then the coefficient of export is positive and significant. Then the coefficient of import is also negative and significant. The mixed pattern observed across model specifications underscores the complex relationship between recorded trade volumes and informal flows. Also, unemployment, it displays a strong negative and statistically significant coefficient, which lies between 0.3 and 0.6. So if you look at the findings which highlight those spatial dimension, which you are looking at distance, it's negative and statistically significant. Then the results of the 6 government indicators, they actually convey a clear and consistent pattern. All 6 exhibit a statistically significant negative association of informal, meaning if we have poor governance, poor control over corruption, then it actually results to more people being pushed into the informal market. Then in conclusion, so the empirical results, they demonstrate that informal cross-border trade is not a peripheral activity, but it's systematically influenced by macroeconomic conditions, entrepreneurial dynamics, and the quality of governance. The significant negative between Pretoria underscores South Africa's role as the regional economic hub, around which informal trade flows are organized. Informal cross-border trade is actually linked to formal economic activity. Then this suggests that informal trade frequently functions as an entrepreneurial response rather than as a coping mechanism for the unemployed, meaning someone does not live. Like if you ask a lot of people, they do not look for a job in the informal sector. They are forced because there are no jobs in the formal sector. So this is what we find. Weaker governance is associated with higher levels of informal trade, indicating the business and individuals resort to informal channels when the formal are perceived as inefficient, corrupt, or burdensome. So recommendations, I'll rush through the recommendations. So government should prioritize institutional reforms that enhance transparency, streamline customs procedures, and actually reduce bureaucratic obstacles so as to decrease incentives for informal trade. Simplifying registration, lowering the cost of formal cross-border can actually encourage entrepreneurs to operate within formal channels. Regional cooperation should be strengthened so as to harmonize trade, to improve cross-border infrastructure so as to reduce the transactory cost associated with geographical distance, then creating a predictable and efficient and business-friendly formal trading environment. Then for any paper, you find that there are limitations. We learn so that in future we can improve. Such a study of this magnitude, we are relying on aggregate data, which is already available either on YDI or IMF. You are not allowing detailed exploration of individual motivations. You are looking at the people who are involved in informal trade. So future research, if you can have a mixed method approach where you combine econometrics and qualitative techniques, you involve trader surveys, interviews, so that at a microeconomic level, you can find more. Also, you disentangle the effects of the 6 governance indicators, so that you particularly focus institutional quality, because it's a very important aspect. Then you can also look at a comparative analysis where you look at not only the SADC region, but how about ECOWAS, how about other regions, so that at the end of the day you can contextualize what we get in SADC. Is it happening in other regions? Then also digital platforms, we have to incorporate them, because what is happening is you can't run away from what is happening in as far as money movement is concerned. The central banker manages banks, but you find that the law, if you look at the central bank or the Banking Act, only regulates the banking space. But a lot of money is moved via these informal channels, that is using telecoms. There was an issue where I was saying countries like Zimbabwe, where there is a cash customer-to-customer business model, where the component of C in the measurement of money tends to be very high. So the aspect where you have a lower D implies it's difficult for the central banker to influence monetary policy. And at the same time, you have a country like South Africa, which has got a business-to-business model, where D tends to be high. So monetary policy in South Africa is effective, because if you lower the repo rate, the market can feel it. But if people are using cash, then it becomes difficult to influence. Thank you.
Thank you very much. Can we give him a hand? I'm going to ask for 2 questions directed to him before I proceed, because I know there are a lot of bankers in the room or people who are not in research. So can you give him feedback? What does it look like from a banking point of view? Any questions? I saw colleagues from Nedbank, RMB, Standard Bank. Yeah, I see you. Megan, your hand was up? Thank you. Let's give feedback, please, because he's talking from a macro point of view, maybe a very micro point of view in our world.
I think it's just a reflection on something you've highlighted around the reasons we make payments is related to trade, as well as remittances, to the earlier conversations. And the extent to which trade is informal and undocumented gives effect to the fact that the payment is then informal and undocumented. And there's a degree of that, and you're highlighting some of the reasons why some of that trade is happening informally. And perhaps it's to do with avoidance of customs or movement of grey goods and informal economies that take place. And some of that is giving effect to less use of formal systems. Something that I contemplated, as you said, that is to what degree that brings less load onto formal systems and therefore increases the cost overall for those users of the formal systems. So that if you've got more use of the systems in place, you might create greater efficiencies. So there's an interesting dynamic, I think, that you perhaps made me alert to around the informal movement of goods and informal payments and how that gives effect to a greater inefficiency in the system potentially. But your correlations are very interesting because they give effect to the underlying reasons for it, which are empirical, and I think validly overlay against our experience of it, which is more anecdotal. And I completely support the notion of bringing empirical evidence to support what entities serving customers on the ground experience, but can't give measures to, and that you've done that very valuably. Thanks.
Thanks, Megan. We're not going to ask him to respond because this is just giving you feedback. So anyone who's from global markets in the room? Any feedback that you would want to give? Okay. I don't see any. Thank you very much, Ngoni. We're going to move on to Mr. Gamadigbe. Over to you, sir.
Thank you. Can I have my presentation, please?
It's coming up.
Okay. Okay. Hi, everyone. My name is Vigninu Gamadigbe. I am a researcher at the Central Bank of West African States, BCAO. First of all, I would like to thank and express I would like to thank all the organizers for inviting me to this presentation, especially the Bank of International Settlement and the South African Reserve Bank for inviting me to present the paper entitled Inbound and Outbound Remittances in WAEMU countries, exploring the dynamics and the main drivers. Coming from a French-speaking country, my English may not be perfect, but the good news is that I will try to deliver the main message of this paper. So my presentation will be organized in 5 points. First of all, I will present the main motivation and the research question of the paper, and then I will present the recent dynamics in remittances in WAEMU countries. And the third point will be devoted to the empirical analysis and the methodology that I've used to tackle the question of the paper. And the section 4 will be devoted to the main results of our econometric analysis. And in the last session, some policy implication will be presented. So, in recent decades, we have witnessed more interconnection of economies due to globalization. So this development have led to an increase in the international and regional migration of people in search of good condition and working conditions. So they also have impacted hugely remittances flows toward the developing countries. So we have a very extensive literature on remittances who have tried to highlight the main advantages of remittances, and we have remittances who are used to finance household consumption, expenditures, and education and healthcare. And remittances also help reduce income volatility in developing countries, and they also play safety net role in face of economic crisis, recessions, and natural disasters. So remittances are also useful for institutions, financial institutions, as they help them to improve their liquidity, and they also contribute to reduce the current account deficit in developing countries. So There are many papers who have tried to identify the main determinant of remittances, and they have pointed out the importance of GDP growth rates, exchange rate volatility, transaction costs, uncertainty, stock of migrants, and sharing a common border and common official language. When we focus on WAEMU countries, three major development needs to be talked about. First, we have the financial development with a significant growth in the number of active commercial banks and fintech and microfinance institutions, and we also have an increase in the number of mobile money providers. The second development is rapid growth in the adoption of digital financial services for domestic and cross-border payment. And the third development is they come to an effective of the interoperability project from September 2024. So these projects could be a huge potential game changer in the domestic and cross-border payment in WAEMU countries. While the literature on remittances is extensive, there is little papers tackling the question of remittances and their determinants in WAEMU countries. So based on this background, this paper asks two questions. The first one is, what are the main drivers of inward and outward remittances in WAEMU countries, and how important are digitalization and financial role in this process? Then we seek to explore the recent dynamics of remittances in WAEMU countries and to identify the main drivers, focusing particularly on digitalization and financial development. So these figures present the dynamics of remittances in WAEMU countries, and the panel A shows us a huge increase in remittances from the year 2000 to 2021. As we can see, remittances are still growing in the region, and the panel B also presents the outbound remittances where the same dynamic is also seen. Now, we can say that if we focus particularly on remittances, inward remittances, we can see that they have been multiplied by 10 from 2000 to 2021. And the same dynamics are also perceptible when we calculated remittances as percentage of GDP. So the graph also shows that when we consider inbound remittances, Senegal and Mali are most receiving countries in the region, and Cote d'Ivoire, the most important economic country in the region, is the country who sends more remittances. When we focus on the sources and destinations of remittances in WAEMU countries, we can see that the sources and destination of remittances are from Europe and the CEMAC zone. This is related to the fact that these countries share a common history, a common colonial history, and the fact that there is a fixed exchange rate between the CFA and the euro, because it helps reduce the volatility of the exchanges, and that promotes and reduces the cost of transactions. Now we move further to present some correlation between the adoption of mobile phone and remittances, and we can see a positive correlation between the two variables, and this same correlation is also found when we consider financial development index. So we move beyond this this simple correlation and try to use more sophisticated model to try to explain and highlight the main determinants of remittances in WAEMU countries. So as my colleague, we rely on a gravity model which we estimated using corridor data. So our data is structured as follows. It comes from the Central Bank of West African States. We have 8 WAEMU countries transacting with 24 other countries, African and others coming from the rest of the world. So we use panel fixed estimator rather than PML estimator because we do not have 0 issues in our data. So what we are trying to do here is to explain inward and outward remittances using some explanatory variable. So we rely on distance, common language, and common border, GDP growth in the receiving and the sending country, the stock of migrants in both receiving and the sending country. We also calculated and included in the model the volatility of the exchange rate. And more importantly, we focus on 2 variables, the financial development in the region and the mobile phone subscription, which we use as a proxy for digitalization. So in our specification, we try to capture the direct effect of financial development on remittances and the mobile phone subscription. And more than that, we go further to analyze the interaction between financial development and mobile phone subscription. So here is our main result. We can see a positive relation between the sharing of an official language and inward remittances. And we also have a positive coefficient of stock of migrant, which help us to say that as the stock of migrant increase, we have more inflows of remittances. So there is a positive effect of common official language, the stock of migrant, both in receiving and sending countries. And we also have a positive coefficient and significant at 1% of the financial development and the adoption of digital tools. Now, we also confirm the result also confirm the safety net role of remittances as we have a negative coefficient of GDP in the receiving country, which showed that when countries went through recession and natural disasters and other shocks like COVID-19, we have migrants residing outside the country who react by sending remittances to their families. So we also have a positive interaction effect between financial development and mobile phone subscription, which we try to illustrate on this graph. So we have a positive marginal, positive and significant marginal effect of mobile phone adoption. This means that countries with more developed financial system benefit more from greater leverage and digitalization on migrant remittances. So what are the main implications of this econometric analysis? So
Mr. Kamatibe, before you go into the policy implications, one question, please.
Yes.
Looking at your data,
yes,
particularly from the mobile companies, do you have any evidence that this data has been used to drive transactional behavior, either by the banks or any other credit providers in the WAEMU region?
What I can say is that this is the first time that we are using a corridor data to analyze remittances in WAEMU countries. So I'm not sure that other players have already used this data to explore and analyze the behavior of customers regarding the transfer of money or cross-border transactions.
Please proceed.
Okay. Thank you very much. So I was saying that for policy implication, we have two points. First of all, for the migration, we can expect that remittances can continue to grow as the population of WAEMU countries is still growing. And we can expect also a decrease in remittances coming from advanced countries which are experimenting or implementing anti-migration policies. So we also highlight the positive, the safety net role of remittances in WAEMU countries, and this push us to find some ways to amplify this role of remittances. So the results show that there is a need for transaction cost reduction policies and digitalization of financial services, such as the interoperability project effective from September 2025 to amplify this role of remittances. So the paper recommends further consideration of extending this interoperability project to other African countries. There is also need to transaction cost reduction policy to amplify this role, and by implementing financial inclusion policies that are being set for the region. So to summarize, I can say that the future of remittances in WAEMU country depends hugely on the migration, and also on the adoption of mobile digitalization of financial tools. Thank you very much for your attention.
Thank you very much. One question. You've spoken about remittances as a source of social safety net. What about the probability that remittances could also be the source of foreign direct investment? Then I'll come to our discussant.
Okay. Thank you very much. At the Central Bank of West African States, we have conducted a survey on the use population or households made of their remittances, and we have shown that a very significant proportion of remittances are used for investment in mortgages and for investment by the households. So remittances also can be a source of investment, a source of revenue creation for the householders receive it from their fellows that are abroad.
Thank you very much. Stephen, you are online. It's your turn. If you could please take over as a discussant.
Thank you very much, Bongi. Can you confirm that you can hear me clear?
We can hear you clearly.
Fantastic. Thank you very much. And for me, I'm excited that cross-border participation is possible. I'm hoping at the end of today's conversation, including tomorrow's conversation, we'll find a pathway towards enabling cross-border remittances across the African sub-region. Thank you very much for the very insightful presentation, both Ngoni and Vinu, regarding informal cross-border trade in the SADC region and the dynamics of remittances in the WAEMU region. Interestingly, I see you both use the same methodology, and very interesting insight about how inflation can push to informal trade and how language can facilitate cross-border payments. In this conversation and other conversations that happen, two things stick out in my word cloud: lack of data, regulatory harmonization. There's a lot to unpack, but I'll just start from data and then drive down to other drivers. Trade. It is very, very interesting that presented on cross-border trade, a block of the region can be triangulated. The presentation today, in this session, brought out data from the WAEMU region and additional data from the SADC region, including what Damola presented earlier. Oiga's presentation brought corridor, very fantastic data from SWIFT. So even as we think of that story, it will be very exciting to triangulate this data and see what further insight we can get in the sub-region. Let me start from informality, because it has been at the core of this conversation. And it is very important for all of us to agree or understand or have a common understanding that informality in itself is basically the symptom. It is not the problem we are looking to cure. My organization, Women's World Banking, we work with some DFS company in Colombia and Thailand to develop a remittance product. So basically there are 1.2 million migrant workers from Colombia working in Thailand. So we work with some solution providers to solution around remittances. As part of that process, we engage women that were receiving remittances through informal sources. And I'm going to read a comment or a statement from one of the women. I have spent a decade in Thailand, far from my home in Cambodia. I want to return and start my own business one day, so every cent counts for this dream. But there was a time when I lost my money through an informal remittance channel. It just disappeared. I felt sad and helpless because I couldn't get my money back. So those are some of, this is one of the kind of comments we saw from participants in the informal sector. And I'm glad to say, based on our collaboration, we brought out solutions that were able to address this problem. So how can we push this further? One word that came up again today is incentive. But incentive for who? First, regulators need incentive. When Ngoni was making his presentation, he did mention that regulators focus on formality, and rightly so, and the primarily business of a monetary policy authority in any country is price stability. So they focus a lot on inflation and financial system stability, especially with the risks of gray listing. But how can we help the regulator to understand that digitizing the informal sector for remittances can facilitate monetary policy transmission? Maybe it will trigger more interest from the regulator in participating and addressing challenges around the informal sector for remittances. How can we incentivize the customer? We had conversation with a lot of customers, and one thing that we've seen across the sub-region, not necessarily for remittances, but there are strong consumer protection framework meant to protect financial service providers. But guess what? It is not translating into confidence. And what are we hearing? Customers are saying confidence is built bottom up. It is not necessarily built by adopting or implementing a regulatory framework for consumer protection. So how do we change that so that through trust we incentivize the customers? Another is the solution provider. We've spoken a lot about regulatory harmonization. Africa is 50+ markets, each with different regulatory regime. There's been effort around passporting, bilateral passporting and all that. But just put yourself, in the shoes of an innovator that is looking to do cross-border solutions for remittances. The application for licenses, different in all regimes. So while we talk about regulatory harmonization, while we talk about proportional regulation, maybe it's a very important conversation for BIS. How do we standardize requirements for licensing, for instance, for remittance providers, leaving the regulation apart, but just the requirement for licensing, so that at least it minimizes the effort of them looking at several jurisdictions while addressing that. Another thing that came up today that is of interest is value-based remittances, particularly around the SADC region. But it's a phenomenon that happens across the entire sub-region. This ties to the conversation around data. How would that change the narrative around the value of remittances and even cross-border trade? Is a very important factor that we need to investigate more. In our conversation with various regulators and market players in over 35 economies, something has come out clearly. People are tired of framework and policies. People are looking for practical solutions. What we've done, we've partnered with a lot of providers to bring out practical solutions. And the FinDesk data has shown us how mobile money has pushed financial inclusion up. How do we leverage existing pace of adoption of digital financial services to facilitate digitization for remittances in the informal sector? Another very important conversation is financial inclusion. Most countries in Africa have a national financial inclusion strategy. A national financial inclusion strategy looks at everything from payments to credits to insurance to pension. Remittances is a very, very big market globally. How do we tightly couple this to the conversation of national financial inclusion strategy? How will it change the narrative? Bongi, I'll just leave us with these questions and then let's see where this conversation takes us. Thank you.
Thank you very much, Stephen. Can we give him a round of applause? In summing up this conversation, just a few pointers from me, listening as part of the audience. The question that you had to solve was, what are the drivers of cross-border payments in the regions? And we have two regions, WAEMU and SADC. So there are alternative ways that I thought it could have been answered. You did very well. And I also agree with your research questions, both of you, because they were very well framed. But something like remittances, it's very much relational. So the field of behavioral economics could have given us a set of different questions from the field of macroeconomics. No fault in using macros, but behavioral, because there are issues there about trust in relationships. How do you end up with informal systems, irrespective of level of development in a country, irrespective of geography? There is a human element. And behavioral economics has got data sets that would have given you different insights from what we were looking at. Second view, it's for both sub-regions, SADC and WAEMU. We had a bit about policy recommendations, and again, those are very solid recommendations. But what I heard from Stephen provokes me to say, in further iterations of your papers, maybe put in a question, if you've got the data, put in the question of regulatory passporting. Because what would that change? How different is it from regulatory harmonization? What would it take? And in this instance, for both of you, I'm thinking regulatory passporting with respect to the telecoms that you cited, because you had sufficient data related to that. Also, part of regulatory passporting that you would need to factor in, it's FATF and grey listing. What would it have changed, particularly for you, Goni, on your equations in your econometric series? They were very much linear equations, and I don't know if they would have changed if you had looked at the impact of grey listing. Then, if data is available from settlement companies, I know we've got a few of them in the room, put that also into your analysis. And to be provocative, risk-based analysis does get you thinking differently. Risk from the side of the consumer, also from the side of policymakers. So that would be my observation to both your papers. And thank you very much, Stephen, for your inputs as well. May I get inputs from the room for the two researchers? What would be your recommendations on what else they could have looked at? Jill?
Thanks very much, and that was a very insightful conversation. So just to follow on from what Bongi said, is that you've talked about taking into consideration the two things, and I think the third thing that you talked about in both your papers somewhere along the line was bringing transaction costs down. But somebody's got to cover those costs. So we need to have a third view in there to say, if we're going to bring transaction costs down, how are we going to do that? Because at the end of the day, there is a cost for the infrastructure. So the policymakers can say, bring the cost down, bring the transactions down to naught, let's not have interchange. But at the end of the day, that infrastructure, whether it's a mobile or a bank or a fintech, have got to cover some of those costs. So I think you need to take that into consideration. Goes back to Geeta's conversation in the earlier conversation that we had, is it's got to make business sense. And how do we make business sense from financial inclusion or other things? How do we need to bring that business conversation in, not just policy, not just consumer? Thanks very much.
Thank you for that input. I see, if you can please introduce yourself as you give the input.
Okay, it's Mpumi Mlangeni from Pay Inc. My question is around the WAEMU research venue. From my side, you spoke around digital adoption and how that has made it easier for remittances, or the adoption of remittances, and made it easier for the flow of money. But I was quite interested, and I'm not sure if this is something that you looked at in your research, around what regulation has, what impact regulation actually has on that, right? So you have high, digital adoption, which then facilitates those remittances, but the ease of transacting and making those transactions from a regulatory point of view, I'm not sure if you looked at that, and I'm interested to just hear your views on that. Thanks.
Okay, let me make a suggestion that this question, let's take it, we're supposed to be at tea time. Let's have a bilateral, because I can also give you some inputs apart from our research panelists. That being said, I don't see other hands. Please join me in thanking the researchers for the work that they've done. I will turn it over to the Master of Ceremonies, or the mistress in this case. Is it? Program Director.
Thank you so much,
That's the
Wengi.
PC term.
All those terms are acceptable. So colleagues, as Wengi mentioned, we are very much due for a comfort break. So let's break and be back in the room, let's say at 15:50. Thank you.
Thank you.
Hello, please, can we mute our mic, please? Thank you.
for us to be able to be back on time for the policy panel to start as is designated. Welcome back, colleagues. I know that we are still missing some colleagues, but I'm sure they'll join us shortly. We have 2 more sessions to go through, and then also including some key closing remarks from Tim Marcella. But for now, we will focus on another research session, which centers around payments in the fast lane, driving efficiency in cross-border transactions. This particular session will be moderated by Juliet Kairuki, the Managing Director for FinCES. Juliet, over to you.
Good afternoon, everyone. In keeping with the theme of this session, I am going to try and be as fast and as efficient as possible. And I'd like to kick off by inviting all the participants in the session to the stage. And then we can kick off with our session, and we will try and regain some of the time that was lost so that we close off and go back to the time that was allocated on the agenda. So I'd like to first say that this session is focused on payments in the fast lane, driving efficiency in cross-border transactions. It examines the critical role of speed and efficiency in transforming cross-border payments. Speed is particularly important for cross-border payments and remittances, as it ensures timely availability of funds and often addresses urgent financial needs. This session, therefore, explores how fast payment systems can enhance speed and reduce the cost of remittances. Our presenters for this session are Mr. Mike Trotter from SWIFT. Welcome, Mike, to the stage. Mike is the Regional Head of Industry Engagement for EMEA at SWIFT. He focuses on fostering collaboration on cross-border payments, digital infrastructure, and financial inclusion. He has 25 years of experience in banking technology. He has expertise in payments transformation and financial messaging. His work on Singapore's Project Ubin sparked his passion for the future of money and global payments innovation. We're happy to have you. Welcome. I almost said karibu. Our next speaker is Alberto Di Iorio. Welcome to the stage, Alberta. Alberta is from the Bank of Italy. He began his career there in 2017, working in the Financial Risk Management Directorate. In 2021, he moved to the newly established Directorate for Retail Payment Instruments and Services, where he is currently employed. From September 2023 to December 2024, he served as a visiting member at the Secretariat of the BIS CPMI. He also collaborates with several universities in Rome, and his research interests mainly focus on payment habits, crypto assets, and stable coins, as well as cross-border payments. He holds a PhD in methodological statistics from Sapienza University of Rome. So we're happy to have you, and we look forward to your presentation. Last but not least, I'd like to invite our discussant, who is Mr. Moktimi Mulaudzi, a payment analyst at the South African Reserve Bank. Welcome, welcome, Mr. Moktimi. He specializes in payment systems operations, regulation, and innovation, and he has nearly 7 years of experience. He contributes to enhancing South Africa's national payment system. He is an alumni of the University of Warwick. He is passionate about digital transformation and advancing inclusive financial ecosystems. So I'm very excited, and I know that we will have a very good and productive session. Our first presentation is going to be delivered by Mike. I'd like to welcome you.
Thank you very much.
Karibu. Welcome.
Thank you and good afternoon, everyone. Right, so I'm going to take you through a little journey of exploration that we did in response to the call for papers. I think everyone's familiar with SWIFT. We've heard the name a few times in terms of a data set that's underpinned some of the studies we've seen today, but I think you know we're a global cooperative owned by its members, looking at how we can improve payments globally, and hopefully today we're going to do that with a bit of our data as well. So I'm going to run through three things. Firstly, why this matters, why we think it matters to everyone. Second, to talk a little bit about the data we've used that I touched on, and Eugenio did a good job this morning to line that up a little bit. And three, the results we found across three different areas. So firstly, a kind of research question where we started. We were really interested to understand, has Sub-Saharan Africa's cross-border payments experience improved over time and over a specific period of time, and what were the drivers behind that? The reason we think that's particularly important is because cross-border payments really are the foundation for growth. They drive global trade, they drive the growth of economies, and that matters. So if cross-border payments are efficient and effective, then hopefully growth will follow. And we've spoken about it a few times today already, that actually data is particularly important, and sometimes there's not a lot of data that's available, or very few data sources. And of course, if you don't have the data, it's difficult to make decisions. And so hopefully through some of the data that we share today, we can help drive some policy decisions that really result in real change for cross-border payments, and particularly for Sub-Saharan Africa. So let me quickly talk through the data set. So we've spoken about it before. We use Swift Observer particularly, and we're going to look at this period of 2021 to 2024. You'll have noticed Eugenio used exactly the same data set. You may be wondering why. And that's actually because Swift payments use this thing called a unique end-to-end transaction reference, or UETR. And it helps us to trace a payment from end to end. It was introduced back in 2017 as part of an initiative we called GPI, and it's now a universal part of every transaction that crosses the SWIFT network. This is particularly important. So it's all SWIFT payment data, and then we kind of refined it down, only payments which were successfully delivered, so we're not looking at anything that's been rejected, of course. And we're going to look at all value buckets as well. And when you look at things like the FSB reporting we do for the GPI, for the G20 targets, this is only payments above 100,000, and we exclude all future date, value date transactions. And we're looking specifically at customer credit transfers, so MT103s or PAC 008s in the modern parlance of ISO 20022. And then we look at transaction volumes and processing speed. I think before we go on, though, I should spend a little bit of time to talk about this concept of processing speed, because it's vital to understand what this means. And typically we think about processing speed kind of in three ways, or three overlapping terms. And when we look at end-to-end speed, it's from the period or the time that a transaction hits the network, the first time we see it, and it includes everything up until the person at the end of the chain, the beneficiary, receives that payment, right? Very important. This is the total time end-to-end, or processing time specifically. And that's made up of two components. The first component is in-flight speed. So in-flight speed is typically this piece that we think about as the cross-border payment. So the bit that goes between banks, there might be multiple hops. Typically it's the correspondent banking leg or the SWIFT leg. And this in-flight speed is the time it spends on the network getting to the final agent that will credit the beneficiary. The beneficiary speed is specifically the time after the credit agent has received it of then crediting to the beneficiary. It might be interesting for you to know that 20%, based on our latest understanding, 20% of the time is spent on the in-flight speed, 80% is spent in the very last leg crediting the customer. And we're going to talk a little bit about that as we go. Okay, all clear? So we know the ground rules. Okay, let's get cracking. So we looked at three different things. Conclusion number one, when we look across our data set for Sub-Saharan Africa, is that cross-border payments in Sub-Saharan Africa are becoming increasingly intracontinental. So when we look back over the last 10 years, we looked at the data as well, we actually see that the compound annual growth rate is around 13% for payments that are growth within Africa. And if we look at kind of the rest of the world's growth, if we look at the growth to all the other parts, it's about 3%. So we see this growth that's happening. When we look across 2021 to 2024, we actually see that 30% compound annual growth rate is there as well. So there's this acceleration of intra-Africa payments that's occurring as well. And again, to the rest of the world, we're not seeing that same level. There was a kink in 2024's data. If you look at our paper, I haven't got the slide up here, but there was actually a kink in the 2024 data because of the CMA change from domestic to cross-border. So those volumes are starting to be seen as cross-border. They cause a little bit of an increase, but overall, the increase is there even if we take out the CMA transactions. Okay, so it's a trend that's increasing. So if we look by region, we've done a breakdown here just to kind of understand the level of growth. And we were quite interested in looking at other emerging areas of the world, regions of the world as well. Sub-Saharan Africa sitting at a 44% growth over the 4 years. If we look at Asia during that period, it's 19%, Latin America 25%. So again, Africa is growing. These intra-Africa payments are growing incredibly in this continent out of all the other developing regions. And it's strongest in Southern Africa. And maybe some of the other discussions we've seen this morning can explain why. But we did wonder what those contributing factors were. Is it the regional initiatives around payment systems? Is it policy changes like AFCFTA? Or is it partly post-COVID as well, looking at reconfiguring supply chains or value chains as well? If we think about the external orientation, so not just the Sub-Saharan Africa payments, we also see that the Middle East is the strongest growing kind of external orientation for the region. So what does this mean for us if we think about this? Well, one of the things that we think about in terms of risks and opportunities is we see a regional imbalance. You can see it differs across the regions of Africa. That fragmentation may mean that certain regions are going to grow and leave others behind if it's not addressed. There is a global reorientation of trade flows, and maybe with the turmoil in the global markets this year as well, we're going to see more focus on intra-Africa trade. And a policy integration risk as well, and I think this has been covered a few times by a few people this morning already. And there may be some currency and FX implications as well, thinking about the US dollar we were speaking about, and a move towards local currency clearing. The second conclusion that we came to is that Sub-Saharan Africa is a long way behind when it comes to speed, trailing about 17% from the global average. So if we take a look at this, one of the things that we've worked hard on, and I mentioned before the in-flight speed versus the beneficiary speed. Across the SWIFT network today, 75% of all cross-border transactions reach the beneficiary bank, that creditor agent, within 10 minutes. So if we think about that in the context of the G20 goals, that means, in theory, the creditor agent has 50 minutes to credit the beneficiary to meet the goals. So there's no problem with the cross-border leg. If we think about the median speed, if we looked at that across the globe, actually, that interbank speed is absolutely consistent globally. So in other words, it doesn't vary for Africa. The in-flight speed is consistent across. Okay. So the significant variation we see is in the last mile. So we come back to the importance of this last mile, the crediting of the beneficiary. If we look one level down at Africa specifically, it's useful to see here that actually we looked at what's the speed of each region. And I don't know if you guys are surprised. I was surprised to see East Africa is actually the fastest processor of incoming cross-border payments. And Southern Africa is the slowest. I wonder what's driving that. But it does highlight that actually, again, it's not something that's consistent. We've spoken about looking at averages today. If we look at individual markets, we actually do see changes. We do see markets that are faster, and East Africa here stands out. But there are discrepancies between markets that need to be addressed. Now, just in terms of what SWIFT's been thinking about in this, earlier this year we did an analysis of these frictions in the last mile across 40 markets globally. 3 of those were in the Sub-Saharan Africa region. And although that's not a great sample, I want to talk about 3 things that we noticed, 3 common factors across those markets. We tend to see capital controls existing across the markets. You're asking for things like payments purpose or regulatory reporting, and the need for supporting documents for cross-border payments. And a lack of standards as well about how they're applied from market to market, which is definitely something that could be addressed. The second is limited banking hours, and this is very significant. Cross-border payments arrive at the creditor agent, but maybe they close and don't process anything after 3 p.m. in the afternoon. That means everything sits on the queue until the next morning when it's processed again. This is significant because those systems are not running 24/7. There's been mention of STP in an earlier session as well, and that manual processing is also a real challenge to overcome. So these market practices and cutoff times, nothing to do with the real-time, the RTGS or anything. It is just the processing at the bank or any other non-bank financial institution that's processing it. Okay, the third one is the structure of intermediation. So these are the number of hops, the number of parties that a transaction might go through is relatively invariant over time. And actually, it might surprise you to know, and it surprised us as well, that 82% of all transactions occurring, cross-border transactions across the SWIFT network in Africa, have 0 or 1 intermediary. So just to put that in perspective, Africa has some of the shortest chains of all cross-border transactions because the average on SWIFT's network is around 70%, 0 or 1 intermediary. So Africa has short chains, right? It's kind of interesting to see. So what does that mean for us? Well, those short chains can have a lot of drivers. Long chains tend to cost more, but here we see the exact opposite of what I think the industry tends to say, that long chains of intermediaries tend to take a long time and result in slow speed. In Africa, they're short, but our payments are slow. Right, so we come back again to the focus on the last mile. It's not actually the rails themselves getting the transaction to the end, but it's the ability to process the transaction once it arrives. So we don't think, based on our analysis, that looking at the chain or the number of intermediaries, or even the cross-border leg, is the problem that we should be focusing on. Okay, let me quickly sum up the three areas or three trends we think that we need to focus on. I've said things are increasingly continental, so Africa matters to Africa. I like that gravity discussion. This seems to kind of hold true. The second is that Africa has below average speed, but it's not because the cross-border elements are slow. It's the ability to process at the last leg. And intermediation doesn't seem to impact things. So the opportunities for research where we need to go into further is a little bit on intermediation dynamics, because we are quite interested to understand, is there a change from certain banks to other banks that are handling things as Africa moves towards more Pan-African banking networks? This is quite interesting to understand if that's changing. The second one is policy integrations. So harmonization of standards has been touched on already. Last mile delivery channels as well, not just to banks, but mobile money or wallet ecosystems. And we really want to make sure that we avoid fragmentation by sub-region, because I think that's a challenge we need to face up to, because those regional imbalances are important. And I think more research needs to be done on understanding what's driving the regional imbalances. Why do we see the differences? If we understand those, we understand which policy levers to pull, and that helps us to address this. Thank you very much. And if you're interested, there's one little thing looking at the spotlight on speed, which might be interesting reading for you later. Thank you.
Thank you very much for that insightful presentation and for helping us to understand that whatever the problems are, it's not SWIFT's fault. And that the reason why there's a 17%, should I say, disadvantage in terms of speed lead is really because of the last mile issues, the beneficiary component. So you've covered a presentation that traverses the wholesale and retail aspects of cross-border payments. I welcome now Alberto to talk to us about remittances and what is happening in that environment with respect to speed and efficiency. Thank you.
So can you hear me? Yes, I think so. Let's wait for the slides to come up. Okay, great. So thank you for having me here today. I'm presenting this research paper called Send Me Money as Soon as Possible, Assessing the Impact of Fast Payment Systems on the Cost of Remittances. This is a joint work with Marco Brandin and Andrea Nobili from Banca d'Italia. And the usual disclaimer is that the views expressed in this presentation are those of the authors and may not reflect those of the Bank of Italy. So let's go at the heart of the matter, a bit of background. I will not spend a lot of time on this, given that all the presentation before me already talked and discussed in depth these arguments, these topics. Of course, we know that the globalization of trade capitals and migration increased the demand for cross-border payments in the recent years. And the cross-border payments are relatively less efficient than domestic payment. And for that, in 2020, the G20 endorsed the so-called roadmap for enhancing the cross-border payments. This roadmap focuses on three main segments, which are wholesale, retail, and then we have remittances. Remittances, we already discussed this in previous interventions, are very important for several aspects and are plagued by some issues. For example, we know that the cost can be very high in some corridors according to the World Bank data. Someone said before that they are safety net for households, and so delays in fund transfer can impact significantly the recipients. And we also seen after the Great Financial Crisis a reduction in the correspondent banking network that may affect the access to cross-border payments in general. In the roadmap, a special attention is on the implementation on fast payment systems as a tool to improve both domestic transaction and cross-border payments. And these with different shades, but we already knew by the literature that we have some benefits at domestic level by implementing a fast payment system. For example, we know that they improve the efficiency, the transparency, and competition in the market. And they can also act as a catalyst for technological innovation. Fast payment systems are also associated with a reduction in the cash usage and an increase in the number and frequency of small value digital payments. And is also the implementation, the adoption of fast payment system is also associated with improvements in financial inclusion indicators. So we wanted, in our paper, we wanted to test whether these domestic benefits can reflect on the cross-border dimension. So does the implementation of an FPS in a jurisdiction, in this case, have an impact on the cost of remittances received by that jurisdiction? Of course, we are targeting indirect effects because FPSs nowadays mainly process domestic transactions, so they do not process cross-border transaction unless where there's an interlinking arrangement. So of course, we are talking about indirect effect. So the benefits that are in the payment ecosystem, if they reflect on the cost of remittances. So, and to try to answer this question, we resorted to one and only, I think, source of data, which is the remittances price worldwide by the World Bank. It's a very comprehensive database, data set on the cost of remittances. We use the period, the time spans from Q2 2016 to Q3 2024. Observation at a quarterly frequency is a very granular data set. We have information on the firm used to send the remittance, the speed of the remittance, which payment instruments was used to fund or to disburse the remittance, and so on and so forth. We also have information on cost, of course, which are the main interest of our research, for the equivalent of $200 and $500. We also have information on the fixed fee and the Forex component. In the dataset, we have 49 sending countries, 105 receiving countries for a total of 368 corridors. Some countries can be both, can act as both as sender and receivers. And then we complemented the information provided by the RPW, by the World Bank, with information on the presence of an FPS in jurisdictions. Here, this is the difficult exercise. I mean, because RPW is, as I said, a well-established source of data, while for the implementation of an FPS, we don't have really a unique source of data. We have something we base mainly on the Project FAST database by the World Bank, which has a list, and then also on research papers, mainly by the BIS, and also looking directly on the websites of central banks. And so, some basic facts. I will not go through all the data in the table, but for those of you who knows the data from the World Bank, we know that the cost of remittances is about 6.5% for a $200 remittances. Sub-Saharan Africa is the most expensive region to receive where to send remittances. But I will put more attention on spend a bit more words on the chart on the right-hand side. Here we wanted to test our research question in a descriptive way. And what we did, we plotted the cost, the average cost to send a remittance of $200 for those countries which have implemented a fast payment. That is the blue line, while the orange yellow line, is the line for the average cost for those countries that have not implemented a fast payment system. So as you can see, is self-explanatory. The blue line is much lower than the orange line, almost 2%. lower, and it also shows a decreasing trend over time, while the orange line stays more or less the same. So it seems that data seems to confirm our research question. But for those that are missing regressions, we also run a bit of a more robust econometric framework. I'm sorry for that, I will spend just a couple of minutes on this. So of course, we wanted to regress in a panel setting the cost of a remittance expressed as a percentage of the amount sent from country I to country J. We also had other dimensions, so the PSP, the time, and the method of collection of the remittance. Then on the explanatory side, the main variable, which is this dummy variable, FPS, it indicates whether the receiving jurisdiction J, in this case, has an FPS at time t. I have to be clear here. This variable varies only at a yearly frequency, while our data are at a quarterly frequency. So within the same year, it does not vary because we were not able to find the exact date of implementation. So we decided to keep it yearly. Then we have also the speed. So in this case, is a numeric variable representing the number of hours required for the remittance to be credited to the recipient. And then we have a set of control variables, GDP, the inflows of remittances, and a set of fixed effects to control for potential unobserved heterogeneity. Okay, so let's go a bit through the results. In this case, I'm showing the results only considering those countries which have implemented a fast payment system. Of course, what is of interest in this table is what is in the green rectangle. As you can see, the effect of FPS dummy is always significant and negative. So it means that after the implementation of a fast payment system, we have a reduction in the cost of remittances. And the only non-significant number is in the last column, which is the column with the largest set of controls. As you can see in the middle of the table, there is an increasing set of controls. And that is mainly why in this specification we have time-fixed effects, which may erode the effect of this dummy. But despite technicalities, let's focus a bit on the red rectangle. Yes, thank you. The red rectangle, which is about speed. As you can see, after introducing the control for firms, the speed coefficient becomes negative and stays negative. This is something important. I will go back to this in the conclusions. Then we extended, so in this slide, we present the results in which we extended the sample by including also those jurisdictions that have not implemented a fast payment system, so the control set. And as you can see, always looking at the green rectangle, more or less the result stays the same, so nothing changed except for the last column. So introducing a control set, of course, gave us a more robust benchmark and the time-fixed effect do not impact the significance of the coefficient. We also exploited the high granularity of this data set, and so we we wanted to investigate a bit the geographical heterogeneity of the effect. And so we split the data set in different regions according to the World Bank classification. As you can see, there's a bit of heterogeneity. There's something that probably is not expected. It is Latin America and Caribbean, which shows no significant effect, but this is unexpected given how successful PIX is in Brazil, for example. So it's something that when we had the result, we were surprised by. And Sub-Saharan Africa is the region where the effect is the lowest. So, but until now, this is more, these results show more a sort of average effect before and after the implementation of a fast payment system. But we wanted also to investigate a bit what is the channel through which this effect materializes. And so what we did also in this case, we try to exploit also, in this case, a bit the granularity of the dataset. And we try to see whether the competition channel is one of the drivers of this reduction. So what we did, we computed for each corridor in the dataset the number of distinct firms that are there. And we did a two-stage list regression, in which at the first stage, we regressed this number of distinct providers on the dummy of FPS. So it means, and we have generally positive and significant results. This means that after the implementation of a fast payment system, we saw an increase in the number of firms serving corridors. And then we, in the second stage, assessed whether this increased number of PSPs, of firms, had an impact on the cost. And what you can see here is that the negative result, the negative sign is more or less confirmed in for all regions. So this means actually that it seems to hold our hypothesis that the competition, even if, and I don't want to anticipate the intervention of the moderator, the number of PSPs is a proxy for competition. Is not probably the best one, but we did what we could. And I'm going to wrap up a bit the presentation. So jurisdiction with an FPS show a reduction in the cost of received remittances. The effect ranges between 0.2 to 1.3 percentage points, depending on the specification. More robust specification with the largest set of controls show the smallest effect. The effect is geographically heterogeneous, as we saw, and these effects seem to be driven by, of course, one of the drivers of this reduction seemed to be the increased number of PSPs, so supporting the idea that the domestic implementation of an FPS stimulates competition. And now I'll go back to the red rectangle of the slide about the first slide of results. Speed and cost are in a negative relationship. This means that faster services to send remittances are also more expensive. And this is quite, so they move in the opposite direction, and this is quite an issue because we know that the G20 roadmap puts target on both cost and speed in the same direction. They want lower cost for higher speed. And this is, as I said, something that should be acknowledged. In the data, we see actually the opposite. One of the potential solutions, of course, is to bring the benefits of FPS to the cross-border dimension, for example, by interlinking arrangements. So with that, I finished. Thank you.
Thank you. Thank you very much for enlightening us on the fact that FSPs, the existence of them improve efficiency and transparency. It's unfortunate that there's a negative relationship between cost and speed, but there's certainly a lot for all of us in the audience to think about, and certainly for the policymakers. I know that there could be questions for both the presenters. I request that you hold them until our discussant has had an opportunity to provide inputs. Welcome, Mlauzi. We have 12 minutes.
Good afternoon, colleagues. I think if there's anything that I've learned today is if you want to confuse the regulators, show them an econometric model. So definitely as part of the operator, I'll definitely be utilizing that skill soon. But I think, colleagues, good afternoon. As I stand here, it's both a privilege and honor to be a discussant in two of very thought-provoking papers. And I think perhaps to start with the first one, which is from one of the most important infrastructures that have probably brought us here from a cross-border perspective, because I think if you think about it, the genesis of connecting everybody from a cross-border perspective has merely been because of the existence of SWIFT. So I think the insight that they have in terms of how the dynamics play out from a cross-border perspective have played out in this paper. And I think one of the most compelling things that really brought joy when I looked at it was the fact that intra-Africa trade is increasing, right? The fact that we are trading more with each other, and you are able to see that from a SWIFT perspective. So certainly when I read that, I was overcame with a bit of joy, but a bit of caution too, because I think the data begins in 2021. The dynamics could be because of geopolitical things, or it could be because of the bottlenecks that we have seen from a COVID perspective, where perhaps because of bottlenecks in supply chains, people have moved away from sort of their traditional East and West and sort of started looking inwards where they've tried to find trade. Another important variable or another important factor that I think the paper from SWIFT plays out, and it's a valuable analytical advance, and I hope from a regulatory perspective, if there's anything that we take from this paper, is that when we speak about speed, it's important to segment it, right? Because speed differs depending on the vantage point and who you're speaking to. If you spoke to me as an RTGS operator about the speed of payments, I'll tell you the RTGS processes speed in a matter of seconds. But if you spoke to the customer on the ground, the reality is different. And if you looked at the end-to-end, the variation there, obviously, and the interplay between those two dynamics would have an impact. And my assumption and my assertion is that a payment is an experience, right? From a user perspective, obviously, safety and efficiency are important, but there are two things that I would always use to determine whether a payment stream is efficient, is how quickly I've made it and how much it costs. So I think it's important that we take that speed needs to be broken down in components to understand the nuances in different jurisdictions. And I think, as we've seen in Sub-Saharan Africa, some of the challenges that we're facing in speed is not in the RTGS systems, because RTGS systems exist, but the last leg is where we need work on. And my submission would be that the regulators need to look at that more, because the last mile is important for us to do. The third or the fourth one that I had a problem or really brought a bit of sadness is the fact that from a West Africa perspective, it seems we are leaving them behind, right? And I think we can appreciate that global imbalances or regional imbalances bring spillovers that are undesirable. That is the cost. If we are moving forward as a continent, we need to move forward together. The fact that West Africa is being left behind is something that I think we need to take a closer look at. Is it the existence or the absence of RTGS systems? Is it the absence of regional formations or regional arrangements from a payment perspective? It's something that I think the paper pointed out that we need to look at. So I think in a nutshell, to close off that point, I think tailored responses are very important. There are nuances in different regions that we need to speak to, and we need to understand, and I think that this paper articulates that quite frankly. The other one, and I think the governor or the DG spoke to this a bit earlier in his opening remarks, is that forex conversions are a friction, right? The fact that payments have to go through the United States or use the United States dollar as a reference creates an additional cost. And sometimes these costs that are then given to the beneficiary of that payment are hidden in this component. And we need to dissect that further. And if we are to advance payments in the African region, for me, the solution to this forex thing is absolutely critical. The other thing that I found quite intriguing about the paper is, I think when you look at cross-border payment is affected, but this challenge is that in that it shows us that in Africa you have less intermediaries, but the cost is not moving. So what is driving that cost is something that I think takes a particular thing. So I think in a nutshell, to speak on the paper from SWIFT, I think this presents opportunities for harmonization, particularly as far as it relates to things like extended operating hours, right, that you spoke to. Some people switch off their papers, and even in extending operating hours, from my experience, from a policy perspective, you can pronounce it, but the impact on systems is absolutely big, and we need to understand how that plays out. So the harmonization from our regulators is absolutely important. So I think, all in a nutshell, I think it was a very well paper. I thoroughly enjoyed reading it. I think it took a more qualitative route, and if anything, it made me ask more questions than it gave answers. So I think it really provides together and not look at the individual goals in a mutually exclusive way. I think the paper clearly outlines that in some of these things there is a trade-off, right? Sometimes you assume if you increase speed, cost will remain the same, and I think the paper does that beautifully by using empirical data to show that there's sometimes a trade-off, and that trade-off is something we need to be able to balance, right? And I think it does that by using a robust statistical source, using econometric model. But I think my caution with that econometric model is that it's important that when we build econometric models, we ensure, especially from a payment perspective, that the theory underlining that, or underpinning that, is absolutely robust, because I think economic theory and payment theory can sometimes have overlaps that you need to be aware of. And I think you would appreciate, if you are an analytical person, any econometric model has its flaws. And I think what you've done perfectly on the paper is admitted that some of the significance can be because of omitted variance bias. And I think some of the modeling and the results showed a bit of that. So it's important that when we build models, we underpin it with the correct theory. Important point that came out of this and was thought-provoking to me was the impact of fast payment systems, right, on remittances, and these fast payment systems being domestic. How implementing domestic fast payment system has spillover effects, or the assumption that it has spillover effects to the cost of payments in regionally. And I think it's a debate that has happened for a long time in academia as to, does economic development create robust and advanced financial systems, or do financial systems contribute to economic development? I think that's a debate that I certainly saw come out of this paper as to which one comes first. Is it the chicken or egg? And I think we need to dissect that further, and that's an opportunity. Another thing that I appreciated most reading the paper is that you clearly do speak to the fact that competition was an important thing in some of these jurisdictions, right? The existence of competition in the market structure and the availability of non-banks also contributed significantly to cost. So from a regulatory perspective, how do we ensure that the non-banks are given access? How do we ensure that the market structure is not against our goals and competition exists? Because these are things that we know reduce cost and price. So we should never deviate from those. Perhaps linking a bit to this paper on SWIFT, I think you do also in the paper accept that regulation, AML and CFT, from a last leg perspective, can act as barriers of entry, right? Banks are naturally de-risking from non-banks because they don't want them to bring things that are, or payments that would get them in trouble with the regulators. So how do we ensure that while we want to keep the safety and efficiency of our payment systems above standard, we don't indirectly create that as a barrier of entry? And I think what I liked also emanating from your paper is the introduction somewhat of stable coins and cryptocurrencies as a solution, but also accepting that they may be also creating fragmentation because they will be closed loop systems, which is an important policy consideration. And I think as I reflected on these technology, as I read most of the papers on stable coin, cryptocurrencies and distributed ledgers, I always ask myself if perhaps we should take a different perspective when we look at these technology. Traditionally, these technologies are looked at in the face of money, right, and how money is transforming. But I wonder if we need to bring our regulators closer to the opportunities, these things. How do we use decentralized technologies to streamline regulation compliance, right? AML, CFTs, where you've got trusted nodes around all the regulators, and you distribute the acceptance of the regulation. Are there opportunities in us distinguishing between the technology and the money aspect of the impact that this technology has? Is something that I think is worthwhile. So I think, in a nutshell, as far as it relates to your paper, I did find it, however, a bit intriguing that your paper says the existence of fast payment systems reduces cost. But if you looked at the SADC region, you've got fast payment systems in both South Africa and Zimbabwe, and the cost is one of the highest. So I think that was something that probably, taking it a bit home was worth looking at. But I accept that there may be nuances, but in a nutshell, I think it's been two lovely papers, and I think I did promise that our discussion was on speed, and I'll be right up to speed, so thank you.
Thank you very much for your contribution and for demonstrating that it is indeed possible to have a very interesting session during a so-called graveyard shift session. Everyone is wide awake. Yes. I'd like to now hand over to participants to ask questions. We're really short on time. I'm very conscious of that. But I see a gentleman there.
So I have two questions in mind, but in the interest of time, I'll just ask one. Alberto, if I understood your presentation correctly, you said there was an inverse relationship between speed and cost. Am I correct?
Yeah, an inverse relationship, yes. The higher the cost, yeah.
So I just wanted, I know this was not the focus of your paper. Are you able to maybe offer some explanation for this?
No, actually, it's not the main focus. So it's something that we found. But when we decided to investigate the topic of the cost, we thought of speed as one of the main determinants, because we think of speed sometimes as a value-added service to the remittance. If you want to get the fund faster, you have to pay, because of course it's riskier, etc. So that's why we inserted it in as a control factor, and then we saw this negative relationship that, as I said in the presentation, is something that, of course, is an issue, let me say, because of course we want to reduce the cost and enhance the speed at the same time, but the data seem to say something different. So of course we have to be conscious of this.
Thank you. If there's time, Mike, it's a quick question to you. Your data on the region, very interesting also. Was this data made available for the 2025 G20 annual progress report? Or?
So it's slightly different because the G20 progress report uses it's the same data set. It's only Q1 though of 2025, and it's only payments above 100,000 USD. So that's the distinction. So you can't directly compare them because it's a broader data set we used for this analysis.
Thank you.
One more question, please.
Thank you very much, Mike and Alberto. Very good presentations. Just, I think probably something underlying both papers is the issue of competition that you mentioned. Alberto, have you tried to control directly by competition to see, for example, this inverse relationship between speed and cost?
Can you speak louder? Because
no, have you tried to control directly for a variable that control for the competition of any monopolistic power that the banks may have? Just to tease out, probably, because if I read kind of Alberto's finding, that is kind of like you have no intermediary, only one intermediary in Sub-Saharan Africa, and that's probably, and you have a long lags, the speed is not as good. It could be that it's a competition issue, kind of like it's more costly because it's less competition, the speed is lower because there is no competition. So then my question would be for Alberto is probably you have is it any possible to see which banks are the intermediaries? Since probably you have the names, and see if you have a proxy of competition, or is kind of, we're talking about a very kind of like established relationship that somebody is having market power.
Okay, so no, we didn't control insert the variable for the number of operators directly in the model, but what I can say is that definitely there's something in this space, because if you remember, the relationship turns negative when we insert the firm control, so the firm fixed effects. So there's something in the data, probably somewhere there's an operator that has something related to the speed, and this drives a bit the results in the previous, but we will definitely, that's a good comment, and we'll definitely investigate it more. Thank you.
Two more questions from the floor, please. Selo and the lady in the lovely coat, you had a question? The red and... Yeah.
Thank you. Where I'm sitting right now, I kind of feel the issue of cost and speed, and I'm talking from a regulator perspective. It almost feels like we are fighting a losing battle. I'll tell you why. We know for a fact that the issue of cost, bulk of the cost is due to compliance, particularly at the beneficiary leg. A remitting institution will tell you they have to sanction, they have to vet, they have to report. It requires human intervention, and somebody must pay for this overhead. And that's the reason why bulk of this cost is so high. And as a regulator, you would consider streamlining and removing these restrictions. But on the other hand, if you try to solve for that, you have international regulatory authorities that will come and put you on a junk status to say you are now creating loopholes for AML and all of these things. So somehow you find as a regulator you are propelled to impose those rigid requirements of compliance because you need to comply, but on the other hand you are killing, the objective of alleviating this high cost. So, I don't know how we can maybe as a region, as a bloc, to find a way to balance solving the issue of cost and speed and yet comply, because we are also need to comply with the international standards. Thank you.
Very quickly. Just to let you know that there's a paper from the Fed, I don't remember, but I can give you the reference about the cost of compliance in remittances. I saw it in another conference. It uses the same data that I used. So if you're interested, that's quite a good paper from the Federal Reserve. I give you the reference later if you want, because I don't remind it. But just to quick.
Maybe I can add one thing from our analysis of those 40 markets that I mentioned earlier. We were looking at the frictions that were impacting speed. One of the biggest findings that we got out of that study was that actually compliance is not causing a friction in terms of speed. The contribution of speed is actually, and the reason why is because a lot of automation's gone into it. Yes, probably that cost a lot of money, but actually we see that cross-border speed is not impacted by compliance in particular. It's not having a significant effect. Cost is a different matter.
Thank you. Sadly, I would have loved to take another question, but it's not possible. We've run out of time. So I'd just like to thank the presenters and the discussant for their time. And I think the real policy consideration coming out of this session is how to improve on generating data sets, because data really is gold. It's what's fostered the discussions on the table today, and I think there's real need to improve quality, to improve the parameters, and to improve how they're accessed. So thank you all for this session, and hand over.
awesome discussion indeed, as seen by the number of questions that clearly are still lingering in the minds of the audience today. So we are now almost close to the end of our program, but we will not do this program justice if we do not reflect on a discussion about the importance of trust and transparency and essentially leveraging payments, pre-validation, and confirmation of pay-use solutions. So for that, we do have Thomas Lama, who is the Deputy Head of the BIS CPMI Secretariat, and he will be moderating this very key conversation. Thomas.
Thank you so much, Mavis, and welcome to the final panel of the first conference day. And from the hard facts of cost and speed, we are now coming to the soft factors of trust and transparency. And before I start, let me thank the G20 presidency and the South African Reserve Bank for inviting us to co-organize this conference as a CPMI, and we really very much looking forward to the outcomes of this event and will feed it into our ongoing work. So it's my utmost pleasure to moderate this panel of distinguished speakers, and I'd like to welcome those that are here in person to just join me on the stage so that I don't feel that alone. And let me briefly introduce them in alphabetical order. First to join me is Olivier Lenz. He is head of Sub-Saharan Africa at SWIFT, with over a decade of experience at SWIFT and another decade in Euroclear. Then I'll be joined by Israel Skosana, who is Chief Product and Scheme Officer at Pay Inc. Until recently, I think, Bank South Africa. And welcome, Israel. Israel has 2 decades of experience in payments and finance. Welcome, Israel. And finally, on the stage, we have Richard Thalpay. He's head of payments and payments as a service at Absa Bank. And he has over 3 decades of experience in banking and payments. And finally, I'm very pleased that last but definitely not least, I'm able to introduce Gloria Wan, who's joining us from, I guess, Singapore, so it's already fairly late for you. Thanks for staying up for us. Gloria is the Executive Director and Head of Kinexys Link by JP Morgan and has over 10 years of experience at JP Morgan. So welcome, Gloria. So if you have done the math, then we have combined over 80 years of experience on payments and finance on this stage. So I think that's going to be an exciting and exceptional panel. While I've asked the panelists not to share any slides, I'll take the privilege as a moderator to briefly flash one photo I've taken this morning. Let's see whether I'm asking too much from the tech support. But if it works, then you should see that lovely picture here, which I took this morning. So when I entered the taxi this morning, the driver asked whether I'm up to a shortcut. So he has a kind of a different route he want to take to bring me to the SARP. And I said, well, why not? Let's give it a try. So we went down the hill, came across these lovely zebras, and in total there were 5 of them. I think I captured 3 or 4 here. And we went down the hill, and I was really kind of congratulating myself what a great choice I've made to kind of agree to the shortcut. Little did I know that we will end up at an unattended locked gate. So we went back up the hill, passed by a second time these lovely zebras. I could enjoy them another time, and went the detour, and finally I ended up with a little delay at the SARP head office here. But it was a very nice experience to me. But I thought, well, what a nice analogy in terms of payments. How often is a payment sent only to find out at the very end that the account is closed, or that the recipient, for example, might be a different person than it's supposed to be. Unlike my experience with the zebras, that often comes with costs, a lot of effort, a lot of hardship for those that are sending the payments, and definitely the delay will be longer than the 15 to 20 minutes that I have faced this morning. So with that, let's try to sort out all, or at least many of these problems before money moves. Let's try to find a way to validate the payments and try to sort out many of these issues before we send the payment on its journey and hope that it'll arrive. With that, I'll kind of like to kind of ask my panel to reflect on those aspects as we go forward. But given that we have an experience of 80 plus years here in this panel, I'd still try to kind of start with a more open-ended question in terms of what is it that you think is important, a key enabling factor for enhancing cross-border payments, be it in Sub-Saharan Africa or more globally, before we kind of dive into the concept of pre-validation. Since it's Gloria who's kind of, for her it's already very late, so Gloria, why don't you give it a start from Singapore? Let's see whether technology works. Gloria?
Hello, can you hear me fine?
Yes, we can hear you now. Perfect. Thank you. Over to you.
Excellent. It is always tricky when you're the only one with the face on the screen with everybody else in the room. So hopefully the connectivity will stay on as we continue the session. And thanks so much, Thomas, for opening the session and then allowing us to share our view on the panel as well. In terms of the key enablers, I think the key challenges we're trying to address in the cross-border payment space are very well summarized by the G20 goals. And it's really coming down to the cost, the speed, the transparency, and accessibility. And if we're looking at the key drivers for payment innovation in the past couple of years, it's pretty much well aligned. But I think the summary of the last session very well led to this discussion. It's important for us to remember that when we're talking about cross-border payments and making them more efficient and more user-friendly, more transparent, improving the actual value movement is only half of the story. The problem with cross-border payment is about exceptions and managing the risks and inefficiencies through real-time data transparency, data exchange to address these exceptions is just as important, if not more. And coming back to the 4 pillars that I've mentioned, when it comes to cost reductions, we have definitely in the past couple of years seen the biggest pressure in the retail and remittance payment space, right? When it comes to cross-border or cross-currency payments, leveraging data to help address these costs across various different use cases has been a big focus. The speed of clearing and settlement is a push and pull factor. We have seen obviously a lot of development efforts from financial institutions, but also taking a step back and looking at in today's fast-paced digital world, consumers are expecting immediate access to goods, services, and funds. And with the likes of e-commerce and on-demand services, this means financial institutions who are supporting the underlying value movement also needs to enhance instant payment solutions, allowing payments to complete immediately, almost atomically, after completing an economic activities. And with the likes of e-commerce and platforms, geographic borders of these payments are getting blurred as well. Now, the infrastructure development like real-time payments have really leaped forward across the globe in the past couple of years, and there are plenty of examples to cite in the Sub-Saharan Africa region. The third point, which I think is going to be the key discussion for this entire session, is around payment safety and security. While real-time payment system has demonstrated very strong benefits, the flip side of the coin is as money moves faster and larger sum of money is being put on real-time rails, the risk of misdirected payments and fraudulent payments are becoming a real focus. And here we have seen various regulators starting to pick up the signals and rolling out confirmation payees, right? The likes of UK who did this first as a mandatory requirement for all of the banks who are participating in local real-time payment systems to roll out pre-validation services to their underlying retail and corporate customers for free of charge. And then we've seen that followed by EU verification of payee earlier this month that went live, and Australia confirmation payee, and a couple of other examples. And we're seeing more regulators starting engaging conversations with industry players to understand how they can embed these type of requirements. And finally, and it's also very important to note, the fourth point, which is also a key driver that I have seen in a lot of the innovation efforts, is around flexibility and customization in payments management and liquidity management. We've seen this mainly started in more of a wholesale payment flow. As the expansion of international trade, greater mobility, the connectivity of SMEs to broader sets of global markets became a big push. But as time passes on, flexibility is also starting to come in the sense of going beyond traditional payment rails and bank accounts. Real-time payments in many jurisdictions goes beyond just bank account-based payments and now start leveraging new identifiers such as social media accounts, emails, mobiles, alias to further integrate value movements as part of the existing user journey. And then we've seen alternative payment methods coming out, the likes of digital wallet, blockchain, stablecoin, deposit tokens, you name it. Everything ranging from new account structure to new rails to new payment instruments beyond fiat currencies. So how do we think about building trust and safety as these new payment rails and these new payment behaviors come around? And what are the new data sets that we need to unlock to start providing the same level, if not better, transparencies as money move differently? I think that has been a big focus for us, while building and catching up on providing better data connectivity, real-time data access for existing traditional payment rails.
Thank you. Thank you so much, Gloria. From a kind of continental perspective, Richard, if I may, do you want to add something from the Sub-Saharan African perspective, from the perspective of a bank with a large footprint on the continent?
Yeah, I mean, I think one of the advantages of coming in last in a long day is that a lot of this stuff has already been covered. I think we know that harmonization of regulation about infrastructure development and interoperability and a whole lot of different things are in play. But I might take a slightly different perspective in terms of where we're going in terms of what really enables this. And I think, you know, one of the things that is very obvious to me is that cross-border payments is an extremely complex. There's non-harmonization. It's not fully implementation. We've got variable education. There are so many, there's formal, informal, whatever we may want to kind of talk about in those spaces. And it actually kind of triggered a thought around, for those who have studied management theory, of the Cuneiform framework, that we sit in the sector which is complex. And the Cuneiform theory just very quickly puts you different responses depending what your environment looks like. If it's simple, if it's complicated, if it's complex or it's chaotic. And complex by definition basically means that the relationship between cause and effect can only be perceived with hindsight. And I think we live in that world in terms of where we're going. And what does that really mean to all of us as we're going? I mean, typically in a management theory, you would probe it or test it, you would sense it, you'd measure what comes back, and then you would respond in the right kind of ways. And I think we're in that space, and there is a lot of data, although it's not complete at the moment. And that kind of means that you eat the elephant one bite at a time. You cannot do this as one big system to change the entire world. We've got to kind of be fairly clear about that. So that really means, in my mind, that one of the real enablers is collaboration, cooperation, with a real bias towards action and learning. We've got to kind of move. We've got to move with cooperative parties. solve one corridor at a time, if that's what we're talking about, or at least make progress in terms of some of those things, and move in that kind of space. The other thing which has come across quite strongly today as well is risk-based. I think we've learned a lot in risk-based type of things. And a lot of the problems which have been displayed and researched today really doesn't talk about high-risk environments. It's talking about very low-value payments between families that we now apply a whole span of regulation and complexity to, which just slows it down and lifts the cost of all of those type of things. So I do think we've got to think about risk-based. I do think that we've got to think about action and learning, but in a very cooperative and collaborative environment as key enablers taking us forward.
Thank you so much, Richard. And it's already the second elephant that is being eaten today, I guess. Barbara also mentioned an elephant. So you also mentioned the infrastructure, and kind of let's move on to Israel, kind of providing important kind of infrastructure in the region. So from the infrastructure perspective, what would you see as the key enablers for enhanced cross-border payments?
Thank you, Thomas. The key thing that we're noticing is that there's a wave of change occurring at this point in time, not only from a technology front, but also in terms of how we put in customers in the center of our solutions. So that consumer lens, linking to what Richard said, is that we're now aware of those hurdles of doing the ease of transaction. We need to make sure that it's now not just on the fintech side that's solving for it for the last mile, but also part of the infrastructure side as well as then the regulatory side. So if anything, it's a mindset change that's taking place to say, how do we make sure that we understand those consumer journeys, we understand those use cases, and we make sure that we have the infrastructure that enables it. We have the regulation that enables and protects, and at the same time, obviously provide that last mile to make sure that the ease of payment takes place.
Thank you so much. And from your perspective, Olivier, do you have anything to add to what Mike already before said, or is it something where you kind of are fully in line with Mike?
First of all, I think the guys on stage saw my notes, so I must have left them somewhere because I was thinking about saying all of that. Look, I also want to be positive in a way. We can look at what's not going well, but we've come a long way, to be very honest. We really come a long way. So I also want to bring a positive note at the end of the day, and there's still loads to be done, but that's good. That's why we're all here in the room, and that's why people are looking to this video. So I also want to change a bit the thinking as it's negative. No, there's a lot that has been done. Yes, we need more data, but we do get more transparency. If I look on the SWIFT side, to Mike's point, we can track any and every payment. Of course, we need to expand that. Okay, this is not about SWIFT. It's about expanding. This is when we talk about interoperability. It's not only about connecting systems to each other, but it's also creating transparency beyond our own system. So things are moving. Now, the results are not there yet. Now, maybe we are optimistic when it comes to the G20. On the other hand, I do believe that we need to stretch ourselves. So I'm fully aligned. Since we have the G20 targets, the discussion has changed. The discussion has become more important. Now, and that's why I'm saying, Richard, you stole my notes because my point was going to be exactly the same. We need to do it step by step. This is complex. This is not something that we're going to solve overnight. We need to do it step by step, keep in mind the end consumer and what it's going to mean for that end consumer, because ultimately that's the one we're serving, whether that's from an inclusive perspective, whether it's from a commercial perspective. And I think these things can go hand in hand. So my opinion is very much as we look at this, let's break it down. And yes, we can look at speed, and we can look at speed of the last mile. And also there, if I can add something to Mike, there's not one culprit. There's not one player that is responsible for that speed. I can bring 10 reasons why speed is reducing, and it's not one player or one instance that's going to solve it. So this might sound very cheesy, but you said it. Collaboration and cooperation is the only way forward. But it also means that as an industry, we agree which are those key priorities that we want to tackle first. Okay? Which are those key priorities that have an impact on the end consumer. So I think that is a debate that we're not having yet at the moment. I think we're still kind of framing it. We say we don't have data. I think we do have we start to have quite some data. We do need to move to what could have now an impact, and it's realistic that we as an industry, and it's not only about South Africa. You know, this is not about South Africa. This is not about Sub-Saharan Africa. This is a broader problem because Sub-Saharan Africa can be the best in class tomorrow, which I'm sure it will be at a certain point. But if the others are not going to follow, we're not going to reap the benefit at a cross-border perspective. So this is a broader thing. So if we're not going to slice the zebra, elephant, then we're not going to go nowhere, and we're going to remain in very much theoretical discussions, and we need to go beyond that. So that's what I wanted to add.
Thanks, Olivier. And let me stick with you so that you have the first-comer advantage, first-mover advantage for the second round. So let's zoom into payments pre-validation. It came through some of the responses that we had, particularly, for example, Gloria also referred to it, the importance of kind of trust and transparency in the end. And how can payment pre-validation help to reduce the frictions that we are currently facing? So is there something in the overall kind of concept that can really help us to address some of the issues we are struggling with? And so let's start with you, Olivier.
Yeah. So yeah, you made the analogy, and yes, sometimes we drive and we need to turn around. It happened to me as well. But actually, you said a lot in your opening by saying that. When we talk about pre-validation or VOP or COP, there's different names, and it covers different payloads. But ultimately, the idea is that we go and check whether the payment we're going to do reference to the beneficiary. And by doing that, we avoid that the payment is going to leave and never is going to arrive. And if it's never arriving, then we can go. I started my career in operations 25 years ago. Then you're going to try to find your payment, and at a certain point, it's going to come back. And then it goes into a payment queue. I don't know who started in operations, but when you start looking in the payment queue when I was young, you spend a lot of time, you did a lot of calls to get that. So what happens is that if that payment doesn't settle or doesn't find the right account, you break up STP. When you break up STP, very simple, we're all in banking, then you've got somebody who's going to have to look at it with everything that comes with it. That person might be fast, might be slow, you don't know. Ultimately, somebody at the other end is waiting for that payment. That's one thing. The other thing is, it also has a cost. So we talk about cost, we talk about speed. I was also a bit confused to see that there's no correlation between speed and cost, but actually, if your payment details are not correct and they don't arrive, then somebody's going to wait and somebody's going to pay a price for it, because actually what we see in the industry, and again, for good reasons, because if somebody else on the other side also has to do a manual operation to say, hey, I received this payment, what do we do with it? So what we see is that cost per failed instruction is around $50 to $100 US. Don't quote me on it, but at least from my time when not 25, but 20 years ago, that's what we would charge in the industry. So this may be old data. If we look at SWIFT data, and again, I don't think this is the newest data, and there's already a lot of data that's been put forward in equations. So again, I don't want to bore you with it, but if you look at failed instructions purely based on wrong account details, at a certain point, but this is all data, so don't quote me on it. I think we were looking at 20% of all failed instructions are failing because of wrong account details, incorrect payment account details. So this is significant. We estimated at that time that the impact was around 2 billion cost for the industry. If we start to pre-validate, if we start to check names and all of that, we can take that burden away, which is a burden for everybody in the chain, and ultimately the end consumer is paying the price for it. So I think let me leave it at that, and I hope I didn't steal your notes, guys.
Let me quickly follow up. Correct me if you think I'm wrong, but I'd say kind of pre-validation is possible on traditional ways, if I may refer to SWIFT as traditional ways. So it's something that is already happening or possible technically.
Look, there is a complexity to it, okay? I think when we talk about the concept of pre-validation, it's, as far as I'm concerned, it's a no-brainer. Does it mean that, yes, we can do it on any rail, but does it mean that we can scale it? That's a different discussion. So clearly, from a SWIFT perspective, we can pre-validate, and we're not the only ones. Others do it in the industry for very good reasons. Are we scaling it? That's a different discussion. But pre-validation is very possible today on a SWIFT network, or probably on any other network. And I know from an instant payments perspective, this is happening already. If you look at SEPA in Europe, It was said this is being implemented, so it is possible. There is a level of complexity, unfortunately, when you bring it to the cross-border perspective. And that is also a reality, and maybe we want to go into that later.
Let's wait with the kind of complexities for the next round, and let's continue with the kind of positive examples. And I was referring to more traditional rails. In my understanding, Gloria, if I can go back to you, your solution is kind of more about TLT, blockchain technologies. Would that be right? And where do you see the advantage of those compared to more traditional solutions?
Yeah, I mean, for us, we started this whole experiment just to give everybody the context. Also, just from traditional cross-border payments. We did a piece of analysis around 6-7 years ago, looking at all of the challenges we are seeing in cross-border payment space, and then backing them into things and use cases, data structures that can be solved by more efficient direct connectivities. Obviously, on the blockchain infrastructure, there's that added layer of privacy preserving component to that, which then we can come into a little bit later, why it has some critical thinking in terms of how you share data in a way that allows the data sovereignty, the data privacy, and data security remain consistent across the network as different participants plugging in. But I wouldn't say blockchain technology is the necessity in this setting. I think in this setting, the most important concept is the network infrastructure, the common rule books, and then the single sets of data definitions, right? I think Olivia mentioned around like scaling these type of solutions globally is extremely difficult. And being able to bring different data points onto the network, onto your end consumers in a consistent experience has been the big efforts that we have been going on in the past couple of years.
Thank you very much. From a paying perspective, what do you see as the potential of pre-validation or confirmation of P?
So from a paying perspective, it answers the question around trust. So we don't see trust as the outcome of payments, but rather the foundation for payments to take place. In saying so, that pre-validation allows for certainty to occur, understanding that the recipient is who I want to pay. And once again, if we continue that train of thought around putting the consumer in the center, be it a corporate, an SME, or an individual, it says that certainty provides me with a sense of confidence that this payment will be successful. Thus, I don't need to now do a reversal in the event that I've sent it to the wrong and cause that uncertainty, the admin associated and the likes. The second part to it is also what are we competing against other payment instruments? And let's use cash as an example. That cash gives you that certainty for that payment. But now if you have this pre-validation place, it gives confidence in digital payments, confidence in digital channels, and says I'm able to provide the service ultimately in the funds to the recipient at the end of the day. And that's the essence of it. It's always going back to the customer centricity about, and from an economic perspective, obviously a reduction in costs by not having cash utilization, reduction in not having that administrative cost through that pre-validation. So if anything, pre-validation is an enabler for that trust component.
Thanks. And then, Richard, from an ABSA perspective, would your customers kind of be interested in using pre-validation, or you as a bank, what benefits do you see in it?
Yeah, I mean, I think to some extent pre-validation is done today. But very, very clearly, the benefits of pre-validation are super clear. So I think it's been covered to a certain extent, but the certainty that you're not going to get a return payment is a huge benefit for any customer and for a bank, because anything that starts generating return payments is causing anxiety, it's causing friction, it's causing cost, it's causing speed or time issues which are coming through. Pre-validation gives certainty and ease in reconciliation. So obviously it's very clear for customers. It improves speed and efficiency. I think we've covered it. It's supporting compliance and risk. People know that they're in a much safer environment. It improves predictability of payments. So it's as a concept, it's really, really attractive. You know, if anyone has spent any kind of time in cross-border payments operations will know of concept called fit for processing at any one time. And that's actually doing a whole lot of validations around the payment before you send it. It is pre-validation to a point, but it's not perfect because the data sets are not totally transparent, and therefore you end up in a situation where things can still get returned and what have you. So you do best efforts to a particular point, and hopefully the payment is straight through thereafter. But it's actually in this pre-validation piece that a lot of the friction actually does happen. It's where you're dealing with the regulatory issues, the compliant issues, etc., on those type of things. And a real strong focus on that. If you could get higher levels of certainty, you'd probably get better investment and better innovation around it as well.
Possibly with the benefit that all these kind of challenges, and let's kind of continue in the next round with the challenges, but they are kind of possibly, hopefully sorted out before the money moves or before the money kind of goes down the transaction chain. So I think there's a kind of broad agreement on this panel that there are a lot of advantages that come with payment pre-validation and confirmation of P specifically. So if this is so beneficial, why haven't we seen it, particularly in cross-border payments, being deployed more broadly? So what are the challenges? And let's kind of stick with you, Richard. I want to give it a first go, and I'm afraid that it'll be rather towards the end, Olivier.
Yeah, I mean, I think the first point, I suppose, is about data and data validation, data privacy. There's only so much that what you're doing effectively with a cross-border payment, you're sending it to another party where you don't have their details. You've been told by the payer what their details are. Validating it means sharing of information. So the first piece comes around kind of data privacy, localization laws, depending on how different jurisdictions deal with data privacy. So solving the data sharing kind of issue is probably a massive piece. Obviously, fragmented regulatory frameworks plays into this. Each country has its own KYC and AML laws and all the rest of it. It does put friction into play, and there's an asymmetry in terms of the validation you can really do. If you kind of take it away from just the banking infrastructure and think of kind of the non-bank entities, the fintech type of environments, sometimes licensing and access restrictions kind of play in there as well. Are they full participants? Do they have to go through another party, etc.? So they're also probably a step back from even where you're getting into the data sharing kind of space. You have other technical kind of barriers which play out over here. Lack of interoperable infrastructure, shifting between real-time payments, instant domestic payment schemes, and cross-border. Those all bring a complexity to it. And just a practical issue is legacy systems. There are so many legacy systems played out across the world which have less accessibility to them, less ease of data flow and message flow, etc., which play out in there. And then, inconsistent data standards on a more operational basis. There's also maybe limited incentives to banks, even in domestic payments where you talk about account verification services, etc. Often a non-chargeable item. What's the incentive, the commercial incentive to put all of these type of things around it? It does. There's obviously efficiency benefits for the bank itself, but it's quite difficult to make these commercial models work in some ways. And I'm talking kind of a bank perspective, but I guess the same situation sits in the fintech type of environments, those are probably some of the kind of broader thematics that I would put around it. A lot around data. You're probably going to hear quite a lot around making sure incentives work across the chain in making cross-border payments work collectively. It's you're getting all of the parties to play, and by nature this is a collaborative environment. It has to be. There's so many different parties playing in the chain. Making sure that everyone is incentivized to get that right is a big issue.
You were referring also to kind of legacy systems. Do you mean more the bank's back office systems, or there's infrastructures in the middle?
Both. So I think you've got that. The banking industry has obviously grown up over hundreds of years, and you've got varying levels in that. But so has the financial market infrastructure. that there are, differences, RTGS systems, I think we heard earlier today, the big need to start to lift that and to modernize that environment. I know in South Africa, we're going through a big modernization exercise across the chain. So you've got legacy problems, I guess, everywhere. And each country is going to be in a different part of their development cycle. And we are by nature talking cross-border, so it's different countries which are playing out and different organizations. So legacy is going to play across the chain.
Israel, I assume bank is not one of these legacy systems. What's your view? What kind of challenges do you see as kind of in employing or deploying and adopting pre-validation?
Thanks, Thomas. Definitely also share the same view in terms of those constraints. From a technology front, obviously significant modernization taking place within the paying environment for the South African context, but it shows the importance of regional coordination. And this is where the central banks coming together to say we are going to have a regional focus to make sure that there is the ease of payments. Also satisfies the question around creating an enabling environment for cross-border payments to take place. And to Richard's point, also create commercial incentives that say participants want to be involved in providing that services. And that varies obviously from the likes of MNOs, banks, and fintechs to see how they can play a role in there. So we do see it as an opportunity for all participants to collaborate in some way or form, but get the foundation to be standardized. We obviously look at the ISO standard 222 to see what's the opportunity there, and if that can be in place across multiple jurisdictions, it already is a quick win. We just need to ensure that the regulators, central banks, enable that environment for commercial success to take place, which ultimately results in societal success to take place within the region. So clear incentive, but it's only possible with regulatory leadership to achieve that.
That's a perfect segue. You mentioned ISO 20022. So Olivier, from a SWIFT perspective, but also from a global perspective, what challenges do you see? I mean, SWIFT is also offering payment pre-validation as a service. What do you see in adoption challenges here?
Yeah, I think as we started, everybody says it's a no-brainer to do pre-validation, and then if it's a no-brainer, you think if it's a no-brainer, then let's all just sit in a circle and we just start doing it. And actually, the reality is not that it is. And I think that both of you kind of put a lot of hurdles forward. And I don't think I want to repeat them, but yes, there needs to be a standardized framework, which. Again, let's be honest. There's already a lot of pre-validation that happens at domestic level, whether it's an instant payment scheme, but there's a lot of countries who do pre-validate payments, and it might even be outsourced to independent players who provide that service. It might be central players who provide that service. Now, if you start looking at all of these models, they're all very different. The data frameworks are very different. If you look at ISO, for example, in ISO, if you want to validate the name, it's one field. Sean, correct me, 104. You're not going to correct me. If you look at a lot of domestic frameworks, it's 4 fields. So now that's where very stupidly the problem starts. So scaling it, and this is purely technically and operationally, we're not even talking about the data privacy, we're not even talking about that, is not a simple thing. So yes, somebody needs to stand up and say, this is how we validate. Yes, I believe there's regulatory involvement, but we also started saying, Rita, you said it, we just need to make sure we don't get the oil out of the system, because we do need to continue. So that collaboration perspective is going to be super important. They're doing it in Europe, so it's possible. They're making it happen, and I made a payment lately in Belgium, and I put an account number and I get the green tick, and I knew the green tick was my payment is validated, and it's very reassuring. And I made the payment, and it's very reassuring. Now we need to scale it, but again, I also believe that we should not boil the ocean. Does it mean that we need to agree as Africa on one thing? It's going to be very difficult. Okay? Can we bring it to regional agreement, SSA, for example, Sub-Saharan Africa? Why not? It should be possible because we all have the same intent. So yes, there's a lot of hurdles, But I think there is a commercial gain. There is a benefit for the end consumer. There's a benefit for the banks. I think we should be able to translate it into something that is doable, but there's still a lot of work to be done.
Thank you. And before I give the floor to Gloria, who is hopefully still with us, in the next round I'll kind of field 2 or 3 questions from the audience. So get ready if you want to ask a question. But Gloria, glad that you're still with us. What's your view on the challenges from a Kinex's perspective?
I wanted to share a little bit of the positive sense as well. I totally recognize all of the challenges everybody has brought on, and I've been on that journey for the past 5, 6 years. I know all of them by heart. But take an example. Right now, I see these validations happening on a cross-border basis every day. I've seen banks starting to roll out these to their underlying clients, despite there isn't a regulatory requirement for them to do so. And I've seen that speed of acceleration and adoption start to creating that network effects. Right now, participants on the Link network can validate 45 markets globally in real time. And these are various market infrastructures, banks coming onto the network, contributing to data to other banks or other use cases. On the other hand, right, for the first 2-3 years, we've spent huge amount of effort educating institutions why pre-validation is beneficial. And trust me, that wasn't taken for granted. That wasn't those kind of validation point that all of the panelists shared on the stage was not the response we got when we first started. But I definitely echo nowadays, when we go speak to an institution, there's never question of the benefits. And in turn, the tide is turning. Like, they are coming up with their own use cases. We have corporates and providers coming on and say, actually, we started seeing benefits of validating payrolls. Like, all of our vendor master data, we need to be regular on a quarterly basis doing hygiene scrubs for fraud prevention, for risk controls. Like, these use cases are being developed. The market is reacting. So then back to the point around it, while it's challenging, it is also a journey that we're also going to get on together, right? Is it one step at a time? We start building demand, we're starting having supply, we start matching them together, and slowly there is more incentive. And that's kind of what we've seen as well. Like, the commercial incentives start building on as there are more demand and then there's more supply. I do wanted to stress that slightly different from some of the other schemes or providers, we've also thought about these type of validation, these type of data exchange as an opportunity for banks to unlock new revenue streams. And that was one of the early enablers for the likes of banks to start opening up their data, to invest into resources to look at legal and compliance impact analysis. And I do think that is a very, very important point that all of the panelists has mentioned, like, hey, what is the right commercial incentives? Because a soft approach of some operational gains oftentimes won't get us there. Like, we really do need to think through, is this going to be a top-down regulatory requirements like the one that EU has put forward, or this is a true commercial incentive that has been protected, vetted through by local regulator and say, hey, I actually permit, this is a permitted data use for fraud preventions, for promoting better and safer cross-border payments or regional payments. And then there is the right commercial model being overlaid on top of these type of data sharing for pre-validations in order for the banks and other institutions to start putting resources behind it. Because it hasn't been a straightforward journey, and we've only at the start of it. But I think it's the time to start accelerating it. There are plenty of models, there are plenty of examples across the globe that we can take into considerations, whether it is for banks to start thinking about new services and new operational process to be rolling out to their clients, or for policymakers to start thinking about, hey, what are the right way of putting the right level of guardrail to help institutions to take that first step forward. Either it is embedding data into their client journey or start sharing data to help promote these type of safety and trust like mechanisms to build out.
Thanks so much, Gloria. And Olivier, you want to react?
Yeah, I also wanted to react positively because I think ultimately, the benefit can be way bigger than us individually doing pre-validation. If you think about technology, and we didn't talk much about it, but if you think about AI and federated learning, if we start to pre-validate and we don't do that in closed loops, and we can use the learnings that we have, not on an individual basis, but open it up to everybody, then we're in a different ballgame. So for me, this is a first step in something that could be way bigger and much more efficient, so that we don't each have to call and do an individual action. But if we get a federated learning, and I think Swift as a cooperative is working on that, if we can get federated learning on top of that, we can start sharing knowledge from each other to the benefit of all of our end customers. So actually, the first step is pre-validating individually. The second step is to create a bigger good out of it, which then comes to the ultimately compliance, cybersecurity, and so on. So for me, that is the ultimate goal that we as an industry should have, and that actually is not that much of a competitive space, to be very honest.
Thank you. So let me see, we have a question here. Let's kind of 2 or 3 questions, given where we are in time. So Arthur, the questions, and the lady away.
Okay, so this is not intended to denigrate what we're doing. It's very important that we're doing, but we are shooting fish in a barrel at the moment with what we're doing. So if we look at the pre-validation and everything, that's very important that we do it. Are we going to lose some of the cross-border payments because of the not having an ID, not having the correct ID? As was said earlier today, that it's very difficult to actually do KYC on some people. Are we going to lose some people that's currently in the market in the cross-border payments environment? And how are we going to be able to bring in do financial inclusion for people who are not currently in this environment right now? So are we building too complex systems that's going to end up excluding people more and more? And how do we protect and bring in people?
Thank you. Let's take Arthur's question. So just for the benefit of our online viewers, Arthur was asking about the role of global identifiers like the LEI and whether or not that can help, I guess, in pre-validation, if I summarize the question correctly. Who wants to go first on either of the 2 questions?
Happy to start off, especially in terms of those barriers you talk about around complexity that actually inhibits participation from participants such as banks, fintechs, and so on, but also ultimately the service in society as consumers at the end of the day. And that is why, from an infrastructure provider perspective, we're saying that the conversation needs to start with those use cases to understand how consumers will consume these products at the end of the day and services. In saying so, it means that we need to make sure that we understand all those barriers and all those hurdles and see what can be done to simplify it as much as possible, and that we also talk about regulation, collaboration taking place with multiple partners, but to make sure that then the service is available to all. And a big driver for that is around financial inclusion. So we have to deal with some reality, which is the data, and in some cases your example of not having an ID document, but also work within the laws of the land at that point in time and across multiple jurisdictions. And that's why this is a complex matter, but it's the minds that are around the table, the leadership from regulators to say we want to solve this. And how can we solve it? Is by identifying all those hurdles and then saying what are the mitigating actions against us. The tech is one part, and we'll get into fancy tech conversations now, but it's only one component to say what is the real enabler for this, and that needs to make sure that we understand what are those barriers at the end of the day. Richard wants to.
Yeah, I mean, I think there's a couple of things. I think it's unquestionable that pre-validation is incredibly desirable to smooth the wheels of of payment flows. But it goes back to the previous little piece around being sure that we have a risk-based approach as well. You know, and you can't group them all, although we tend to in some ways, into one bucket. You do have remittances, very low value remittances. You've got low value retail payments, but those kind of vary quite highly. You've got wholesale payments, etc. I mean, on the big wholesale payments, etc., pre-validation would make an enormous difference to playing that out. And a lot of the retail payments, which is bank to bank, you could probably get there as well. But you've got to be thinking risk-based approach in remittances, and how you start to really include at a much bigger level. And hopefully, through building data, etc., it becomes a little bit easier over time. Maybe, Arthur, to your question around things as well, I mean, obviously standards help. Part of the reason that we battle with this is because there aren't really global standards around it. ISO is probably starting to help in terms of some of the perspectives, but in terms of solutioning it, we're going to need to really think about standards. Otherwise, it becomes so expensive to do it on a just bilateral basis everywhere, or bases everywhere, that you're probably going to run into issues. But clearly, standards will help.
Now, maybe very quickly, and I think it's a very fair question, and I think when we increase efficiency in cross-border payments, it should not create exclusion. It should not. That should be two different things. I think in the world that we are, we can create further efficiency, and we need to further increase inclusion. And those two things can go together. And one can think, and I'm just thinking out loud, that you validate a phone number. Okay, so there's different things that you can do to foster that inclusion, but efficiency should not reduce exclusion, because then we're doing the wrong thing, and ultimately that this is not where we want to go. So I think it's a fair point, and we need to keep an eye on that we don't put measures in that benefit a few. Yeah, but I think if we talk about pre-validation, the benefit is way bigger, and is much more significant. And I think, Arthur, obvious, if we can further increase and identify people, and we can standardize that, that's the way to go. So I think that is a no-brainer. We're putting ISO into the market. ISO will allow us already to get more information and more data to reduce some of those last-mile issues. Then identification beyond big codes and all that. Yes, if we can move the needle, we should.
Thank you very much. Very quickly, Gloria, any final thoughts from your side?
Yeah, absolutely. I think it's an interesting point around financial inclusion. Like, I think the whole point around pre-validation is expanding the variation of various different payment rails coming up. And we still have a lot of opportunities to define what that experience would look like for some of the newer payment rails. But we got to establish the foundation, build the right education and the customer behaviors, without sacrificing the safety point of that. Like, I couldn't stress more in the past 18 to 24 months, the amount of fraud pressure that we're seeing across the global basis, across all type of payment flows, it's definitely increasing to the point that is turning the tide. Like, if we're building pre-validation for operational efficiency, cost reduction, like, that's definitely not the focus. Right now, most of the institutions coming to us developing these solutions because fraud controls, regardless that's retail, their retail customer base or their corporate customer base. So I don't think we should ever sacrificing. It's about finding the right balance. It's also about implementing this the right way. Like, a lot of the institutions implementing this as a value add. Like, we're not at the stage where we have almost 100% like data coverage. The data quality is a journey that we're going to be on for a long time. So we wouldn't be assuming that like we're excluding certain populations or certain types just because we started building these type of best practices in the market. In terms of identifier, absolutely. We're starting to see very clear market indication in the wholesale space, high value, that identifier is a much more preferred way for validating versus beneficiary names. Most of the more sophisticated players are coming to us and say, how can we help promote better adoption of LEI, and then validating LEI because it's finite, it's binary. There is no gray areas, especially for some of these type of risk management fraud use cases. So we're also working with a lot of the industry players and say, how can we embed these type of digital identity identifiers, these type of standards into pre-validations, almost as an enabler for further adoptions for other types of use cases.
Thank you so much, and thank you for staying with us despite the late hour at your end. So let me just quickly wrap up with, I think trust kind of is coming back right from the beginning of the discussion, because I think also trust is important. Trust in financial services and digital financial services can also foster financial inclusion. So I think let me conclude with a saying that trust arrives on foot and leaves on a horseback, or in our case on a zebra back, if I kind of can circle back to my opening. So from that point of view, let's try to build, increase the trust via pre-validation. I think that will go a long way in enhancing cross-border payments. With that, let me please join me in thanking our distinguished panelists for their very useful insights, and the organizing team from SAB around Arif, Mavis, Kyle, and of course Darren, who have made this first day so successful. Thank you so much.
All right, colleagues, I know I'm standing between you and some much needed liquidity, but I think we will not do the day justice if we do not receive some key closing remarks from our former head of the National Payment System Department, Tim Masela, who has been steering a lot of engagements and work and initiatives over the past years aimed to integrate payments, not just within the country or SADC, but Africa at large. So colleagues, Tim Masela.
Thanks, Mavis, and I'm glad that most of you are still here, and I only have 5 minutes to try and just make some reflections. I'll start off by indicating that it is my view that the South African Reserve Bank, during its presidency of the G20, in partnership with the BIS, did indeed identify relevant focus areas in the payments area that we actually have managed to work through until now. And based on the discussions of today, I don't know whether colleagues are aware that the SAB and the BIS CPMI chose to just focus on 2 specific areas. The first one being looking at the data element of ensuring that we can move the dial in terms of improving cross-border payments. And as you have seen during the conversations today, we received a lot of research and data that definitely we can take away and ensure that we take the appropriate actions to ensure that, at least on the data part, selfishly, we wanted to ensure that we come up with actions that can benefit Sub-Saharan Africa. But while we contribute to the body of knowledge broadly in the global community. So I believe that based on what you have received today, you may give the researchers and the moderators a round of applause for the work that they delivered indeed. The second aspect was just on this aspect of discussion in the last panel relating to pre-validation, and I believe that in that respect, some people were asking questions as to whether we're trying to solve a question that has already been solved. I believe, based on the discussions, the issues have been surfaced. And definitely there would be action that would go a long way in ensuring that we address those issues and we are able to, in the cross-border context, embed the pre-validation mechanisms that can, in the most way, bring trust and transparency, as the topic reflected on the last subject spoke to. I'm not going to, I wrote everything that have been spoken about today, but I'm not going to read through that because I think this is just a recap for us to make that reflection that says, I think we managed to put focus where it's required in terms of what I just indicated to address the two areas. Now, you would have actually picked up that it seems both the private sector and the regulatory sector have got a role to play. A partnership is required in some respects. It seems the regulators are requested to take the lead and ensure that we move, and specifically when they take their catalyst role, to ensure that we move in the right direction. And of course, they need to remove the barriers that are in their spaces to create an enabling environment. There were issues of risk-based, proportionality, all those aspects that needs to be focused on by regulators to ensure that they pave the way for the private sector to roll out products and solutions, while of course, somewhere I believe the private sector needs a bit of a push from the regulators sometimes for the desired outcomes to be realized. Now, as I said, mine is just to close in a few minutes. I just want to bring it back to the initial engagements that we had today. You had a reflection about the priority actions and the engagements under the G20 roadmap. If I just give you 3 things of summing up the discussions of today, you'll recall that under the priority actions, there's an aspect that talks to payment system interoperability and extension, and in that basket, there's aspects that talks to practices that we need to adopt. There's aspects that talks to leveraging fast payments offerings and solutions, and of course, ensuring that we adopt service levels that would ensure that we deliver on the mission of ensuring that the customer is at the center. Secondly, there was a basket that looks to legal, regulatory, and supervisory frameworks. And these are sitting in the regulators' lab, and they need to actually internalize this work with the private sector, ensure that the dial is moved. And the last basket just talks to data exchange and message standards. Interoperability was spoken about. It's interoperability of systems, but of course, we should ensure that in that aspect, we also attend to fragmentation that is brought into the system, including fragmentation in the regulatory space. I'll stop here and thank the organizers for this, and I believe that this goes a long way in terms of the contribution of South Africa during its presidency. As we're going to be concluding this work, we're going to have a meaningful impact in most jurisdictions in Sub-Saharan Africa, and of course contribute to the body of knowledge. And indeed, where we surface issues and there's proposals on what can be done, it seems to me that we would leave our presidency at a logical point with aspects that something can be done about, rather than leaving the work half done, because sometimes you're not sure whether the next presidency will adopt what you were looking at. And I thank you, Thomas, Mavis, Arif, and colleagues, and I thank you all for staying until this time. Thanks very much.
All right, thank you so much, colleagues. We have come to the end of first day. It was indeed a day full of optimism and very solution-focused engagements, and I think we certainly heeded the call by DG Kasim, and he has also extended his appreciation of all of you for your attendance as well as for your meaningful participation in today's session. I do have some quick announcements before we close off and proceed as into the networking cocktail event. Starting first with the fact that there is a photo session that we need to just indulge our communications team by the stairs. So I'm sure you would have seen the stairs just outside this venue. Please, when we exit here, if you can just proceed as into the stairs for a photo moment. And then secondly, just a reminder, if you have not validated your parking tickets, please do let the team know. You can also just let me know, we'll be able to assist. We are aware that there are colleagues who want to move their vehicles from the State Theatre to the parking here. You are more than welcome to do that. The only ask is that can that please take place after the photo session. So the photo session will be relatively quick if you smile and bring on a happy face. And then for tomorrow, just a quick announcement that we will be joined by the governor, and we are starting at 8:45 a.m. sharp. So that's when he is meant to deliver a keynote address, which means we will appreciate it if you can please be seated in this room between 8:30 and 8:40 a.m. He's always on time, so please assist with that. That is, in a nutshell, the end of day one. I also have some remarks, but I'll just include them for Arif to do them tomorrow so that I don't hold up us further. Thank you so much, colleagues. Looking forward to seeing you tomorrow.